This is reading 3 of the Level 1 CFA program curriculum. I'm going to split reading 3 into a few different parts. So this is going to be part 1 of reading 3 for Level 1 CFA program curriculum reading. So today, I'm breaking it down into the first part. I'm going to break it down to around 5 or 6 parts because this is such a long reading. Okay, so reading 3 is the gist of Level 1's ethics chapter. So reading 3, guidance for standards 1 to 7. Learning outcomes, mastery. The candidates should be able to demonstrate the application of the Code of Ethics and Standards of Professional Conduct to situations involving issues of professional integrity, distinguish between conduct that conforms with the Code of Standards and conduct that violates the Code of Standards, recommend practices and procedures designed to prevent violations of the Code of Standards and professional conduct. Standard 1, professionalism. Standard 1A, knowledge of the law. Members and candidates must understand and comply with all applicable laws, rules, and regulations, including the CFA Institute Code of Ethics and Standards of Professional Conduct of any government, regulatory organizations, licensing agency, or professional association governing their professional activities. In the event of conflicts, members and candidates must comply with the most strict law, rule, or regulations. Members and candidates must not knowingly participate or assist and must dissociate from any violations of such laws, rules, and regulations. Guidance highlights relationship between code and standards and applicable laws, participation in or association with violations by others, investment products, and applicable laws. Members and candidates must understand the applicable laws and regulations of countries and jurisdictions where they engage in professional activities. These activities may include, but are not limited to, trading of securities and other financial instruments, providing investment advice, conducting research, or performing other investment services. On the basis of their reasonable and good faith understanding, members and candidates must comply with the laws and regulations that directly govern their professional activities and resulting outcomes, and that protect the interests of the clients. When questions arise, members and candidates should know the firm's policies and procedures for accessing compliance guidelines. The standards does not require members and candidates to be experts. However, in compliance, additionally, members and candidates are not required to have detailed knowledge or to be experts on all laws that could potentially govern their activities. During the changing regulations, members and candidates must remain vigilant in maintaining their knowledge of the requirements for their professional activities, now financial products and processes, along with uncovered ethical missteps, create an environment for recurring and potentially wide-ranging regulatory changes. Members and candidates are also continually provided improved and enhanced methods of communicating with both clients and potential clients, such as mobile applications and web-based social networking platforms. As new local, regional, and global requirements are updated and addressed, these are other changes. Members and candidates and their firms must adjust their procedures and practices to remain in compliance. The relationship between the code and standards and applicable laws. Some members or candidates may live, work, or provide investment services to clients living in a country that has no laws or regulations governing a particular action, or that the laws or regulations that differ from the regulations of the code. Applicable laws and the laws that governs the members or candidates' conduct, which laws apply will depend on the particular facts and circumstances of each case. The more strict law or regulation is the law or regulation that imposes greater restrictions on the actions of the member or candidate, or calls for the members or candidate to exert a greater degree of action that protects the interests of the investors. For example, applicable laws or regulations may not require members and candidates to disclose federal fees, referral fees received from or paid to another for the recommendation of investment products or services, because the code and standards impose the obligation. However, members and candidates must disclose the existence of such fees. Members and candidates must adhere to the following principles. 1. Members and candidates must comply with applicable laws or regulations related to their professional activities. 2. Members and candidates must not engage in conduct that constitutes a violation of the Code of Standards, even though it may otherwise be legal. 3. In absence of applicable laws or regulations, or the code and standards impose a higher degree of responsibility and acceptable law and regulations, members and candidates must adhere to the code and standards applications of the principles that are outlined in Exhibit 1. The applicable laws governing the responsibilities of a member or candidate should be viewed as a minimal threshold of accountable action, where members and candidates take action that exceeds the minimal requirements that further supports the conduct required of Standard I-VIII. CFA Institute members are obligated to abide by CFA Institute articles of incorporations, bylaws, code of ethics, standards of professional conduct, rules of procedures, membership agreements, and other applicable rules promulgated by CFA Institute, all as amended periodically. CFA candidates who are not members must also abide by these documents except for the membership agreement, as well as rules and regulations related to the examination of the CFA examination, the candidate responsibility statement, and the candidate pledge. Participation in or association with violations by others. Members and candidates are responsible for violations in which they knowingly participate or assist. Although members and candidates are presumed to have knowledge of all applicable laws, rules, and regulations, CFA Institute acknowledges that members may not recognize violations if they are not aware of all facts giving rise to the violations. Standards I applies to members and candidates that should know their conduct may attribute to violations of applicable laws, rules, or regulations, or the code of standards. If a member or candidate has reasonable grounds to believe the imminent or ongoing client or employer activity is illegal or unethical, the member or candidate must dissociate or separate from the activity. In extreme cases, dissociation may require the member or candidate to leave his or her employment. Members and candidates may take the following intermediate steps to dissociate the ethical violations of others when direct discussions with the person or persons committed the violation is unsuccessful. The first step should be an attempt to stop the behavior by bringing the attention of the employers through a supervisor of the firm compliance department. If the attempt is unsuccessful, the member or candidate have a responsibility to step away and dissociate from the activity. Dissociation practices will differ on the basis of the member's and candidate's role in the investment industry. It may include removing one's name from written reports or documents, asking for a different assignment, or refusing to accept a new client or continue to advise a current client. An action combined with continued association with those involved in illegal or unethical conduct may construed in participation or assistance in the illegal or unethical conduct. CFA Institute strongly encourages members and candidates to report potential violations of codes and standards committed by fellow members and candidates. Although a failure to report is less likely to construct a violation than a failure to dissociate from ethical conduct, the impact of an activity on the integrity of capital markets can be sufficient. Although code and standards do not compel members and candidates to report violations to the government or regulatory organizations, such disclosures is mandatory under applicable laws. Voluntary reporting is often referred to as whistleblowing. Such disclosures may be prudent under certain circumstances. Members and candidates should consult their legal compliances advisors for guidance. Additionally, CFA Institute encourages members, non-members, clients, and investing public to report violations of the Code of Standards by CFA Institute members or CFA candidates by submitting a complaint and reporting to the CFA Institute Professional Conduct Program via email or the CFA Institute website. Investment products and applicable laws. Members and candidates involving in creating or maintaining investment services or investment products or packages of securities and or derivatives should be mindful of where these products or packages will be sold, as well as their places and organizations. The applicable laws and regulations on countries or regions of organization and expect sales should be understood by the responsible and supervised of the services, creation, and the maintenance of the products or packages. Members or candidates should make reasonable efforts to review whether associated firms are distributing products or services developed by their employing firms Also abide by the laws and regulations for the countries and regions of distribution. Members and candidates should undertake the necessary due diligence when transacting cross-border businesses, understand multiple applicable laws and regulations in order to protect the reputation of the firm and themselves. Given the complexity that can arise when businesses transactions in today's market, there may be some uncertainty surrounding the laws or regulations are considered applicable when activities are being conducted in multiple jurisdictions. Members and candidates should seek the appropriate guidances, potentially including the firm's compliance or legal department or legal counsel outside the organization, to gain a reasonable understanding of their responsibilities and how to implement them appropriately. Exhibit 1. Global application of the Code and Standards. Members and candidates who participate in multiple jurisdictions may be subject to varied securities laws and regulations. If applicable laws are stricter than the requirements of the Code of Standards, members and candidates should adhere to applicable laws. Otherwise, they must adhere to the Code and Standards. The following chart provides illustrations involving members who may be subject to securities laws and regulations of 3 different types of countries. NS are countries with no securities laws or regulations. LS are countries with less strict security laws and regulations than the Code and Standards. MS are countries with more strict laws and regulations than the Code and Standards. Applicable laws. Okay. Members residing in NS countries does business in an LS country. LS country laws applies. The duty for members must adhere to the Code and Standards. The explanation for this is because applicable laws is less strict than the Code and Standards, and members must adhere to the Code and Standards. Recommended procedures of compliance. Members and candidates. Suggested methods by which members and candidates can acquire and maintain understanding of applicable laws, rules, and regulations include the following. Stay informed. 1. Stay informed. The members and candidates should establish and encourage their employers to establish a procedure by which employees and regulatory informed about changes in applicable laws, rules, and regulations and case law. In many instances, the employer's compliance department or legal counsel can provide such information in the form of mandatorums or distributed to employees in the organization. Also, participation in an internal or external continuing education program is a practical method of staying current. 2. Review procedures. Members and candidates should review or encourage their employers to review the firm's written compliances procedures on a regular basis to ensure that the procedures reflect current law and provides adequate guidance to employees about what is permissible conduct under the law and or Code and Standards. Recommended compliance procedures for specific items of the Code and Standards are discussed in the handbook in the guidance section associated with such standards. Maintain current files. Members and candidates are 3. Maintain current files. Members and candidates should maintain or encourage their employers to maintain readily accessible current references, copies of applicable statutes, rules, regulations, and important cases. Distribution area laws. Members and candidates should make reasonable efforts to understand the applicable laws, both country and regional, for the countries and regions that their investment products are developed and most likely to be distributed to clients. Legal counsel. When in doubt about the appropriate actions to undertake, it is recommended that a member or candidate seeks the advice of compliance personnel or legal counsel concerning legal requirements of a potential violation is being committed by a fellow employee. It may be prudent for the member or candidate to seek the advice of the firm's compliance department or legal counsel. Disassociation. When disassociating from an activity that violates the Code and Standards, members and candidates should document the violations and urge their firms to attempt to persuade the perpetrators to cease such conduct, to dissociate from conduct. A member or candidate may have to resign his or her employment. Firms. The formality and complexity of a compliance procedure for firms depends on the nature and size of the organization and the nature of its involvement operations. Members and candidates should encourage their firms to consider the following policies and procedures support the principles of Standards I-VIII. Development and or adopt the code of ethics. The ethical culture of an organization starts on the top. Members and candidates should encourage their supervisors or managers to adopt the code of ethics. Adhering to the code of ethics facilitates solutions when people face ethical dilemmas and can prevent the need for employers to resort to a whistleblowing solution. Publicly alleging counseled misconduct. CFA Institute has published the Asset Manager Code of Professional Conduct, which firms may adopt or use as the basis for their code. Provide information on applicable laws, pertinent information that highlights applicable laws and regulations might be distributed to employees or made available in a current location. Information sources may include primary information developed by the relevant governmental agencies, regulatory organizations, licensing agencies, and professional agencies, e.g. from the website, laws, firms, memorandums, newsletters, and associations, memorandums, or publications, e.g. CFA Institute magazine. Lastly, establish procedures for reporting violations. Firms might provide written protocols for reporting suspected violations of the laws, regulations, and company policies. Applications of standards. Example 1, notification of known violations. Michelle Allen works at a brokerage firm and is responsible for an overwriting of securities. A company official gives Allen information indicating that the financial statements Allen filed with the regulatory overstates the issue's earnings. Allen seeks the advice of the brokerage firm's general counsel, who states that it would be difficult for the regulator to prove that Allen has been involved in any wrongdoing. Comment. Although it is recommended that members and candidates seek the advice of legal counsel, and reliance on such advice does not absolve a member or candidate from the requirement to comply with the law or regulations, Allen should report the situation to a supervisor, seek an independent legal opinion, and determine whether the regulator should be notified of the error. Example 2, dissociate from a violation. Lawrence Brown's employer, an investment banking firm, is the principal underwriter for an issue of convertible debentures by the Courtney Company. Brown discovers the Courtney Company has concealed severe third quarter losses in its foreign operations. The preliminary prospectus has already been distributed. Comment. Knowing that the preliminary prospectus is misleading, Brown should report his findings to the appropriate supervisory persons in his firm. And the matter is not remitted. Brown's employees does not disassociate from the underwriting. Brown's should sever all his connections to the underwriting. Brown should also seek legal advice to determine whether additional reporting or other actions should be taken. Example 3, dissociating from a violation. Kamisha Washington's firms advises past performance records by showing the 10-year return of a composite of a client's account. Washington discovers, however, that the composite omits the performance of accounts has left the firms during the 10-year period, whereas descriptions of the composite indicates the inclusion of all firms' accounts. The omission has led to an inflated performance figures. Washington is asked to use promotional material that includes the erroneous performance numbers when soliciting business for the firm. Comment. Misrepresenting performances is a violation of the code and standards. Although she did not calculate the performance herself, Washington would be asserting and violating Standards I-VIII if she was used to inflate if she was used to inflate performance numbers when soliciting clients. She must dissociate herself from the activity if discussing the misleading numbers with the person responsible if is not an option for correcting the problem. She can bring the situation to the attention of her supervisor or the compliance department at her firm. If her firm is unwilling to recalculate performances, she may refrain from using the misleading promotional material and should notify the firms of her reasons. If the firms insist that she use the material, she should consider whether her obligations to dissociate from her activities require to seek other employment. Example 4, following the highest requirement. James Collins is an investment analyst at a major Wall Street brokerage firm. He works in a developing country with a rapidly modernizing economy and a growing capital market. Local securities laws are minimal in the form of content and includes non-punitive prohibitions against insider trading. Comment: Collins must abide by the requirements of the Code of Standards, which might be more strict than the rules of the developing country. He should be aware of the risks of small market and abundance of fairly regulated flows of information in the market represents to his ability to obtain information and make a timely judgment. He should include this factor in formulating his advice to clients and handling material non-public information that accidentally comes into his possession. He must follow Standards II-VIII, material non-public information. Example 5, following the highest requirements. Laura Jameson works in a multinational investment advisor based in the United States. Jameson lives and worked as a regulatory investment advisor in a tiny but wealthy island nation of Caramba. Caramba securities laws state that no investment advisors registered and working in the country can participate in initial public offerings, IPOs, for the advisor's personal account. Jameson, believing that as a U.S. citizen working for a U.S.-based company, she should comply with U.S. laws, has ignored the Caribbean law. In addition, Jameson believed that a charter holder, as long as she adheres to the code and standards requires, she disclose her participation in any IPO to her employer and candidates. When such ownership creates a conflict of interest, she is meeting the highest ethical requirements. Comment: Jameson is in violation of Standards I-VIII as a regulatory investment advisor in Caramba. Jameson is prevented by Caramba security laws from participating in IPOs regardless of the laws of her home country. In addition, because the laws of the country where she is working is stricter than the code and standards, she must follow the stricter requirements of the local laws rather than requirements of the code and standards. Example 6, laws and regulations based on religious tenets. Amanda Janney is employed in a fixed income portfolio manager for a large international firm. She is on a term within her firm, is responsible for creating and managing a fixed income hedge fund to be sold throughout the firm's distribution centers to high net worth clients. Her firm receives expressions of interest from potential clients from the Middle East who are seeking investment of the company in comply with Islamic law. The marketing and promotional material for the fixed income hedge fund do not specify whether or not the fund is a suitable investment for investment seeking compliance with Islamic law. Because the fund is being distributed globally, Jenny is concerned about the reputation of the fund and the firm, and believes disclosure of whether or not the fund complies with Islamic law can help minimize potential mistakes and placing this investment. As the financial market continues to become globalized, members and candidates will need to be aware of different differences between cultures, regulations, laws, and requirements, as well as different governmental laws and regulations. Jenny and the firm could be proactive in the efforts to acknowledge areas where the new funds may not be suitable for clients. Example 7, reporting potential unethical actions. Krista Bloom is a junior portfolio management at a high net worth portfolio portfolios for a large global investment manager. She observes a number of new portfolios and relationships coming from a country in Europe where the firm did not have previous businesses, and is told that a broker is in the country is responsible for the new businesses. At a meeting on allocation of resource to third-party research firms, Bloom notes that this broker has not been added to the list and is allocated payments for research. However, she knows the portfolio do not invest in securities in the broker's country, and she has not seen any research come from the broker. Bloom asked her supervisor about the name being on the list, and she told somewhere inappropriate research payments, and she wished to dissociate from the misconduct. Comment: Bloom should follow the firm's policies and procedures for reporting potentially unethical disclosures between the new broker's relationship and the research payment. Example 8, failure to maintain knowledge of the law. Collins White is excited to use new technology to communicate with clients and potential clients. She recently been posting investment information, including performance reports and investment opinions on recommendations on her Facebook page. In addition, she sends out brief announcements, opinions, and thoughts on her Twitter account. For example, prospects of future growth of XYZ company looks good. # make money for you. Prior to White's use of these social media platforms, the local regulatory has issued new requirements and guidances governing online and electronic communication. While communication appears to conflict with the recent regulatory announcements. Comment: White is in violation of Standards I-VIII because her communications do not comply with the existing guidance and regulations governing use of social media. White must be aware of the involving legal requirements pertaining to new and dynamic areas of financial services industry that are applicable to her. She should seek guidance from appropriate, knowledgeable, and reliable sources, such as her firm's compliance department, external service providers, or outside counsel, unless she diligently follows legal and regulatory trends affecting professional responsibility. Standard 1B, independence and objectivity. Members and candidates must use reasonable care and judgment to achieve and maintain independence and objectivity in their professional activities. Members and candidates must not offer, solicit, or accept any gifts, benefits, compensations, or considerations that might reasonably be expected to compromise their own or others' independent or objectivity. Guidance highlights 1, buy-side clients, 2, fund managers and custodial relationships, 3, investment banking relationship, 4, performance measurements and attributions, 5, public companies, 6, credit rating agency opinions, 7, influence during the manager selection pronouncement process, 8, issue paid research, lastly 9, travel funding. Standard 1B states the responsibility of CFA Institute members and candidates in CFA program to maintain independence and objectivity so that their clients will have the benefit of their work and opinion unaffected by any personal conflict or interest or other circumstances adversely affecting their judgment. Each member and candidate should endeavor to avoid situations that could cause or be perceived to cause a loss of independence or objectivity to recommend investment or taking investment action. External sources may try to influence the investment process by offering analysis and portfolio managers a variety of benefits. Corporations may seek expanded research coverage issues, and underwriters may wish to promote new securities offerings. Brokers may want to increase commission businesses, and independent rating agencies may be influenced by the companies requesting the rating benefits. Benefits may include gifts, invitations to lavish functions, tickets, favors, or job referrals. One type of benefit is the allocation of share or unsubscribed IPOs in the investment managers for their personal accounts. This practice affords managers an the opportunity to make quick profits that may not be available to their clients. Such a practice is prohibited under Standard I-VIII. Modest gifts and entertainment are acceptable, but special care must be taken by members and candidates to resist subtle and not so subtle pressure to act in conflict with the interests of the clients. Best practice dictates the members and candidates reject any offer of gifts or entertainment that can be expected to threaten their independence and objectivity. Receiving a gift, benefits, or consideration from a client can be distinguished from gifts by entities seeking to influence the members or candidates to determinant or other clients in a client relationship. The client has already entered some type of compensation agreement with a member candidate or his or her firm. A gift from a client could be considered supplementary compensation. The potential gift for obtaining influence to the determinant of other clients, although persistence is not as great as in situations where no compensation arrangement exists. When possible, prior to accepting bonuses or gifts from clients, members and candidates should disclose to employers such benefits offered by clients. If notifications is not possible prior to acceptance, members and candidates must disclose their employer benefits previously accepted from clients. Disclosures allows the members or candidates to make an independent determination about the extent to which the gift may affect the members and candidates' independence and objectivity. Members and candidates may also come under pressure from their own firms to, for example, issue favorable research reports or recommend their recommendations for certain companies with potential or continued business relationship with the firm. The situation may be aggravated and exclusive of the company sits on the bank of or investment firms broad and attempt to interfere in investment decision-making. Members and candidates acting in a sale or marketing capacity should be especially mindful of the objectivity in promoting appropriate investment for their clients. Left unmanaged pressures that threatens independence place research analysts in a difficult position, and many jeopardize their ability to act independently and objectively. One of the ways this research analysis can have copied pressure the past is to use subtle and ambiguous language in their recommendations or to temper the tone to their research reports. Such subtitles are lost in some investors, however, who reasonably expect research reports and recommendations to be straightforward and transparent and to communicate clearly an investment analyst's view based on unbiased analysis and independent judgment. Members and candidates are personally responsible for maintaining independence and objectivity when preparing research reports, making investment recommendations, and taking investment actions on behalf of clients. Recommendations must convey the members and candidates' true opinion, free of bias or internal or external pressure, and be stated in clear and ambiguous language. Members and candidates also should be aware that some of the professional or social activities within CFA Institute or its member societies may subtly threaten their independence or objectivity. When seeking corporate financial support of conventional seminars or even weekly society luncheons, members and candidates reasonable for activities should evaluate both the actual effect of such solicitations on their independence and whether the objectivity may be perceived to be compromised in the eyes of their clients. Buy-side clients, one source of pressure on sell-side analysts is buy-side clients. Institutional clients are traditionally the primary use of sell-side research, either directly or with soft dollar brokerages. Portfolio managers may have significant positions in the securities of a company under review. A rating downgrade may adversely affect the portfolio's performance, particularly in the short term. Because the sensitivity of stock prices and rating changes has increased in recent years. The downgrade may also affect the manager's compensation, which is usually tied to portfolio performance. Moreover, portfolio performance is subject to media and public scrutiny, which may affect the portfolio manager's professional reputation. Consequently, some portfolio managers implicitly or explicitly support sell-side rating inflation. Portfolio managers have a responsibility to report and foster the intellectual honesty of sell-side research. Therefore, it is improper for portfolio managers to threaten or engage in retaliatory practices such as reporting sell-side analysts to the covered company in order to instigate negative corporate reactions. Although most portfolio managers do not engage in such practices, the precipitation by the research analysis that revisal is possible may cause concerns and make it difficult for an analyst to maintain independence and objectivity. Fund managers and custodial relationships. Research analysts are not the only people who may be concerned with maintaining their independence. Members and candidates who are responsible for hiring and retaining outside managers and third parties custodians should not accept gifts, entertainment, or travel funding that may perceive as impairing their decisions. The use of secondary fund managers has evolved into a common practice to manage specific asset allocations. The use of third-party custodians is common practice for independent investment advisory firms and help them with trading compatibilities, and custodians after arrange educational and marketing events and to inform others about their business strategies, investment process, and custodial services. Members and candidates must review their merits of each offers individually in determining whether they may attend yet maintain their independence. Investment banking relationships. Some sell-side firms may exert pressure on their analysts to issue favorable research reports on current or prospective investment banking clients. For many of these firms, income from investment banking has become increasingly important to overall firms' profitability because brokerage investment has declined as a result of price competition. Consequently, firms offering investment banking services work hard to develop and maintain relationships with investment banking clients and prospects. These companies are often covered by the firm's research analysts because companies often select their investment banking banks on the basis of reputation and their research analysts, the quality of their work, and their standing in the industry. In some countries, research analysts frequently work closely with the investment banking colleagues to help evaluate prospective investment banking clients. In other countries, because past abuses of managing the obvious conflicts of interest, regulators have established clear rules prohibiting the interactions of these groups. Although collaboration between research analysts and investment banking colleagues may benefit the firm and enhance market efficiency, e.g. by allowing firms to assess risks more accurately and make better pricing assumptions, it requires firms to carefully balance the conflicts of interest inherent in collaborations. Having analysts work with investment bankers is appropriate only when conflicts are adequately and effectively managed and disclosed. Firms managers have a responsibility to provide an environment in which analysts are neither coerced nor enticed into issuing research that does not reflect their true opinion. Firms should require public disclosure of actual conflicts of interest to investors. Members, candidates, and their firms must adapt and follow perceived best practices in maintaining independence and objectivity in the corporate culture and protecting analysts from undue pressure by their investment banking colleagues. The firewall traditionally built between these two functions must be managed to minimize conflicts of interest. Indeed, enhanced firewalls policies may go as far as prohibiting prohibiting all communication between these groups. An element of an enhanced firewall is separate reporting structures for personnel on the research side and personnel on the investment banking side. For example, investment banking personnel should not have any authority to approve, disapprove, or make changes to research reports or recommendations. Another element should be a compensation arrangement that minimizes the pressure on researchers, analysts, and reward objectivity and accuracy. Compensation arrangements should not link analyst remunerations directly to investment banking assignments, in which the analyst may participate as a term member. Firms should also regularly review their policies and procedures to determine whether analysts are adequately safeguarded, and to improve the transparency of disclosure relating to conflicts of interest. The highest level of transparency is achieved when disclosures are prominent and specific rather than marginalized and generic. Members and candidates working within a firm's investment performance measures departments may be also presented with situations that challenge their independence and objectivity. As performance analysts, their analysis may reveal instances where managers may appear to have stayed for their mandate. Additionally, for performance analysts may receive requests to alter the construction of composite indexes owning the negative result from a selective account or fund. The member or candidate must not allow internal or external influences to affect their independence or objectivity as they faithfully complete their performance calculations and analysis related responsibilities. Public companies analysts may be pressured to issue favorable reports and recommendations by the companies they follow. Not every stock is a buy, and not every research report is favorable for many reasons, including the cyclical nature of many business activities. The market fluctuations, for instance, a good company does not always translate into a good stock. Relating to the current stock price is fully valued. In making the investment recommendations, the analyst is responsible for anticipating, interpreting, and assessing a company's prospects and stock price performances in a factual manner. Many company managers have believed that their company stock is undervalued, and these managers may find it difficult to accept critical research report or rating downgrades. Company managers' compensation may also be dependent on stock performances. Due diligence and financial research and analysis involves gathering information from a wide variety of sources, including public disclosure documents such as proxy statements, annual reports, and other regulatory filings. And also company management and investment relations, personnel, suppliers, customers, competitors, and other relevant sources. Research analysts must justifiably fear the companies with limit their ability to conduct thorough research by denying analysts who have negative reviews direct access to company managers and or bearings on them, conferences, calls, and other communications venues. Regulatory practices includes companies bring legal actions against analysts personally and or the firms to seek monetary damages for economic effects of negative reports and recommendations. Although few companies engage in such behaviors, the perception that is reprisal is possible and a reasonable concern for analysts. The concern may be difficult for them to conduct the comprehensive research needed to make objective recommendations. For further information and guidance, members and candidates should refer to CFA Institute publications, best practice guidelines governing analysts/corporate issue relations. Credit rating agencies' opinions. Credit rating agencies provide a service of grading the fixed income products offered by companies. Analysts face challenges related to incentivized and compensation schemes that may be tied to final ratings and successful placements of products. Members and candidates employed at rating agencies should ensure the procedures and processes at the agencies prevent undue influences from a sponsoring company. During the analysis, members and candidates should abide by their agencies and the industry standards of conduct regarding the analytical process and distribution of the reports. The investment credit rating agencies also raises concern over concerns similar to those inherent in investment banking relationships. Analysts may face pressure to issue ratings as a specific level because of other services the agencies offer companies, namely advising on the development of structural products. The rating agencies need to develop the necessary firewalls and protections to allow the independent operations for the different business lines. When using information provided by credit rating agencies, members and candidates should be mindful of the potential conflicts of interest, and because of the potential interest, members and candidates may need to be independent, validate the rating agencies granted influence during the manager selection / pronouncement process. Members and candidates may find themselves on either side of the manager selection process. An individual may be on hiring side as a representative for a pension organization or an investment committee member for an endowment of a charitable organization. Additionally, other members may be representing their organization in attempts to earn new investment allocation mandates. The responsibility of members and candidates must to maintain their independence and objectivity and extends to hiring or firing those who provide business services beyond investment management. When serving in a hiring capacity, members and candidates should not solicit gifts, contributions, or other compensations that may affect their independence and objectivity. With Standards I-VIII, requesting contributions to a favorite charity or political organization may also be perceived as an attempt to influence the decision-making process. Additionally, members and candidates serving in a hiring capacity should refuse gifts, donations, and other offered compensations that may perceive to influence their decision-making process. When working to earn a new investment allocation, members and candidates should not offer gifts, contributions, or other compensations to influence the decision of the hiring representative. The offering of items with the intent to impair the independence and objectivity of another person will not comply with Standards I-VIII. Such prohibited actions may include in the denotations to a charitable organization or political candidate referred by the hiring representatives. A clear example of improperly influenced hiring representatives was displayed in the pay-to-pay scandal involving government-sponsored pension funds in the United States. Managers look to gain lucrative allocations from the large funds, made requested donations to the political campaigns of individuals directly responsible for the hiring decisions. The scandal and other similar events have led to new laws requiring additional reporting concerning political contributions and bans on hiring or hiring delays for managers that may campaign distributions to representatives associated with the decision-making process. Leisure-paid research in light of recent reduction of sell-side research coverage, many companies seeking the increased visibility both in the financial markets and with potential investors have hired analysts to produce research reports analyzing their companies. These reports bridge the gap created by the lack of coverage and can be an effective method of communicating with investors. Leisure-paid research conduct by independent analysts, however, is fraught with potential conflicts depending on how the research is written and distributed. Investors may be misled into believing that the research is a form of independent source, where in reality has been paid by a subject company. Members and candidates must adhere to the strict standards of conduct that governs how the research is to be conducted and what disclosures must be made in the report. Analysts must engage in thorough, independent, and unbiased analysis and must fully disclose potential conflicts of interest, including the nature of their compensation. Otherwise, analysts risk misleading investors. Investors need clear, credible, and thorough information about companies, and they need research based on independent dot at a minimum. At a minimum, issuer paid research should include a thorough analysis of the company's financial statement based on publicly disclosed information benchmarked within a peer group. The industry analysts must exercise diligence, independence, and thoroughness in conducting their research in an objective manner. Analysts must distinguish between fact and opinion in their reports. Conclusions must have a reasonable and adequate basis and must be supported by appropriate research. Independent analysts must also strictly limit the type of compensation that they accept for conducting issue paid research. Otherwise, the content and conclusions of the reports could reasonably be expected to be determined or affected by compensation from the sponsoring companies. Compensation that may affect the research both report could be direct, such as payment based on the conclusions of a report, or indirect, such as stock awards or other equity instruments that could increase in value on the basis of positive coverage in a report. In such instances, the independent analyst may have an incentive to avoid including negative information or making negative conclusions. Best practice is for independent analysts prior to writing their reports to negotiate only a flat fee for their work that is not linked to their conclusions or recommendations. Traveling funding. The benefit related to accepting paid travel extends beyond the cost savings to the members or candidates and his firm, such as the change to talk exclusively with the executives of a company or learning more about investment options provided by an investment organization. Acceptance also comes with potential concerns. For example, members and candidates may be influenced by the decisions when flying on a corporate or chartered jet, or attending sponsored conferences where many expenses, including airfares, are lodging and covered, to avoid the appearance of compromising their independence and objectivity. Best practice dictates that members and candidates always use commercial transportation at their expense or at the expense of their firm, rather than expecting paid travel arrangements by the outside company. Should commercial travel be unavailable, members and candidates may accept modestly arranged travel and participate in appropriate information gathering events such as a property tour. Recommended procedures for compliance. Members and candidates should adhere to the following practices and should encourage their firms to establish procedures to avoid violations and Standards I-VIII. Protect integrity of opinion. Members and candidates and their firms should establish policies stating that every research report concerning the securities of a corporate client should reflect the unbiased opinion of an analyst. Firms should also design compensation systems that protect the integrity of the investment decision process by maintaining the independence and objectivity of analysis. Create a restricted list if the firm is unwilling to permit dissemination of adverse opinion about the corporate client. Member and candidates should encourage the firm to remove the controversial company from the research universe and put on a restricted list so that the firms disseminates only factual information about the company, restrict special cost arrangement when attending meetings at an issuer's headquarters. Members and candidates should pay for commercial transportation and hotel charges. No corporate issuers should reimburse members or candidates for air transportation. Members and candidates should encourage issuers to limit the use of corporate aircrafts to situations in which commercial transportation is not available or which efficient movement could not otherwise be arranged. Members and candidates should take particular care when frequent meetings are held between individual issuers and their individual members or candidates. The issuer should always host the members or candidates. Limit gifts. Members and candidates must limit the acceptance of gratuities or gifts or token items. Standards I-VIII does not preclude customary ordinary business-related entertainment, as long as its purpose is not to influence or reward members or candidates. Firms should consider a strict value limit for acceptable gifts that is based on the local or regional customs, and should address whether the limit is per gift or aggregate annual value. Restrict investments. Members and candidates should encourage their investment firms to develop formal policies relating employee purchases of equity or equity-related IPOs. Firms should require prior approval for employees participating in IPOs with prompt disclosure of investment actions taken following the offering. Strict limits should be imposed on investment personnel requiring securities and private placements. Review procedures. Members and candidates should encourage their firms to implement effective supervisory and review procedures to ensure the analysts and portfolio managers comply with policies relating to their personal investment activities. Independent policies. Candidates and their firms should establish formal writing policies on the independence and objectivity of research and implement reporting structure and review procedures to ensure the research analysts do not report and are not supervised by or controlled by any department of the firm that could compromise the independence of the analyst. More detailed recommendation related to the firm's policies regarding research objectivity are set forth in the CFA Institute Statement. Research objectivity standards. Appointed officers. Firms should appoint a senior officer who oversees responsibilities for compliance with the firm's code of ethics and all regulations concerning its business. Firms should provide every employee with the procedures and policies for reporting potential unethical behavior violations and regulations or other activities that may harm the firm's reputation. Applications of the standard. Example 1, travel expenses. Stephen Taylor, mining analyst for Bronson Brokers, is invited to Precision Metals to join a group of his peers to tour mining facilities in several western U.S. states. The company arranges a chartered group flight from site to site for accommodation of Spartan motels, the only chain of accommodation near the miners. For 3 nights, Taylor allows Precision Metals to pick up his tab, as do other analysts, with one exception, John Adams, an employee of a large trust company who assists on following his company's policies of paying for his hotel rooms himself. Comment: the policy of the company where Adams works complies closely with the Standard I-VIII, avoiding even the appearance of a conflict of interest, but Taylor and the other analysts who are not necessarily violating Standards I-VIII. In general, when allowing companies to pay for travel and or accommodation of the circumstances, members and candidates must use their judgment. They must be on guard on such arrangement, not impinging on members or candidates' independence and objectivity. In this example, the trip was strictly for business, and Taylor was not accepting irrelevant or lavish hospitality. The itinerary requirements, chartered flights for which analysts were not expected to pay. Accommodations were modest. The arrangements are not unusual and do not violate Standards I-VIII, as long as Taylor's independence and objectivity were not compromised in the final analysis. Members and candidates should consider both whether they can remain objective and whether their integrity may be perceived by their clients to have been compromised. Example 2, research independence. Susan Dealins, an analyst at a corporate finance department at an investment service firm, is making a presentation to a potential new business client that includes the promise of her firm will provide full research coverage but she must not commit her firm's research department to provide favorable recommendations. The firm's recommendations, favorable, neutral, or unfavorable, must be based on an independent and objective investigation of analysts of the company and its securities. Example 3, research independence and intra-firm pressure. Walter Fritz is an equity analyst at Hilton Brokerage who covers the mining industry. He has concluded that the stock of metal and mining is overpriced. In fact, a senior manager at Hilton Manager Bank. Walter Fritz is an equity analyst at Hilton Brokerage who covers the mining industry. He has concluded that a stock of metals and mining is overpriced and the current value, but is concerned the negative research report or good relationship between the metals and mining and investment banking division of his firm. In fact, the senior manager at Hilton Brokerage has sent him divisions of the firms. In fact, a senior manager has sent him a copy of a proposal his firm has made to metals and mining to rewrite a debt offering. Fritz needs to produce a report right away and is concerned about issuing a less than favorable rating. Comment. Fritz's analysis of metals and mining must be objective and based solely on the consideration of the company's fundamentals. Any pressure from other divisions of his firms is inappropriate. The conflict could have been eliminated if, in anticipation of the offering, Hilton Brokerage have placed metals and mining on the restricted list of its sales force. Example 4, research independence and issuer relationship pressure. As an example 3, Walter Fritz has concluded that metals and mining stock is overvalued at the current level, but he is concerned that the negative research report might jeopardize the close report that has nurtured over the years. With metals mining CEO, the chief financial officer, and investment relations officers. Fritz is concerned that a negative report may result in management retaliation. For instance, cutting him off from participating in conferences caused or when a quarterly earning release is made, denying him the ability to ask questions on such calls and or denying him access to top management or arranging groups meeting between Hilton Brokerage clients and the top metal and mining managers. Comment. As an example 3, Fritz's analysis must be objective and based solely on the consideration of company's fundamentals. Any pressure from metals and mining is inappropriate. Fritz should reinforce the integrity of his conclusions by stressing that his investment recommendation is based on the relative valuations, which may include quantitative leisures with respect to metals and mining management. Example 5, research independence and sales pressure. As support for the sales effect in her corporation bonds department, Lindsay Warner offers credit guidance to purchase of fixed income securities. Her compensation is closely linked to the performance of the corporate bond department. Nearly the quarter's end, Warner's firm comment. Unethical sales practices create significant potential violations of the code and standards. Warner's opinion on the Molten brand must not be affected by the internal pressures or compensation. In this case, Warner must refuse to push the Molten's bonds unless she is able to justify that makes The market price has already adjusted for the operating problems. Example 6, research independence and prior coverage. Joe Gerald is a securities analyst following airline stock, a rising star in her firm. Her boss has been carrying a buy recommendation for international airlines and asked Gerald to take a coverage of that airlines. He tells Gerard that under no circumstances should the prevailing recommendation be changed. Gerard must be independent and objective in her analysis of international airlines. If she believes her boss' instruction has compromised her, she has two options. She could tell her boss that she cannot cover company under these circumstances, or that she can take over coverage of the company, reach her own independent conclusions, and if the conflict with the boss' opinions, shares with the conclusion with her boss and other supervisors in the firms so that they can make appropriate recommendations. Duran must issue only recommendations that reflect her independent and objective opinion. Gifts and example 7, gifts and entertainment from related parties. Edward Grant directs a large amount of his commission business in a New York-based brokerage house. In appreciation for all his business, the brokerage house gives Grant 2 tickets to the World Cup in South Africa, 2 nights at the nearby resort, several meals, and transportation via limousine to the game. Grant fails to disclose receiving these packages to a supervisor. Grant has violated Standards I-VIII because accepting these substitutional gifts may impede his independence and objectivity. Every member and candidate should endeavor to avoid situations that may cause or be perceived to cause a loss of independence or objectivity in recommending investments or taking investment actions. By accepting the trip, Grant has opened himself to the accusations that he may give the broker favored treatment to return. Example 8, gifts and entitlement from clients. Farissa Green manages a portfolio for Irene Noden, a client of Drisbury Investment. Green achieves an annual return for Noden that has consistently better than other benchmarks she has the clients previously agreed to. As a reward, Noden offers Green 2 tickets to Wimbledon and the use of Noden's flat in London for a week. Green discloses this gift to a supervisor at Trisbury. Green is in compliance with Standards I-VIII because she disclosed the gift from her clients in accordance to his firm's policies. Members and candidates may accept bonuses or gifts from clients as long as they disclose them to the employers, because gifts is in a client relationship status are deemed less likely to affect the members or candidates' objectivity and independence than gifts to other situations. Disclosure is required, however, that a supervisor can monitor such situation to guard against employees favoring a gift-given client to the determinants of other fee-paying and clients, such as by associating a greater proportion of IPO stock to the gift-giving client's portfolio. Best practices for monitoring includes comparing the transaction cost of a knowing account from the cost of other accounts managed by Green. Other similar accounts within Fishberry supervisors could also compare the performance returns, which can with the returns of other clients. With the same mandate. This comparison will assist in determining whether a pattern of favoritism by Green is disadvantaging other Trisbury clients, or the possibility of this favoritism could affect her future behavior. Example 9, travel expenses and external managers. Tom Wayne is an investment manager of the Franklin City Employee Pension Plan. He recently completed a successful search for a firm to manage the foreign equity allocations of the plan's diversified portfolio. He followed the plan's standards procedures of seeking presentations from a number of qualified firms and recommendations that his board select Penguin Advisors because of its experience well-defined investment strategies and performance records. The firm claims compliance with global investment performance standards GIPS and has been verified following the the selections of Penguin. A reporter from the Franklin City Recorder calls to ask there was any connections between the actions of the fact that Penguin was one of the sponsors of an investment fact-funding trip to Asia that Wayne made earlier the year. The trip was one of several conducted by the Pension Investment Academy, which has arranged a literary meeting with economic, government, and corporate officers in major cities in several Asian countries. The Pension Investment Academy obtains support for the cost of these trips from a number of investment managers, including Penguin advisors. The Academy then pays the travel expenses of the various pensions plan managers on the trip and provides all meals and accommodations. The president of Penguin Advisors was also one of the travelers on the trip. Comment: although Wayne could probably put a good use to the knowledge he gained from the trip in selecting portfolio managers in other areas of managing the pension plan, his recommendations of Penguin Advisors may be tainted by possible conflicts occurring when he participates in a trip partly paid by Penguin Advisors when he was in the daily company of the president of Penguin Advisors to avoid violating Standards I-VIII. Wayne's basic expenses for travel and accommodations should have been paid by his employer, or the pension plan contract with the president of Penguin Advisors should have been limited to informational or educational events only. On the trip, the organizer and sponsor should have been made a matter of public record, even if his actions were not in violation of Standards I-VIII. Wayne should be able to have been sensitive to the public perception of the trip when reported in the newspapers and the extent to which the subjective elements of his decision may have been affected by the familiarity of the daily contact of such a trip would encourage this advantage would probably not be shared by firms competing with Penguin Advisories. Example: 10 research independence and compensation arrangements. Javier Hario recently left his job as an analyst, as a research analyst for an investment advisor. While looking for new positions, he was hired by investment relations firms to write a research report on one of its clients, a small educational software company. The investor relationship firms hopes to generate investor interest in the technology company. The firm will pay Hilario a flat fee plus a bonus if any new investors buy the stock in the company as a result of Hilario's report. If Hilario accepts his payment arrangement, he will be in violation of 1B because the compensation arrangement can reasonably be expected to compromise his independence and objectivity. Hilario will receive a bonus for attracting investors, which provides an incentive to draft a positive report regardless of the facts and to ignore or to play down negative information about the company. Hilario should only accept a fat fee that is not tied to the conclusion or recommendation of the report. Issuer paid research that is objective and unbiased can be done under the right circumstances as long as the analyst takes steps to maintain his or her objectivity and includes in the report proper disclosures regarding potential conflicts of interest. Example 11, recommendation, objectivity, and service fees. 2 years ago, Bob Wade, trust manager of Central Midas Bank, was approached by Western Funds about promoting its family of funds with special interest in the service fee class of funds to entice Central to promote this class. Western Funds offered to pay the banks a service fee of 0.25% without disclosing the fees being offered to the bank. When asked one of the investment managers to review Western funds to determine whether they were suitable for clients or of central Medes banks, the manager completed the nominal due diligence, reviewing and determined that the new funds were fairly valued in the market, with fees structured on a par with competitors. Wade decided to accept Western's offer and instructed the team of portfolio managers to exclusively promote these funds and the service fee class of the clients seeking to invest new funds or transfer from their current investments. Now, 2 years later, the fund manager by Western began to underperform their prayers. Wade is counting on the fees to reach his profitability target and continues to push these funds as acceptable investments in the Central's clients. Comment where Wade is violating Standards I-VIII because the fee arrangement has affected the objectivity and his recommendation. Right, Wade is relying on the fee of his component of the department's profitability and a willingness and is unwilling to offer other products that may affect the fees received. See also Standards VI, which is 6A, disclosure of conflict. Example 12, recommendation objectivity. Bob Thompson has been doing research for a portfolio manager on the fixed income department. His assignment is to do sensitivity analysis on scrutinized subprime mortgages. He has discussed with his managers potential scenarios to use to calculate expected returns. A key assumption is such calculations is housing prices appreciation, HPA, because it drives prepayments of mortgages and losses. Fonsom is concerned with the significant appreciation experience lower the previous 5 years as a result of increased availability of funds from subprime mortgages. Fonsom insisted that the analysis should include a scenario 1 with 10% in year 1, 5% in year 2, and then the project worst case scenario 0% in year 3 through 5. The manager replies the assumptions are too dire because there are never been a time where available database when HPA is negative. Fonson conducts his research to better understand the risk inherent in these securities and evaluate these securities in the worst case scenario and unlikely but impossible environment based on the results of an enhanced scenario. Thompson does not recommend the purchase of the securitization. Against the general market trends, the manager follows Thompson's recommendation and does not invest. The following year, the housing market collapsed, and involving the subprime investments of manager portfolio outperformed the peer groups of that year. Comment: Thompson's actions is running the worst case scenario against the protest of the portfolio manager. Are in alignment with the principles of Standards I-VIII. Thompson do not allow his research to be pressured by the general trends of the markets, or the manager desires to limit the research to historical norms. See also Standard 5A, diligence and a reasonable basis. Example 6, influencing manager selection decisions. Adrian Mandel, CFA, is a senior portfolio manager for ZZYY Capital Management, who oversees a team of investment professionals who manages labor unions, pension funds. A few years ago, ZZYY sought to win a competitive asset manager search to manage a significant allocation of the pension fund of the United Donut and Pretzel Baker Union, UDPBU's investment board is charged by a recognized key decision maker for a long-term leader of the union, Ernesto Gomez. To improve ZZYY's chances of winning the competition, Mandels made significant monetary contributions to Gomez's union re-election campaign fund. After ZZYY was hired as a preliminary manager of the pension, Mandel believed that his firm's pension was not secure. Mandel continued to contribute to Gomez's re-election campaign chest, as well as his entertain lavishly the union leader and his family at top restaurants on a regular basis. All of Mandel's outlays were routinely handled by marketing expenses reimbursed by ZZYY's expenses accounts, and were disclosed to his senior management as being instrumental in maintaining a strong, close relationship with an important client. Comment: Mandel's not only offered but actually gave monetary gifts, the benefits, and other considerations that reasonably can be expected to compromise Gomez's objectivity. Therefore, Mandel's was in violation of Standards I-VIII. Example 14, influencing managing selection decisions. Adrian Mandel, CFA, had heard about the manager's search competition for the UDPBU pension fund through the brokerage/dealer contract. The contract told him that a well-known retired professional golfer, Bobby the Bear Finlay, who had become a licensed broker-dealer serving at a pension consulate, was outstretching the UDPBU manager sorts. Finley has gained celebrity status with several labor union pensions fund broadly by entertaining their respective status labor union pensions. Okay. Amy Scott is a performance analyst within her firm with responsibilities for analyzing the performance of external managers. While completing her quarterly analysis, Scott notices a change in one manager's reported composite construction. The change concealed the bad performances of a particular large account by placing the account into a new residual composite. The change allowed the manager to remain on top of the list of the manager performances. Scott knows her firm has a large allocation to this manager, and the firm's manager is a close personal friend of the CEO. She needs to deliver her final report, but is concerned with pointing out the composite changes. Comment: Scott will be in violation of Standards I-VIII if she did not disclose the changes in her final report. An analysis of managers' performance should not be influenced by personal relationships or the size of the allocations of the outside managers, but not including the change. Scott would not be providing an independent analysis for the performance metrics for her firm. Example 16, intra-firm pressure. Jill Steen is head of a performance measurement of her firm. During the last quarter, many members of her organization research department were moved because of a poor quality of their recommendations. The subpar research caused one larger account holder to experience a significant underperformance, which resulted in the client's withdrawing his money after the end of the quarter. The head of sales requesting that Stan removes this account from the firm's performance composite because the performance declines can attribute to the departed research team and not the client's advisors. Comment: pressure from other internal departments can create situations that cause a member or candidate to violate a code and standards. Steen must maintain her independence and objectivity to refuse to exclude specific accounts from the firm's performance composites to which they belong, as long as the clients invested under a strategy similar to that of the defined composite. It cannot be excluded because the poor stock selection that led to the underperformance of the asset withdrawal. So these are the two. The first the first two standards. This concludes the first part of our reading 3 of our CFA Level 1 program curriculum. I will continue because our reading 3 is a really long and really heavy chapter. It is actually the focus of CFA Level 1. So I will continue the reading in our next section. See you next time. Goodbye. Continued reading of CFA Level 1, Reading 3, Standards I-VIII, Misrepresentation. Members and candidates must not knowingly make any misrepresentations relating to investment analysis, recommendation, actions, or other professional activities, guidance. Highlight. Impact on investment practices, performance, reporting, social media, omissions, plagiarism, work complete for all employers. Trust is the foundation for the investment professions. Investors must be able to rely on the statements and information provided by them by those whom the investors have trusted their financial well-being. Investment professionals who make false or misleading statements not only harm investors but also reduce the level of investor confidence in the investment profession and threaten the integrity of capital markets as a whole. A misrepresentation in any untrue statement or omission of a fact of any statement that is otherwise false or misleading. A member or candidate must not knowingly omit or misrepresent information or give a false impression of a firm, organization, or security in a member's, candidate's, or oral presentation, advertisement, whether public or disseminated or not. The context and knowingly means that the member or candidate either knows or should have known that the misrepresentation will be made or omitted information altered for the investment decision-making process. Written materials include but are not limited to research papers, underwriting documents, company finance reports, market letters, newspaper columns, and books. Electronic communication include but are not limited to internet connection, web pages, mobile applications, and emails. Members and candidates who use web pages should regularly monitor material posted on the sites to ensure that it can be is up to current information. Members and candidates should also ensure that all reasonable precautions have been taken to protect the site's integrity and security, and that site does not misrepresent or any information that does not provide full disclosure. Standards I-VIII prohibits members and candidates from guaranteeing clients any specific returns on volatile investments. Most investments contain some element of risk and make their returns inherently unpredictable. For such investments, guarantee either a particular rate of return or guaranteeing preservation of investment capital, i.e. I can guarantee that you will earn 8% on equity this year, or I can guarantee that you will not lose money on the investment, is misleading to investors. Standards I-VIII does not prohibit members and candidates from providing clients with information on investment products that has guarantees built into the structure of the products themselves, or for which of the institutes has agreed to cover any losses. Impact on investment practice. Members and candidates must not represent any aspects of the practice, including but not limited to their qualifications or credentials, the qualifications or service provided by other firms, their performance records, and the records of their firms, and the characteristics of an investment. Any misrepresentations made by a member or candidate relating to the member's candidate's professional activities is a breach to the standard. Members and candidates should exercise care and diligence when incorporating third-party information. Misrepresentation resulting from use of credit ratings, research, testimonies, or marketing material of outside parties becomes the responsibility of investment professionals when it affects the professionals' business practices. Investing through outside managers continues to expand and as an acceptable method of investing in other areas of a firm's core competencies. Members and candidates must disclose their intended use of external managers and must not represent those managers' investment practices as their own. Although the level of involvement of outside managers may change over time, appropriate disclosures by members and candidates are important to avoiding misrepresentation, especially in the primary actions to invest directly with a staged external manager. Standards VB or 5B, communication with clients and prospective clients, discuss in further detail communicating with a firm's investment practices. Performance reporting. The performance benchmark selection process is in another area where misrepresentation may occur. Members and candidates may represent the success of their performance records through presenting benchmarks that are not comparable to their strategies. Furthermore, clients can be misled by the benchmark's results and not reported on the basis comparable to that of the fund's or client's result. Best practices is selecting the most appropriate available benchmark from a universe of available options. The transparent presentation of appropriate performance benchmarks is an important aspect in providing clients with information that is useful in making investment decisions. However, Standards I-VIII does not require that benchmarks always to be provided in order to comply. Some investment strategies may not lend themselves to display an appropriate benchmark before the complexity or diversity of the investment included. Furthermore, some investment strategies may use reference indexes that do not reflect the opportunity set of the invested assets. For example, a hedge fund comparing its performance with a cash plus basis. When such a benchmark is used, members and candidates should make reasonable efforts to ensure that the disclosure is the reason behind the use of reference indexes to avoid misrepresentation of their performances. Members and candidates should discuss with clients on a continuous basis to appropriate benchmarks to use for performance evaluation and related fee calculations. Reporting misrepresentation may also occur when violations for liquid or non-traded securities are available for more than one source. When different opinions are available, members and candidates may be tempted to switch providers to obtain higher security valuations. The process of shopping for value may represent a security's worth, leading misinformation. Will improve the perception of the value process of liquid securities. Clients will likely have additional confidence in that they were able to make an informed decision about continuing to hold securities on their platform. Social media. The advancement of online discussion forums and communication platforms commonly referred to as social media is placed additional responsibilities on members and candidates when communicating through social media. Members and candidates should provide only the same information as allowed and distributed to clients and potential clients through other traditional forms of communication. The online or interactive aspects of social media do not remove the need to be open and honest about information being distributed, along with understanding the following existing and new developing rules of regulation regarding the allowed use of social media. Members and candidates should also ensure that all communication in a format adheres to the requirements of the code and standards. That perceived anonymity grant through the platform may entice individuals to misrepresent their qualifications or abilities to have or those their employers. Actions undertaken through social media that knowingly misrepresents investment recommendations or professional activities and considered a violation of Standard I-VIII or I-VIII. Omissions. The omission of a fact or outcome can be misleading, especially given the growing use of methods of technical analysis processes. Many members and candidates rely on such models and processes to scan for new investment opportunities, develop investment vehicles, and to produce investment recommendations. The ratings when input and knowledge omitted, the resulting outcome may provide misleading information to those who rely on it for making investment decisions. Additionally, the outcomes from models shall not be presented as fact because they represent the expected results based on the input and analysis process incorporated. Omissions in the performance measurement An attribution process can also misrepresent a manager's performance, and skilled members and candidates should encourage their firms to develop strict policies for composite development to prevent cherry-picking situations in which selected accounts are presented as representative of a firm's ability. The omissions of any account appropriate for the defined composite may misrepresent to clients the success of managers' implementation and its strategies. Plagiarism, Section IC, also prohibits plagiarism and preparation of materials for distribution to employers, associates, clients, prospects, and general public. Plagiarism is defined as copying or using in substantially the same form of material prepared by others without acknowledging the source of material or identifying the author and publisher of such material. Members and candidates must not copy or represent their own original ideas or materials without permission, and must acknowledge and identify the source of the idea or material that is not their own. The investment profession use myriad of financial, economic, and statistical data in the investment decision-making process through various publications and presentations. The investment professional is constantly exposed to work of others, and the temptation to use that work without proper acknowledgement. Misrepresentation through plagiarism in investment management can take various forms. The simplest and most flagrant example is to take a research report or study done by another firm or person, change the name, and release the material as one's own original analysis. The action is clear violation of Standards I-VIII. Other practices including using expert from articles or report prepared by others, either verbatim or with only slight change in word without acknowledgement. 2, citing specific quotations and attributes as leading analyst and investment expert without naming the specific references. 3, presenting statistical estimates of forecasts prepared by others and identifying the source but not including the qualifying statements or caveats that may have been used. 4, using charts and graphs without stating their sources. And 5, copying proprietary computerized spreadsheets or algorithm without seeking the corporation or authorization of the creator. In the case of distributing third-party outsourced research, members and candidates may use and distribute such reports as long as they do not represent themselves as the report's authors. Indeed, the members or candidates may add value for the clients by shifting through research and RAM packages. In such cases, clients should be fully informed that they are paying for the ability for a member or candidate to find the best research from a wide variety of sources. Members and candidates must not represent their ability, the extent of their expertise, or the extent of their work in a way that would mislead their clients or prospective clients. Members and candidates should disclose whether the information being presented to clients comes from another source from either within or outside the members or candidates' firms. This allows clients to understand who has the expertise behind the report or whether the work is being done by an analyst, other members of the firm, or an outside party. Standards IC also applies to plagiarism or in oral communication, such as through group meetings, visits with associates. One of the most grievous practices and violations of standards is the preparation of research report based on multiple sources of information without acknowledging the sources. Examples of information from such sources include ideas, statistical compilations, and forecasts combined to give the appearance of original work. Although there is no monopoly on ideas, members and candidates must give credit where it is clearly due. Analysts should not use undocumented forecast earnings, projections, asset values, and so on. Sources may be revealed to bring the responsibility directly back to the author of the report or the firms involved. Work completed for employers The preceding paragraphs address actions that would constitute a violation of Standards I-VIII in some situations. However, members and candidates must use research conduct or models developed by others within the same firm without committing violation. The most common example relates to situations in which one or more of the original analysts is no longer with the firm. Research and models developed while employed by the firm are property of the firm. The firm retains the right to continue using the work completed after a member or candidate has left the organization. The firm may issue future reports without providing attributions to the prior analyst. A member or candidate cannot, however, reuse a previously related report solely under his or her name. Recommended procedures for compliance. Factual presentations. Members and candidates can prevent unintentional misrepresentation to the qualifications of the service they or their firm provides, and each member and candidate understands the limits of the firm's or individual's capacities and the need to be accurate and complete in presentation. Firms can provide guidance for employees who make written or oral presentations to clients or potential clients by providing a written list of the firm's available services and descriptions of the firm's qualifications. The list should suggest ways of describing the firm's services, qualifications, and compensation that are both accurate and suitable for clients or consumer presentation. Firms can also help prevent misrepresentation by specifically designating which employees are authorized to speak on behalf of the firm, regardless of whether the firm provides guidance. Members and candidates should make certain that they understand the services of the firm and its qualifications. Qualification summary. In addition to ensuring accurate representation to clients, each member and candidate should prepare a summary of his or her qualification, the experience, and a little of the service of the members or candidates is compatible of performing. Firms can assist members and candidates compliance or periodically reviewing employee correspondence and documents that contain representation of individual or firm qualifications. Verify outside information. When providing information to clients from third-party members and candidates share a responsibility for the accuracy of marketing and distribution materials that pertain to the third party's capacities, services, and products. Misrepresentation by third parties can damage the members or candidates' reputation, the reputation of the firm, and the integrity of the capital market. Members and candidates should encourage their employees to develop procedures for varying information of third-party firms. Maintain web page. Members and candidates who publish a web page should regularly monitor materials posted on the site to ensure that the site contains current information. Members and candidates should also ensure that all reasonable precautions have been taken to protect the site's integrity, confidentiality, and security, and that the site does not misrepresent any information and provides full disclosure. Plagiarism policy. To avoid plagiarism in preparing research reports or conducting analysis, members and candidates should take the following tips. 1. Maintain copies. Keep copies of all research reports, articles containing research ideas, materials with new statistical methodologies, and other materials that were relied on the preparing of the research project. 2. Attribute question. Attribute to the source any direct quotations, including tables, projections, and statistics, models, projects, ideas, and new methodologies prepared by persons or other recognized financial and statistical reporting services or similar sources. Thirdly, attribute summaries, attributes of their source, any paraphrase of summaries of material prepared by others, for example, to support an analyst of Brown Company's competitive position. The author of a research report on Brown might summarize author's analysis report on Brown's chief competitor but the author of the Brown Report must acknowledge in his own report the reliance on the analysis on the others' analysis report. Applications of standards. Example 1, disclosure of issuer paid research. Anthony McGuire is an issuer paid analyst hired by publicly traded companies to electronically promote their stock. McGuire creates a website that promotes his research efforts in a seemingly independent analyst. McGuire posts a profile on a strong buy recommendation for each company on the website, including that the stock is expected to increase in value. He does not disclose the contractual relationship with the companies he covers on the website. In the research report he issues or in the statement he makes about the companies in interest chat rooms. Comment: McGuire has violated Standards I-VIII because the website is misleading to potential investors. Even if recommendations are valid and supported with thorough research, his omission regarding the true relationship between himself and his companies, his covers constitutes a misrepresentation. McGuire has also violated Standards I-VIII, disclosure of conflicts, but not disclosing the existence of an arrangement with the companies through which he receives compensation in exchange for his service. Example 2, correction of unintentional errors. Yi-Jian Yao is responsible for the creation and distribution of the marketing material for his firm, which claim compliance with GIP standards. Yao creates the distribute of presentation of performance by the firm's by the firm's Asian equity composite stats. The composite has 350 billion yuan in assets. In fact, the composite has only 35 billion in assets, and the higher figure on the presentation is a result of a typographical error. Nevertheless, the erroneous material is distributed on a number of clients before Yao catches the mistake. Comment: once the error is discovered, Yao must take steps to create distributions of the incorrect material and errors informing them those who have received the erroneous information, because Yao did not knowingly make this misrepresentation. However, he did not violate Standards I-VIII because the firm claims compliance with GIP standards. It must also comply with GIP standard statements of error correction in relationship to the error. Example 3, non-correction of known errors. Sayyid Muhammad is the president of an investment management firm. The promotional material of the firm created by the firm's marketing department incredibly claims that Muhammad has the advanced advantage in finance from a prestigious business school. In addition to the CFA designation, although Muhammad attended the school for a short period of time, he did not receive a degree. Over the years, Muhammad and others in the firm had distributed this material to numerous prospective clients and constituents. Comment: even though Muhammad may not have been directly responsible for the misrepresentation of his credentials in the firm's promotional material, he used the material numerous times after an extended period, as should have known of the misrepresentation. Thus, Muhammad has violated Standards I-VIII. Example 4, plagiarism. Cindy Grant, a research analyst at a Canadian brokerage firm, has specialized in the Canadian minting industry for the past 10 years. She recently read an extensive research report on Jefferson Mining Limited by Jeremy Barton, another analyst. Barton provided extensive statistics on the mining reserves, production capacity, selling rates, and marketing factors affecting Jefferson's operation. He has also noted the initial drilling results on a new body of ore, which has not been made public, might show the existence of mining zones that can increase the life of Jefferson's main mines. But Branton cited no specific data on the initial drilling results. Grant called an officer of Jefferson who gave her the initial drilling results over the telephone. The data indicated that the expected life of the main wines may be tripled. Grant added these statistics to Barton report and circulated within her firm as her own report. Grant plagiarized Brayton's work by replacing large parts of his own work without acknowledgement. Example 5, misrepresentation of information. When Wiki Marks sells mortgage-backed derivatives called investment-only ships OIS, the public pension plan clients, she described them as guaranteed by the U.S. government. Purchasers of the IOA are entitled only to the interest streams generated by the mortgages, however, not the notional principal itself. One particular municipality's investment policies and low law requirements that securities purchased by its public pension plan by guaranteed by U.S. government, although the underlying mortgages are guaranteed. Neither the investor's investment nor the interest streams of the IOAs is guaranteed. IOS is guaranteed. When interest rates decline, causing an increase in prepayment of mortgages, interest payments of the IOS's investors decline, and those investors lose a portion of their investment. Make violated Standards I-VIII by misrepresenting the terms and characteristics of the investment. Example 6, potential information representation. Kalak Abdarabo manages the investment of several high net worth individuals in the United States who are approaching retirement. Abdarabo advises these individuals that take a portion of the investment and move quantity to the back to sponsor certificates of deposit and money market accounts so that the principals will be guaranteed up to a certain amount. The interest is not guaranteed. Comment: although there is risk that the institution offering the qualifications of deposit and money market accounts could bankrupt in the United States, these accounts are issued by U.S. government through the Federal Reserve Institute. Corporations, therefore, using the term guarantee in this context is not appropriate as long as the amount is within the government-issued limit. Operator should explain these facts to the clients. Example 7, plagiarism. Stephen Swanson is a senior analyst at the investment research department of Ballard and Company. Apex Corporation has asked Ballard to assist in acquiring the major ownership of a stock in the Chartered Company, a financial consulting firm, and to prepare to report commending the stockholders of Camp Brown agreed to the acquisition. Another investment firm, Davis and Company, had already prepared to report for Apex, analyzing both Apex and of Camp Brown and recommending an exchange ratio. Apex has given the Davis report to Ballard officials, who have passed it on to Swanson. Swanson reviewed the Davis report and other available material on Apex and Brown. From his analysis, he concluded that the common stock of Brown and Apex represents a good value in the current price. He believes, however, that the Dennis report does not consider all the factors a Brown stockholder would need to know to make a decision. Swanson reports his his conclusion in the partner in change, who tells him to use the Davis report, change a few words, sign your name, and get it out. Comment: if Swanson does a request, he will violate Standards I-VIII. He could refer to those portions of the Davis report that he agrees with. He identifies Davis as a source. He could then add his own analysis and conclusions to and repeat before signing and distributing it. Example 8, plagiarism. Include Browning and quantitative analysis in Double Alpha Incorporated returns from a seminar and great excitement at the seminar. Jack Jorley, a well-known quantitative analysis at the national brokerage firm, discussed one of his new models in great detail, and Brown is intrigued by the new concepts. He proceeds to test the model, making some minor mechanical changes, but retaining the concepts until he produces something very positive results. Browning quickly announces to his superiors at Double Alpha that he has discovered a new model, that the clients and prospective clients should be informed of this positive finding as ongoing proof of Double Alpha's consulting innovation and ability to add value. Comment: although Browning tested Jorley's model on his own and even slightly modified it, he must still acknowledge the original source of the idea. Browning can certainly take credit from the final practical results. He can also support his conclusions with his own test. The credit for the innovative thinker, however, must be awarded to Jorley. Example 9, plagiarism. Ferrando Zubia would like to include in his firm's marketing material some plain language's description of various concepts such as price to earnings, PE, multiple, and why standard deviation is used to measure the risk, the depreciation from how other sources, but Zubia wished to use the waterfall to use them without reference to the original offers, would use the material by a violation of Standards I-VIII. Copying verbatim any material without acknowledgement, including plain language description of PE multiple and standards deviation, violates Standards I-VIII. Even though these concepts are general, best practice would be for Zubia to describe them in his own words or cite the sources for which the descriptions are quoted. Members and candidates would be violating Standards I-VIII if they either were responsible for creating marketing material without attribution or knowingly used plagiarized material. Example 10, plagiarism through a mainstream media outlet. Erica Snortsneder learned about a study that she would like to cite in her research. Should she cite both the mainstream intermediary source as well as the author of the study itself when using the information? Comment: in all instances, a member or candidate must cite the actual source of the information. Best practice for Snortsneder would be to obtain the information directly from the author and review it before citing it in a report. In that case, Snortsneder would not need to report how she finds out the information. For example, suppose Snortsneder reads in the Financial Times about a study by the CFA Institute. Best practice for Snortsneder will be able to obtain a copy of the study of the CFA Institute, review it, and and then cite it in her report. If she does not use any interpretation of the report from the Financial Times, a newspaper does not add value to the report itself. The newspaper is merely a conduit of the original information and does not need to be cited. If she does not obtain the report and review the information, Standards neither runs the risk of relying on second-hand information that may misstates facts. If, for example, the Financial Times erroneously reports some information from the CFA Institute study and Standards neither copy the erroneous information without acknowledging CFA Institute, she can be object to complaints. Best practices would be either to obtain the complete study of an original offer and cite only the offer, or use the information provided by the intermediary and cite both sources. Example 11, misrepresentation of information. Paul Ostrotsky runs a 2-person investment management firm. Ostrotsky's firm subscribes to a service from a large investment research firm that provides research reports that can be repackaged by smaller firms for those firms' clients. Ostrotsky's firms distributes those reports to clients as its own work. Comment: Ostrotsky can rely on third-party researchers that has a reasonable and adequate basis, but cannot imply that he is the author of such research. If he does, Ostrotsky is misrepresenting the extent of his work in the way that misleads the firm's clients and prospective clients. Example 12, misrepresentation of information. Tom Stafford is a part of a team within Appleton Investment Management responsible for managing a pool of assets for Open Air Bank, which distributes structured securities of offshore clients. He became aware of Open Air promoting the structured securities as much less risky investments than investment manager policies followed by him and the team of manage the original pool of assets. Also, Open Air quality of an investment. Stafford communicates his concerns to his supervisors, who respond to Open Air, who owns the products, responsible for making all marketing and distribution. Stafford's supervisors goes on to say that the products is outside of the U.S. regulatory regime, and Appleton follows all risks of the products are disclosed at the bottom page 184 of the prospectus. As a member of the investment team, Stafford is qualified to recognize the degree of accuracy of the material that characterized the portfolio, and he is correct to be worried about Appleton's responsibility for a misrepresentation of the risk. Thus, he should continue to pursue the issue of Open Air's inaccurate promotions of the portfolio according to the firm's policies and procedures. The code and standards stress protecting the reputation of the firm and the sustainability and integrity of the capital market. Misrepresenting the quality and risk associated with an investment pool may lead to negative consequences for others well beyond the direct investors. Example 13, avoiding misrepresentation. Trina Smith is a fixed income portfolio manager in a pension fund. She has observed that the market for highly structured mortgages is the focus of salespeople she met, and these products represent a significant number of trading opportunities. In discussion about the topics with her team, Smith learned that calculating yield on changing cash flow within the deal structure requires very specialized vendor softwares. After more research, they found out that each deal is unique and that deals can have more than a dozen layers of changing cash flow priorities. Smith comes to the conclusion that because of the complexity of these securities, the team cannot effectively distinguish between potentially good and bad investment options. To avoid misrepresenting their understanding, the team decides that the highly structured mortgages segment of the securitized market should not become part of the core of the fund's portfolio. They will allow some of the less complex securities to be part of the core. Carmen Smith is in compliance with Standards I-VIII, but not investing in securities that she and her team cannot effectively understand because she is not able to describe the risk and return profit profile of the securities to the pension fund beneficiaries and trustees. She appropriately limits the fund's exposure to this sector. Example 14, misrepresenting composite constructions. Robert Palmer is head of performance for a fund manager. When asked to provide performance numbers to fund rating agencies, he avoids mentioning that the fund manager is quite liberal. In composite construction, the reason accounts are excluded is not fully explained. The performance values reported to the rating agency for the composite, although accurate for the accounts shown each period, may not present a true representation of a fund manager's ability. Comment: cherry-picking accounts to incline in either published reports or information provides to rating agencies conflicts with Standard I-VIII, moving accounts into or out of composites to influence their own overall performance results. Material misrepresents a report value over time. Palmer should work with his firm to strengthen its reporting practices concerning composite construction to avoid misrepresenting the firm's track record on the quality of the information being provided. Example 15, presenting out-of-date information. David Finch is a sales director at a commercial bank where he directs the bank's clients' adversaries in the sale of third-party mutual funds. Each quarter, he holds a division-wide training session where he provides fact sheets on investment funds, and the bank is allowed to offer to clients these fact sheets, which can be redistributed to potential clients and created by the fund firms and contains information about the funds, including investment strategies and target distribution rate. Finch knows that some of the fact sheets are out of date. For example, one long fund approved the use of significant leverage last quarter as a method to enhance returns. He continues to provide the sheets on the sales team without under updates because the banks has no control over the market's material released by the mutual fund firm. Comment: Finch is violating Standards I-VIII by providing information that misrepresents aspects of the fund but not providing the sales team and ultimately the clients with the updated information, and his misrepresenting the potential risk associated with the fund and outdated fact sheets. Finch can instruct the sales team to clarify that the deficiencies in the fact sheet with clients and ensure they have the most recent fund prospectus documents before accepting orders and investments in any form. Example 16, overemphasis on firm's results. Bob Anderson, a chief compliance officer in Optima Asset Management Company, a firm currently offering 8 funds to clients. 7 of the 8 have 10-year returns below a medium of the respective sectors. Anderson approves a recent advertisement which includes the statement: Optima Asset Management is achieving excellent returns for its investors. The Optima Emerging Market Equity Fund, for example, has 10-year returns that exceed the sector median by more than 10%. From the information provided, it is difficult to determine whether a violation has occurred as long as the sector outperformance is correct. Anderson may be attempting to mislead potential clients by citing the performance of a sole fund that achieves such a result. Past performances is often used to determine a firm's skills and abilities in comparison to funds in the same sectors. However, all the funds outperformed their respective benchmarks However, if all the firms outperform all the benchmarks, then Anderson's assertion that a company is achieving excellent returns may be factual. Funds may exhibit positive returns for investors, exceed benchmarks, and yet be return below under the median of their sectors. Members and candidates need to ensure that their marketing efforts do not include statements that misrepresent their skills and abilities to remain compliant with standards. 1C, unless the return of a singular fund reflects the performance of a firm as a whole. The use of singular funds for performance comparisons should be avoided. So this is standard 1C of reading 3 in the level 1 CFA program. I will continue the reading in our next section. Continued reading of the CFA level 1 program curriculum. Reading 3. Standard 1D, misconduct. Members and candidates must not engage in any professional conduct involving dishonesty, fraud, or deceit, or commit any acts that reflects adversely on the professional reputation, integrity, and competence. Guidance, whereas Standards 1A addresses the obligations of members and candidates to comply with applicable laws that governs their professional activities. Standards 1D addresses all conduct that reflects poorly on the professional integrity, good reputation, or competence of the members and candidates. Any acts that involves lying, cheating, stealing, or other dishonest conduct is in violation of the standards. If offense reflects adversely on the members or candidates' professional activity, although CFA Institute discourages any sort of unethical behavior by members and candidates, the code and standards are primarily aimed at conduct that actions related to members and candidates' professional life. Conduct that damages trustworthiness or competence may include behavior that, although not illegal, nevertheless negatively affects a member's or candidate's ability to perform his or her responsibility. For example, using alcohol during business hours might constitute a violation of the standards because it could have the detrimental effect on a member or candidate's ability to fulfill his or her professional responsibilities. Personal bankruptcy may not reflect on the integrity of the trustworthiness of a person declaring on bankruptcy, but if circumstances of bankruptcy involves fraudulent or deceitful business conduct, bankruptcy may violate the standard. In some cases, the absence of appropriate conduct or lack of sufficient effort may be violation of Standards 1D. The integrity of the investment profession is built on trust. Member or candidate, whether an investment banker relating to research analyst or portfolio manager, is expected to conduct the necessary due diligence and properly understanding the nature or risk of investment before making investment recommendations, but not taking these steps and instead relying on someone else's process to perform them. Members and candidates may violate the trust of their clients have placed on them. The loss of trust may have a significant impact on the reputation of the member or candidates and the operations of the firm's market as a whole. Individuals may attempt to abuse the CFA Institute program professional conduct program by actively seeking CFA Institute enforcement of the code and standards, and Standards 1D in particular. As a member of setting personal, political, or other disputes relating to professional ethics, CFA Institute is aware of the issues and appropriate disciplinary procedures and enforcement mechanisms are in place to address misuse of code and standards and professional conduct programs in this way. Recommendations, procedures for compliance, in addition to ensuring that their own behavior is consistent with Standards 1D to prevent general misconduct. Members and candidates should encourage their firms to adopt following policies and procedures to support the policies of supporting 1D Code of Ethics. 1 Code of Ethics. Develop and or adopt the code of ethics to which employees must subscribe, and make it clear that any personal behavior that reflects poorly on the individual involved, the institution as a whole, or the investment industry will not be tolerated. 2 List of violations. Disseminate to all employees a list of potential violations and associated disciplinary sanctions up to inclining dismissal from the firm. 3 Employee references. Checked references of potential employees to ensure that they are good character and not ineligible to work in the investment industry because of past infractions of the law. Application of standards. Example 1, professionalism and competence. Assignment serviceman is a trust investment officer in the bank of a small affluent town. Enjoy lunching every day with friends at a country club where his clients have observed him having numerous drinks. Back at work after lunch, he clearly is intoxicated while making investment decisions. His colleagues make a point of handling any businesses with Sasserman in the morning because They distrust his judgment after lunch. Common misstatements, excessive drinking at lunch, and subsequent intoxication at work constitutes a violation of Standards I-D because this conduct has raised questions about the professionalism and competence. His behavior reflects poorly on him, his employers, and the investment industry. Example 2, fraud and deceit. Howard Hoffman, a security analyst at ATZ Brothers Incorporated, a large brokerage house, submits reimbursements for over a 2-year period to ATZ's self-funded health insurance program for more than 24 bills, most of which have been altered to increase the amount due. The investigation by firm's directors of employee benefits uncovers the inappropriate conduct. ATZ subsequently terminates Hoffman's employment and notifies the CFA Institute. Comment: Hoffman violates Standards I-D because he engages in internal conduct involved fraudulent and deceitful actions in the workplace that adversely reflects on his integrity. Example 3, fraud and deceit. Jody Brinks, an analyst covering the automotive industry, volunteers much of her spare time to local charities. The board of one of the charitable institutions decides to buy 5 new vans to deliver hot lunches to low-income elderly people. Brinks offers to donate her time to handle purchasing agreements, to pay a long-standing debt to a friend who operates an automotive dealership, and to compensate herself and for her troubles, she agrees to a 20% higher than normal and split and the surcharges with her friend. The director of the charity ultimately discovers the scheme and tells the Brinks that her services, donated or otherwise, is no longer required. Comment: Brinks engaged in conduct involving dishonesty, fraud, and misrepresentation and has violated Standards I-D. Example 4, personal actions and integrity. Carmen Garcia manages a mutual fund dedicated to socially responsible investing. She is also an environmental activist. As a result, she participates in nonviolent protests. Garcia has been arrested on numerous occasions for trespassing on the property of large petrochemist plants that is accused of damaging the environment. Comment: Generally, Standards I-D is not meant to cover illegal transgressions resulting from act of civil disobedience in support of personal beliefs, because such conduct does not reflect poorly on the members or candidate's professional reputation, integrity, or competence. Example 5, professional misconduct. Meredith Rasmussen works in a buy-side trading desk for an investment management firm and concentrates on in-house trades for a hedge fund subsidiary managed by a team of investment management firms. The hedge fund has been very successful and is marketed globally by the firm. For her experience as a trader for much of her activities in the firm, Rasmussen has been quite knowledgeable about the hedge fund's strategies, tactics, and performances. Well, a distinct break in the market occurs and many of the securities involved in a hedge fund's strategy declines markedly in value. Rasmussen observed that the reported performance of a hedge fund does not reflect this decline. In her experience, the lack of effect is a very unlikely occurrence. She approaches the head of trading about her concerns and is told that she should not ask any further questions, that the fund is big and successful and is not of her concern. She is fairly sure something is not right, and she contacts the compliance officer, who also tells her stay away from the issue of the hedge fund's reporting. Rasmussen has clearly come across an era of policies, procedures, and compliance practices within the firm's operations. According to the firm's procedures for reporting potentially unethical activity, she should pursue the issue by gathering some proof of her reason for doubt. Should all internal communications with the firm not satisfy her, Rasmussen should consider reporting to potential unethical activity to the appropriate regulatory. See also Standards IV-A for guidance and whistleblowing, and Standards IV-C for duties of a supervisor. Standard 2, integrity of the capital market. Standard 2A, material non-public information. Members and candidates who possess material non-public information that can affect the value of an investment must not act or cause others to act on the information. Guidance. Highlight. 1. What is material information? 2. What constitutes non-public information? 3. Mosaic theory. 4. Social media. 5. Using industry experts. 6. Investment research reports. Trading or inducing others to trade on material non-public information erodes confidence in capital markets, institutions, and investment professionals. By supporting the idea of those who inside information and special access can take unfair advantages of a general investing public. Although trading on insider information may lead to short-term profits, in the long run, individuals and the profession as a whole suffers from such a trading. These actions have caused and will continue to cause investors to avoid capital markets because the market are perceived to be rigged in favor of the knowledgeable insider. When an investing public avoids capital markets, the markets of and capital allocation becomes less efficient and less supportive of strong and vibrant economies. Standards 2A promotes and maintains a high level of confidence in the market integrity, which is one of the foundations of investing professions. The prohibition of using information goes beyond and the direct buying and selling of individual securities or bonds. Members and candidates must not use material non-public information to influence their investments or actions related to derivatives, e.g. swaps or option contracts, mutual funds, or other alternative investments. Any trading based on material non-public information constitutes a violation of Standards 2A. The expansion of financial products and the increasingly interconnectivity of financial markets globally have resulted in new potential opportunities for trading on material non-public information. What is material information? Information is material if its disclosure will probably have an impact on the prices of securities or other or if reasonable investors will want to know the information before making an investment decision. In other words, information is material if it will significantly alter the total mix of information currently available about a security in such a way that the price of a security will be affected. The specificity of the information and the extent of its difference from public information, its nature, and its reliability are key factors in determining whether a particular piece of information fits the definition of material. For example, material information may include but is not limited to information on the following: 1. Earnings. 2. Mergers, acquisitions, trading offers, or joint ventures. 3. Changes in assets or asset quantities. 4. Incentive products, processes, or discoveries, e.g. new products, trails, or research efforts. 5. New licenses, patents, registered trademarks, or regulatory approvals /rejections of products. 6. Development regarding customer or suppliers, e.g. the acquisition or loss of contracts. 7. Change in management. 8. Change in offer, auditor notification, or facts that the issuer may no longer rely on the offers report or qualification opinion. 8. Events regarding the issuance of securities, e.g. default on senior securities, cause of securities of redemption, purchasing plans, stock splits, change in the dividends, change in the right of security holdings, and the public-private sales of additional securities. 9. Bankruptcies. 10. Significant legal disputes. 11. Government reports of economic trades, employment, housing starts, currency information, etc. 11. Order for large trades before they are executed. And lastly, now new or changing equity or debt ratings issued by third parties, e.g. sell-side recommendations and credit ratings. In addition to the substance and specificity of the information, the source or relative reliability of the information also determines materiality. The less reliable a source, the less likely information provided will be considered material. For example, factual information from corporate insider regarding a significant new contract for a company is likely to be material, whereas assumption based on speculation by competitors about the same contract is likely to be less reliable and therefore not material. Additionally, information about trials and new drugs, products, or services developed under development from qualified personnel involved in the trials is likely to be material, whereas educated conjectures by subject experts not connected to the trials are unlikely to be material. Also, the more ambiguous the effect of the information on price, the less material that information is considered. If it is unclear whether and to what extent the information will be affecting the price of the security, the information may not be considered material. The passage of time may also render information that was once important immaterial. What constitutes non-public information? Information is non-public until it has been disseminated or available to the market in general, as opposed to a selected group of investors. Disseminated can be defined as made known. For example, a company report or profit that is posted on the internet and distributed widely through a press release, or accompanied by feelings, has been effectively disseminated in the marketplace. Members and candidates must have the reasonable expectations that people have received the information before it could be considered public. It is not necessarily, however, to wait for the slowest method of delivery. Once the information is disseminated to the market, it is public information and is no longer covered by the standard. Members and candidates must be particularly aware of information that is selectively disclosed by corporations to a small group of investors, analysts, or other market participants. Information that is made available to analysts maintains non-public until it is made available to investors in general. Corporations that disclose information on a limit basis creates the potential for insider trading violations. Issues of such disclosures often arise when a corporate insider provides material information to analysts in a briefing or conference call before the information is released to the public. Analysts must be aware that a disclosure made to a room full of analysts does not necessarily make the disclosed information public. Analysts should be alert to the possibility that they are selectively receiving material non-public information when a company provides them with guidance or interpretation of such publicly available information as financial statements or regulatory filings. A member or candidate may use insider information provided legal legitimacy by the source company for the specific purpose of conducting due diligence according to the business agreements between the parties. For such activities as mergers, loan underwriting, credit rating, or offering engagement. In such instances, the investment professional would not be considered in violation of Standards II-A by using the material information. However, the use of insider information provided by the source company for other purposes, especially to trade or entice others to trade the securities of the firm, conflicts with the standard. Mosaic theory. A financial analyst gathers and interprets large quantities of information from many sources. The analyst may use significant conclusions derived from analysis of public and non-material, non-public information as the basis of investment recommendations and decisions, even if those conclusions would have been material inside information. As they have been communicating directly to the analysts of a company under the mosaic theory, financial analysts are free to act on the connection or mosaic of information without risking violation. The practice of a financial analyst depends on the free flow of information for the fair and efficient operation of the capital market. Analysts and investors must have the greatest amount of information possible to facilitate making well-informed investment decisions about how to and where to invest capital, accelerate time and intelligible communication is essential if analysts and investors are to obtain the data needed to make informed decisions about how and where to invest capital. These disclosures must go beyond the information mandated by the reporting requirements of the security laws and should include specific business information about items used to guide a company's future growth, such as new products, capital projects, and the competitive environment. Analysts seeks and use information such to compare and contrast investment alternatives. Much of the information used by analysts comes directly from companies. Analysts often receive such information through contracts with corporate insiders, especially investor-related staff and financial officers. Information may be disseminated in the form of press releases, through oral presentation by company executives in analyst meetings or conference calls, or during analyst visits to company premises, and seeking to develop a more accurate and complete picture of a company. Analysts should also reach beyond contracts with companies themselves and collect information from other sources, such as customers, contractors, suppliers, and companies' competitors. Analysts are in the business of formulating opinion and insights that are not obvious to the general investing public about the attractiveness of particular securities. In the course of their work, analysts actively seek out corporate information not generally known to the market for the express purpose of analyzing the information expected to trade on the basis of recommendation. Analysts initiatives and discover and analyze information and communicate their funding to their clients, significantly enhance market efficiency, thus benefiting all investors. See Dirk versus Securities and Exchange Commissions. According to violation of Standards II-A will not result when a prospective analyst reach a conclusion about a corporate action or event through the analysis of public information, the item of non-material non-public information. Investment professionals should note, however, that although analysts are free to use mosaic theory information in their research reports, they should save and document their research. See Standards 5C, record retention, evidence, and evidence of their analyst knowledge of public non-material, non-public information about a corporation's strengths, and assertions that the analyst reach his or her conclusions solely on appropriate methods rather than through the use of material non-public information. Social media. The continued advancement of technology allows members and candidates and the industry at large to exchange information at rates not previously available. This is important for investment professionals to understand the implications of using information from the internet and social media platforms, because all such information may not actually be considered public. Some social media platforms require memberships in specific groups in order to access the published contents. Members and candidates participating in groups with membership limitations should verify that material information obtained from these sources can also be accessed from sources that would be considered available for the public, e.g. company filings, web pages, and press releases. Members and candidates may use social media platforms to communicate with clients or investors without conflicting with the standards, as long as the information research our clients is open to the investing public, as they use the platform would be comparable with other traditional forms of communication, such as emails and press releases. Members and candidates are required by Standards I-VIII should also complete all appropriate regulatory filings relating to information distributed through social media platforms. Using industry experts, the increased demand for insights of understanding the complexities of some industries have led to an expansion of engagement with outside experts. As the level of engagement increased, new businesses formed to connect analysts and investors with individuals who have specialized knowledge in their industry, e.g. technology or pharmaceuticals. These networks offer investors the opportunity to reach beyond their usual business circles, to speak with experts regarding economic conditions, industry trends, and technical issues relating to the specific products and services. Members and candidates must provide compensation to individuals for their insights without violating the standard. However, members and candidates are ultimately responsible for ensuring that they are not requesting or acting on confidential information received from external experts, which is in violation of security regulations, the laws, or duties to others. As the recent string of insider trading cases display, some experts are willing to provide confidential or protected information for the right incentives. Firms connected Firms connecting experts with members and candidates often require both parties to sign agreements concerning disclosure of material non-public information, even with the protection from such compliance practices. If an expert provides material non-public information, members and candidates would be prohibited from taking investment actions on the associated firms until the information becomes publicly known to the market. Investment research report: when a particularly well-known or respected analyst issues a report or makes changes to his or her recommendations, the information alone may have an effect on the market and thus may be considered material. Therefore, theoretically, under Standards II-A, such a report would have to be made public at the time of it was distributed to clients. The analyst is not a company insider, however, and does not have access to insider information. Presumably, the analyst created the report from information available to the public, mosaic theory, and by using his or her expertise to interpret the information, the analyst's hard work paid by the clients guaranteed the conclusion. Simply because the public in general would find the conclusion material does not require that the analyst make his or her work public. Investors who are not clients or of the analyst could either do the work themselves or become clients of the analyst to gain access to the analyst's expertise. Recommended procedures for compliance: achieve public dissemination. If a member or candidate determines the information is material, the member or candidate should make reasonable efforts to achieve public dissemination of the information. These efforts usually entail encouraging the issuing company to make the information public. If public dissemination is not possible, the member or candidate must communicate the information only to the designated supervisory and compliance personnel within the members or candidates' firms, and must not take investment action or alter current investment recommendations on the basis of the information. Moreover, members and candidates must not knowingly engage in any conduct that may induce company insiders to privately disclose material non-public information. Adopt compliance procedures. Members and candidates should encourage their firms to adopt compliance procedures to prevent the misuse of material non-public information. Particularly important is improving compliance in such areas as reviewing of employees and proprietary trading, the review of investment recommendations, documentation of a firm's procedures, and the supervision of interdepartmental communication. In multi-service firms, compliance procedures should suit the particular characteristics of a firm, including its size and the nature of its business. Members and candidates are encouraged to inform their supervisors and compliance personnel of suspected inappropriate use of material non-public information as the basis of security trainings, activities, or recommendations being made within their firm. Adopt disclosure practices. Members and candidates should engage their firm and develop the following disclosure policies designed to ensure that information is disseminated in the marketplace in an equitable manner. For example, analysts from small firms should receive the same information and attraction from a company as an analyst from a large firm receives. Similarly, companies not provide certain information to buy-side analysts but not to sell-side analysts, or vice versa. Furthermore, a company should not discriminate among analysts in the provision of information or black BO particular analysts who have given negative reports on companies in the past within investments or in research firms. Members and candidates should encourage the development of and compliance with procedures for distributing new and updated investment options to clients. Recommendations of its nature may represent material market moving information that needs to be communicated to all clients fairly. Issue press releases. Companies should consider issuing press release prior to analyst meetings and conference calls to scripting those meetings and calls to decrease the chance that further information will be disclosed. If material non-public information is disclosed for the first time in an analyst meeting or call, the company should promptly issue a press release or otherwise make the information publicly available. Firewall elements. An investment barrier, commonly referred to as a firewall, is most widely used is the most widely used approach for preventing the communication of material non-public information within firms. It restricts the flow of confidential information of those who need to know the information to perform their jobs efficiently. The minimal element for such a system includes but are not limited to substantial control of relevant interdepartmental communication, preferably through a clearance area within the firm in either the compliance or legal department, review of employees trading through a maintenance of watch/restricted/rumor list, documentation of the procedures designed to limit the flow of information between departments and of the actions taken to enforce these procedures, and highlighting review of restrictions of proprietary trading while a firm is in possession of material non-public information, appropriate interdepartmental communication, although documentations required most for practical reasons take into account the difference between the activities of small firms and those of large multi-service firms of all sizes and types, benefits by improving the documentation of their internal enforcement and firewall protection. Even at small firms, procedures concerning interdepartmental communication and reviews traditional activity and the investigation of possible violations should be compiled and formalized. Physical separation of departments as a practical matter. To the great extent possible, firms should consider the physical separation of departments and files to prevent communication of sensitive information that should not be shared. For example, the investment banking and corporate finance area of a brokerage should be separated from the sales and research department of a bank's commercial lending department should be separated from the trust and research department. Prevention of personal overlap. There should be no overlap of personnel between investment banking and corporate finance areas of a brokerage firm and the sales of research department, or between a bank's commercial lending department and its trust and research department. For a firewall to be effective in the multi-service firms, an employee should be only on one side of the firewall at any time. Inside knowledge may not limit the information about a specific offering or the current financial condition of a company. Analysts may be exposed to much information about the company, including new product development or future budget projections that clearly constitutes insider knowledge, and thus precludes the analyst from returning to his or her research functions. For example, the analyst who follows a particular company may provide limited assistance to the investment bankers under carefully controlled circumstances where the firm's investment banking department is involved in a deal with a company. The analyst must then be treated as though he or she were an investment banker. The analyst must remain on the investment banking side and the wall until any information he or she learns is publicly disclosed. In short, analysts cannot use any information learned in the course of the project for research purposes and cannot share the information with colleagues in the research department. A reporting system, a primarily objective of an effective firewall procedure is to establish a reporting system in which authorized people review and approve communication between departments. If an employee behind a firewall believes that he or she needs to share confidential information with someone on the other side of the wall, the employee should consult a designated compliance officer to determine whether sharing the information is necessary and how much information should be shared. If the sharing is necessary, the compliance officer should coordinate the process of looking over the wall, end quote, so that the necessary information will be shared and the integrity of the procedure will be maintained. A senior supervisor or compliance officer should have the specific authority and responsibility of deciding whether information is material and whether it is sufficiently public to be used on the basis for investment decisions. Ideally, the supervisor or compliance officer reasonable for communicating information to a firm's research or brokerage area would not be a member of this area. Personal trading limitation. Firms should consider restrictions or prohibition of a firm's trading by employees, and should carefully monitor both proprietary trading and personal trading by employees. Firms should require employees to make periodic reports to the extent that that such reporting is not readily required by securities laws of their transactions and transactions made for the benefit of family members. Securities should be placed on a restricted list when a firm has or have material non-public information. The broad distribution of a restricted list then triggers the sort of trading the list was developed to avoid. Therefore, a watch list shown to only a few people responsible for compliance should be used to monitor transactions in specific securities. The use of a watch list in combination with the restricted list is an increasingly common means of ensuring effective control of personal trading. Record maintenance. Multi-service firms should maintain written records of communications between various departments. Firms should place a high priority on training and should consider instituting comprehensive training programs, particularly for employees in sensitive areas. Property training procedures. Concerning the restrictions or review of a firm's proprietary trading while the firm processes material non-public information will necessarily depend on the type of proprietary trading in which the firm may engage in prohibition on all types of proprietary activity. When a firm comes into possession of material non-public information is not appropriate. For example, when a firm acts as a market maker, a prohibition of proprietary trading may be counterproductive to the goal of maintaining the confidentiality of information of market liquidity. This concern is particularly important in the relationship between small regional brokers/dealers and small investors. In many situations, a firm may take a small issuer public with the understanding that the firm will continue to market maker in the stock, and such tip to outsiders firms that continues making market making activities while the possession of material non-public information should, however, instruct their market maker to remain passive with respect to the market. That is to take only the contra side of unsolicited consumer trades. The risk of bridge trading and case of a trading prohibition is more compelling than it is in the case of market making. The impotence of arbitrage traditions is neither passive nor reactive, and the potential for illegal profits is greater than the market making. The most prudent course for firms is to suspend arbitrage activities when a security is placed on the watch list. These firms that continue arbitrage activity face a high hurdle in providing the adequacy of their internal procedures for preventing traditional on material non-public information, and must demonstrate a stringent review on documentation of firm trades. Communication to employees. Members and candidates should encourage their employees to circulate written compliance policies and guidelines to all employees. Policies and guidelines should be used in conjunction with training programs aimed to enabling employees to recognize material non-public information. Such information is not always clearly identifiable, and for employees must be given sufficient training to either make an informed decision or to realize they need to consult a supervisor or compliance officer before engaging in questionable transactions. Appropriate policies reinforce that using material non-public information is illegal in many countries. Such trading activities based on material non-public information undermines the integrity of the individual and firm and the capital markets. Application of the standards. Example 1, acting on non-public information. Frank Barnes, the president and controlling shareholder of Smart Town clothing chain, decides to accept tender offers and sells the family business at a price almost double the market price of its shares. He describes his decision to his sister Smart Town's treasurer, who conveys to his daughter, who owns no stock in a family company at present, who tells her husband Staples. Staples, however, tells the stockbroker Alex Housley, who immediately buys Smart Town stocks for himself. Commented information regarding the pending sale is both material and non-public. Staples and has violated Standards II-A by communicating the insider information of his broker. Halsey also violated the standards by buying the shares on the basis of material non-public information. Example 2, controlling non-public information. Samuel Peters, an analyst at the Scotland and Pearce Incorporated, is associated with firms with a secondary offering for Bright Ideas Lamp Company. Peter participates via telephone conference calls in a meeting with Scotland and the Pearce investment banking employee of Bright Ideas CEO. Peter is advised that the company's earnings projections for the next year have significantly dropped throughout the telephone conference calls. Several Scotland and Pearce salesperson are portfolio managers walk in and walk out of Peter's office where the telephone calls is taking place. As a result, they are aware of the drop in projections earning for Bright Ideas. Before the conference calls is concluded, the salesperson trade the stock of the company on behalf of the firm's clients and other firms' personnel trading the stock in the firm's proprietary account and an employee's personal account. Comment: Peter has violated Standards II-A because he failed to prevent the treasurer to misuse material non-public information to others in his firms. Peter should have adopted information barriers to preventing the communication of non-public information between departments of the firm. The salespeople and portfolio managers who traded the information have also violated Standards II-A by trading on issued information. Example 3, selective disclosure on material information. Elizabeth Levinson is based in Taipei and covers Taiwanese markets in her firm, which is based in Singapore. She is invited together with other 10 largest service holders on a manufacturing company to meet the finance director of the company. During the meetings, the finance director states that the company expects the workforce to strike next Friday, which will cripple productivity and distribution. Can Levinson use the information as a basis to change her rating for the company from a buy to sell? Levinson first determines whether the material information is public. According to Section 2A, if a company is not made the information public, a small group forum does not qualify as a method of public dissemination. She cannot use the information. Example 4, determining materiality. Lench Fichman is trying to decide whether to hold or sell shares of an oil and gas exploration company that she owns in several of the funds she managed. Although the company was underperformed in the index and so for some time already, the trends in the industry sector signals that the company of its type might become takeover targets. While she is considering her decisions, her doctor, who casually follows the market, mentions that she thinks that the company is questioned will soon be brought out by a large multinational conglomerate, and that it would be a good idea to buy the stock right now. After talking to various investment professionals, the checking of the opinion of the company, as well as the checking industry Frachtman decides that next day to accumulate more stocks on the oil and gas exploration company. Although information on expected takeover bid may have been a type of generally material and non-public, in this case, the source of information is unreliable and information cannot be considered material. Therefore, Frachtman is not prohibited from trading the stocks of the business. Example 5, applying the mosaic theory. Jada Taja is a buy-side analyst covering the furniture industry, looking for an attractive company to recommend to buy. He analyzes several furniture markets by studying their financial reports and visiting their operations. He also talks to some designers and retailers to find out which furniture styles are trendy and popular. Although none of the companies that she analyzed are a clear buy, she discovers that one of them, Swan Furniture Company, may be in financial trouble. SFC's extravagant new design have been introduced at substantial cost. Even though these designs initially attracted attention, the public is now buying more conservative furniture from other makers. Next quarter earnings will drop sustainably. He issues a sell recommendation for SFC. Immediately after receiving the recommendation, investment managers started reducing SFC stock in their portfolio. Investment on quantity earnings data is manager and non-public. Taja arrives at the conclusion that the earning drop of the basis of public information and piece of non-material non-public information such as opinions and designer and retailer therefore are trading based on Taja's correct conclusion is not prohibited. Standards II-A. Example 6, applying the mosaic theory. Roger Clement is a senior financial analyst who specializes in European automotive industry on Roval Capital. Because he has repeatedly nominated by many leading industry magazines, the newsletters as a best analyst for the automotive industry. He is widely regarded as an authority on the sector after speaking with representatives of Target Charlotte, a European auto manufacturer who sells primarily to Spain and South Korea. And after conducting the interviews with the salespeople, labor leaders, and firms, Canadian currency analysis, the banking official Clement analyzed Tugart Chervai's traditions and incorporates its incorporation instructions strategy may well face serious opposition from the industry in general and Target's Marks segment in particular and part 4 banks could take a tighter than expectance to the opening round of credit negotiations with the company. With the reasons he changed his conclusion with the company from a market performance to a market underperformance. Clement retains the supportive material used to research outperform firms to make a comment to reach a conclusion about the value of the company. Clement has pieced together a number of non-material or public bits of information that affects the Trugott Charlottes. Therefore, under the mosaic theory, Clement could not have violated Standards II-A in drafting this report. Example 7, analysis, recommendation, and material non-public information. The next day, Clement is prepared to be interviewed on a global financial news television program where he will discuss his changes and recommendation on Turgot Charlottes for the first time in public. While preparing for the program, he mentions how the show's producers, Mary Zaito, journalist who will be interviewing him, the information we'll be discussing. Just prior to going on the air, Zaito sells her holdings in Turgot Charlotte. She also phoned her father, which with the information, because she knows that he and other family have investigations and target Charlotte. A comment: when Ziller receives advance notification of Siemens' change in opinion, she knows that it will have a material impact on the stock price, even if she is not totally aware of Clement's understanding reasoning. She is not a client of Clement, but obtains early access to the material non-public information prior to publication. Her trades, and thus based on material non-public information and violations Standards II-A. Zeals further violates the standards by relaying the information to her friend. It would not matter if he or any other family member traded. The act of providing the information violates Standards II-A. The fact that the information is provided by a family member that does not absolve someone of the prohibition of using the communication material non-public information. Example 8. Acting on non-public information, Ashton Kilgore is a retired investment professional who managed his own portfolio, his own share in National Savings, a large local bank, a close friend and its glorified buddy, James Mayfield, is senior executive at National. National has seen in stock prices drop considerably, and the news and outlook are not good. It is in a conservation about the economy and the banking industry on the golf course. Mayfield relays the information to National but National was surprised the investment community in a few days with its announces excellent earnings for the quarter. Kellogg is pleasing, surprised by the information that, and thinks that Mayfield may a sensitive action. Subsequently, National announces that it has gone operating earnings, but had set to aside federal aside reserves for anticipated significant losses in the loan on its portfolio to combine new causes and stocks to grow to 60% common, even though Kellogg believes that Mayfield would not break the laws by disclosing insider information to money was lost on the purchase. Kellogg should not have purchased additional shares of National if it is the members or candidates' responsibility to make sure for executing investment actions that common sense earnings and not material non-public information. Kellogg is in violation with Standards II-A. Example 9, Mosaic Theory. John Doe is a research analyst for a hedge fund that also sells its research to a select group of playing clients' investment funds. Doe's focus is medical technology companies and products, and he has been in the business of long enough and has been successful enough to build up a very credible network of friends and experts in the business. Doe has been working on a major research recording a medical device manufacturer. He recently ran into an old acquaintance at a wedding with a senior executive at Boyce. Doe asked about the business. Doe was down to a statement that the executive who has responsibilities in the new product areas made about the products. I would not go too excited about the medium-term prospects. We have a lot to work on first. Dahl incorporates this and other information about the new bicycle products in his long-term recommendation of Boyce. Dahl's conversation with the senior executive is part of the mosaic information used in recommending Boyce. When holding discussions with a firm's executive, Dahl would need to guard against soliciting or obtaining material non-public information before issuing the report of executive, and to be weighed against the other known public facts of determine whether it would be considered material. Standards I-VIII, monitoring the termination. Larry Nadler is a trader for a mutual fund. Gets a text message from another firm's trader who he has known for years. The message indicates a software company is going to report strong earnings when the firm publicly announces in 2 days. Nadar has a buy order for a portfolio manager within the firm to purchase several 100,000 shares of the stock. Nadal is aggressive in placing the portfolio manager's order and competence purchases by the following morning, a day ahead of the firm's planning earning announcements. Comments: there are often rumors and whispers numbers before release of any kind. The text message from the other trader would most likely be considered market noise unless Niklar had the gold had an ongoing business relationship with the public firm. If he had no reason to suspect he was receiving material non-public information that would prevent him from completing the traditional request of a portfolio manager. Example 16, using an expert network. Mary McCoy, a senior drug analyst of a mutual fund. Her firm hires a service that conducts her experts to in a treatment of cancer through various phone conversations. McCoy enhances her understanding of the lack of therapists for successful treatment. The information is critical to McCoy's making informed recommendation of the company's procedures these days. Comment: McCoy is appropriately using the experts networks to enhance her evaluation processes. She has completely used the network to enhance her evaluation process. She has neither asked nor has received information that may consider trial. McCoy is allowed to seek advice from professionals within the industry that she follows. Example 12, using an expert network. Tom Watson is a research analyst working for a hedge fund to stay information. Watson relies on inside experts to inform on such industry as technology and pharmaceuticals and new advantages occurring frequently. The meetings with this industry experts often are arranged through network and placement arrangements that have specific politics and procedures in place to deter the exchange of material non-public information. Watson arranges a call to discuss future prospects for one of the fund's existing technology company holdings, a company that was tested a new semiconductor product. The science leading to the test indicates that his disappointment with the performance and the new semiconductor. Following the call, Watson relays the insight he received to others at the fund. The fund sells the current positions in the company and buys many put options because the market is anticipated to success of the new semiconductor, with the share price reflect the market's optimism. Comment: Watson has validated Standards II-A by passing law material, non-public information. So that is standards. Those are the standards readings. I'm going to continue reading in our next part. I have broken this part into many sections. The next part I will continue reading 3 of CFA Level 1 program, which would be which I will continue from here. I'll see you guys next time. Goodbye. Alright, continued reading of CFA Level 1 program curriculum, reading 3. Standards II-B, market manipulations. Members and candidates must not engage in practices that distort prices of artificially inflating trending volume with the intent of misleading market participants. Guidance highlights information-based manipulations, transactions-based manipulations. Standards II-B requires that members and candidates uphold market integrity by prohibiting market manipulations. Market manipulations includes practices that distort security prices or trade volume with the intent of deceiving people or entities that rely on information in the market. Market manipulation damages the interests of all investors by disrupting the smooth functions of financial markets and lowering investor confidence. Market manipulation may lead to lack of trust in the fairness of the capital markets, resulting in higher risk premiums and reduced investor participation. A reduction in efficiency of the local capital markets may negatively affect the growth of economic health of a country and may also influence the operations of the globally interconnected capital markets. Although market manipulation may be less likely to occur in mature financial markets and emerging markets, cross-border investing increasingly exposes all global investors to the potential of such practices. Investing increasingly exposes all global investors to the potential for such practices. Market manipulation includes 1. The dissemination of false or misleading information, and 2. Transactions that deceive or will be likely to mislead the market participants by distorting the price-setting mechanism of financial instruments. The development of new products and technologies increasing the incentives, means, and opportunities for market manipulations. Additionally, the increasingly complexity of sophistication of technology uses the communication with market participants have created new avenues for manipulation. Information-based manipulation includes but is not limited to spreading false rumors to induce trading by others. For example, members and candidates must refrain from pumping up the price of investment by issuing misleading positive information or overlaying overly optimistic projections of securities worth only to later dump the investment, i.e. sell it once the price fueled by misleading information effects on others market participants reaches an artificially high level. A transaction-based manipulation involves instances where a member or candidate knows or should have known that his or her actions could affect the pricing of a security. This type of manipulation includes, but is not limited to, the following: 1. Transactions that artificially affect prices or volumes that gives the impression of activity or price movement in the financial instrument, which represents a diversion from the expectations of a fair and efficient market. And 2. Securing a controlling dominant position in a financial instrument to exploit and manipulate the price of a related derivative and or underlying asset. Standards II-B is not intended to preclude transactions undertaken on legitimate trading strategies based on perceived market inefficiencies. This intent of the action is critical to determining whether it is a violation of this standards. Application of the standards. Example 1, independent analysis and company promotions. The principal owner of Financial Institute Services, FIS, entered into an agreement with 2 micro-cap companies to promote the company's stock in exchange for stock and cash compensations. The principal owner caused FIS to disseminate email, design, and maintain several websites and distribute an online investment newsletter, all of which recommended investment to the other company. The systematic publication of reportedly independent analysis and recommendation containing inaccurate and highly promoted and speculative statements increased public investment in the company and led to dramatically higher stock prices. Comment: principal owner of FIS violated Standards II-B by using inaccurate reporting and misleading information under the use of independent analysis to artificially increase the stock price of the companies. Furthermore, the principal owner violates Standards I-VIII, diligence and responsible basis, by not having reasonable and adequate basis for recommending the two companies, and violated Standards VI-A, disclosure of conflicts by not disclosing to investors and compensation agreements. Example 2, personal trading practices and price. John Gray is a private investor in Belgium who brought a large position several years ago in Frame Pharmaceuticals, a German small-cap securities with limited average trading volumes. He has now decided to significantly reduce his ownings with the poor price performance. Gray is worried that the low trading volume of the stock may cause the price to decline further as he attempts to sell his large position. Gray devises a plan to divide his holdings into multiple accounts into both brokerage firms and private banks in the names of family members, friends, and even a private religious institution. He then creates a rumor campaign of various blogs and social media outlets promoting the company. Gray begins to buy and sell the stocks using the accounts to hopes to raise the trading volume of the price. He conducts the trades through multiple brokers, selling slightly larger positions than he bought on a tactical schedule. And over time, he is able to reduce his holdings as desired without negatively affecting the sell price. Comment: John violated Standards II-B by fraudulently creating the appearance that there was a greater investor interest in the stock, through the online rumors. Additionally, through his trading strategy, he created the appearance that there were greater liquidity in the stock than actually existed. He was able to manipulate the price through both misinformation and trading practices. Example 3, creating artificial price volatility. Matthew Murphy is an analyst at this Diversitaro Securities and Company, which has a significant number of hedge funds among its most prominent brokerage clients. Some of the hedge funds hold short positions on Wire-Wharf Semiconductor 2 trading days before the publication of a quarter-end report. Murphy alerted his sales force that he is able to issue a research report on Wire-Wharf, and that will include the following options. 1, quarterly revenues are likely to fall short of management's guidelines. 2, earnings will be as much as 5% per share, or more than 10% below consensus. And Wire-Wharf's highly respected chief financial officer may be joining another company. Knowing that Wire-Wharf has already entered its declared quarter-end quiet period before reporting earnings, and thus will be reluctant to respond to rumors. Murphy times and releases his research reports specifically to sensationalize the negative aspects of the message in order to create significant downward pressure on Wire-Wharf's stock, to the distinct advantage of Diversitaro's hedge fund clients. The report's conclusions are based on speculations, not on fact. The next day, the research report is broadcasted to all of Diversitaro's clients and the usual newswire services. Before Wire-Wharf's investor relations department can assess the damage on the final trading day of the quarter and refute Murphy's report, the stock opens trading sharply lower, allowing Diversitaro's client to cover the short positions at a substantial gain. Comment: Murphy violated Standards II-B by aiming to create artificial price volatility designed to have a material impact on the price of the issuer's stock. Moreover, by lacking the adequate basis for the recommendation, Murphy also violated Standards VA or 5A, diligence and reasonable basis. Example 4, personal trading and volume. Rajesh Sekhar manages 2 funds, an equity fund and a balance fund, whose equity components are supposed to be managed in accordance with the same model. According to that model, the hedge funding in stock of Digital Design Incorporated (DD) are excessive. Reductions of the DD holdings will not be easy. However, because the stock has low liquidity in the stock market, Sakar decides to start trading larger positions of DD stock back and forth between his two funds and slowly increase the price. He believes market participants would see growing volume and increased prices to become interested in the stock. If other investors are willing to buy the DD stock because of such interest, then Sakar will be able to get rid of at least some of his overweight positions without inducing price decreases. In this way, the whole transaction will be for the benefit of fund participants, even if brokerage commissions are incurred. Comment: Sakar's plan would be beneficial for his fund's participants, but is based on artificial distortions of both trading values and the price of the DD stock, and thus contributes a violation of Standards II-VIII. Example 5. Pumping priming strategy. ACME, Future Exchanges, is launching a new bond feature context to convince investors, traders, abridgers, hedgers, and so on to use its contract. The exchange attempts to demonstrate that it has the best liquidity. To do so, it enters into agreements with members in which they commit to a substantial minimum trading volume on a new contract over a specific period in exchange for substantial reductions of their regular commissions. Comment: the formal liquidity of a market is determined by the obligations set by the market makers. By the actual liquidity of the market is better estimated by the actual trading volume and bid or ask spread. Attempts to mislead participants about the actual liquidity of the market constitutes a violation of Standards II-VIII. In this example, investors have been intentionally misled to believe they choose the most liquid instrument for some specific purpose, but they can eventually see the actual liquidity of the contract significantly reduced after the term of the agreement expires. If the ACME Futures Exchange fully discloses its agreement with members to boost transactions over the same initial launch period, it will not violate Standards II-VIII. ACME's intent is not to harm investors, but on the contrary, to give a better service. For that purpose, it may engage in liquidity pumping strategies, but the strategy must be disclosed. Example 6. Creating artificial price volatility. Emily Gordon is an analyst of household products companies, is employed by a research boutique, Picador and Company, based on information that she has gathered during a trip through Latin America. She believes that Hygiene Incorporated, a major market of personal care products, has generated better than expected sales from its new product initiative in South America. After modestly boosting her projections for revenues and for gross profit margins in her worksheet model of Hygiene, Gordon estimated that her earnings projections of $2 per diluted share for the current year may be as much as 5% too low. She contracts the Chief Financial Officer, CFO of Hygiene, to try to gain confirmation of her findings from her trip and to get some information regarding her recent guidance of US 1.95 to 2.05 for the year. Gordon decides to try to force comment from the company by telling Picador and Company clients who follows a monumental investment style that consensus earnings projections for Hygiene may be much too low. She explains that she is considering rising that when the word of an unrealistically high earning projection filter of Hygiene's Investors Relations Department, the company will feel compelled to update its earnings guidance. Meanwhile, Gordon hopes that she is at least correct with respect to earnings directions, and that she will help clients who act on her insights to profit from a quick gain by trading on her advance. Comment: by exaggerating her earning projections in order to try to fuel a quick gain in Hygiene's stock price, Gordon is in violation of Standards II-B. Furthermore, by virtue of previewing her intentions of revising upwards her earnings projections to only a select group of clients, she is in violation of Standards III-B, fair dealing. However, it would have been acceptable for Gordon to write the report that 1. Frames her earning projections in a range of possible outcomes, 2. Outline clearly the assumption used in her Hygiene model that took into consideration the findings from her trip through Latin America, and 3. Lastly, was distributed to all Picador and Company clients in an equitable manner. Example 7, pump and dump strategies. In an effort to pump up the price of his holdings at Moosehead and Belfast Railroad, a company, Steve Weinberg logs on several investor chat rooms on the internet to start a rumor that a company is about to expand the railroad into anticipation of receiving a large contract for shipping lumber. Comment: Weinberg has violated Standards II-B by disseminating false information about Moosehead and Belfast when the intent is to mislead market participants. Example 8, manipulation model inputs. Bio Modovio supervises a structured financial term for Superior Investment Bank. His responsibilities include packaging new structured investment products and managing superior relationships with relevant rating agencies to achieve the best rating possible. Modeville uses mostly positive scenarios as model input scenarios that reflect minimal downside risks and asset underlying the structural products. The resulting output statistics is the rating request underwriting prospectus supporting the idea that the new structured products have minimal potential downside risk. Additionally, Modell's company from Superior is partially based on both the level of rating assessed and the successful site of new structured investment products, but does not have a link to the long-term performance of investments. Mandeville is extremely successful to lead Superiors at the top orienter of structured investment products for the next 2 years. In the third year, the economy experienced difficulties and values of the assets underlying structured products a significant decline. The subsequent comment: Mandeville's manipulates the input of a model to minimize associated risks to achieve higher ratings. He understands his understanding of structured products allows him to skillfully decide what inputs to include in support to desired rating and price. The information manipulation of short-term gains, which in violations of Standards II-B ultimately causes significant damage to many parties of the capital markets as a whole. Mandeville should have realized the promotion as a rating and price will inaccurate information could cause not only a loss of price confidence in a particular structured product, but also a loss in investor trust in a system. Such a loss of confidence affects the ability of the capital markets to operate efficiently. Example 9, information manipulation. Alec King is a performance analyst of for Tory investment fund, King believes that the portfolio manager for a firm's small and mid-cap equity fund dislikes him because the manager never offers him tickets to local baseball games, but does offer tickets to other employees. To set up a potential regulatory review of the manager, King creates user profiles of several online forums under the portfolio manager's name and starts rumors about potential mergers and for several of the smaller companies in the portfolio. As the price of the company's stock increases, the portfolio manager sells the position, which leads to an investigation of regulatory of King's desired. King has violated Standards II-B, even though he did not personally profit from the market's reactions to the rumor and posting the false information. King misleads others into believing the companies were likely to be acquired. Although his intents were to create trouble for the portfolio manager, his actions clearly manipulates factual information that was available to the market. Standards III, duty to the client. Standards III-A, loyalty, prudence, and care. Members and candidates have a duty of loyalty to their clients and must act with reasonable care and exercise prudent judgment. Members and candidates must act for the benefit of their clients and place their clients' interests before their employers or their own interests. Guidance highlights understanding the application of loyalty, prudence, and care. 2, identifying the actual investment clients. 3, developing the client's portfolio. 4, soft communication policies. 5, proxy voting policies. And 5 was the last one. So lastly, proxy voting policy. Standards III-A clarifies the client's interest are paramount. The members or candidates' responsibilities to a client includes duty of loyalty, the duty to exercise reasonable care. Investment actions must be carried out for the sole benefit of the client and in a manner the member or candidate believes gives the known facts or circumstances to the best interest of the client. Members and candidates must exercise the same level of prudence, judgment, and care that they would apply to the management and disposition of their own interests in similar circumstances. Prudence requires caution and discretion. The exercise of prudence by investment professionals require that they act with care, skill, and diligence that a reasonable person acting in a like capacity and familiar with such matters would use. In the context of managing a client's portfolio, prudence requires following the investment parameters set forth by the clients and balancing risk and return. Acting with care requires members and candidates to act in a prudent and judicious manner in avoiding harm to clients. Standards III-A sets minimal expectations for members and candidates when fulfilling their responsibilities to their clients. Regulatory and legal requirements for such duties can vary across the investment industry depending on a variety of factors, including job functions of the investment professional and the existence of an advisory/client relationship, the nature of the recommendations being offered, from the perspective of the use for the end of financial services. These different standards can be arcane and confusing, leaving investors unsure of what levels of service is expected from investment professionals they employ. The single standard of conduct described in Standards III-A benefits investors by establishing a benchmark for duties of loyalty, prudence, and care, and clarifies that all CFA Institute members and candidates, regardless of job title, local laws, or cultural differences, are required to comply with these fundamental responsibilities. Investors hiring members or candidates who must adhere to the duty of loyalty, prudence, and care set forth in this standards can be confident that these responsibilities are the requirement regardless of any legally imposed fiduciary duties. Standards III-A, however, is not a substitute for a member's or candidate's legal or regulatory obligations. As stated in Standards I-A, members and candidates must abide by the strict requirements imposed on them by regulatory or codes and standards, including any legally imposed fiduciary duty. Members and candidates must also be aware of whether they have custody or effective control of client assets. If so, a heightened level of responsibility arises. Members and candidates are considered to have custody if they have any direct or indirect access to clients' funds. Members and candidates must manage any pool of assets in their control in accordance with the terms of governing documents, such as trust documents and investment management agreements, which are primarily determinants of a manager's powers and duties. Whether their actions are contrary to provisions of those instruments or applicable laws, members and candidates are at risk of violating Standards III-A. Understanding the application of loyalty, prudence, and care. Standards III-A establishes a minimal benchmark for the duty of loyalty, prudence, and care that are required for all members and candidates regardless of whether a legal fiduciary duty applies. Although fiduciary duty often encompasses the principles of loyalty, prudence, and care, Standards III-A does not render all members and candidates fiduciaries. The responsibilities of members and candidates for fulfilling their obligations under these standards depends greatly on the nature of the professional responsibilities and the relationship they have with clients. The conduct of members and candidates may or may not rise to the level of being a fiduciary, depending on the type of client, whether the member or candidate is giving investment advice, and the many facts and circumstances surrounding the particular transaction or client relationship. Fiduciary duties are often imposed by law or regulations when an individual or institution is charged with the duty to act of acting for benefits of another party, such as managing investment assets. The duty required in fiduciary relationships exceed what is acceptable in many other business relationships because a fiduciary is in an enhanced position of trust. Although members and candidates must comply with any legally imposed fiduciary duty, the Code and Standards neither imposes such a legal responsibilities nor requires all members or candidates to act as fiduciaries. However, Standards III-A requires members and candidates to work in the client's best interest no matter what the job functions. A member or candidate who does not provide adversely services to a client but whom act only as trade execution professionals must prudently work with the client's interests when completing requesting trades. Acting in the client's best interest requires these professionals to use their skills and diligence to execute trades in the most favorable terms that can be achieved. Members and candidates operating in such positions must use care to operate within the parameters set by the client's trading instructions. Members and candidates may also operate in a blended environment where they execute clients' trades and offers advice on a limited set of investment options. The extent of advisory arrangements and limitations should be outlined in the agreement with the clients as the outset of the relationship. Furthermore, for instance, members and candidates should inform clients that the advice provided will be limited to the proprietary products of the firm and not include any products available on the market. Clients who want to access to a wider range of investment products would have the information necessary to decide not to engage with members or candidates working under these restrictions. Members and candidates operating in this blended context would comply with their obligations by recommending the allowable products that are consistent with the client's objectives and risk tolerances. They would exercise care, thorough diligence, aligning the client's needs with the attributes of the products being recommended. Members and candidates should place the client's interests first by disregarding any firm or personal interest in motivating a recommendation transaction. There is a large variety of professional relationships that members and candidates have with their clients. Standards III-A requires them to fulfill the obligations outlined explicitly or implicitly in their client agreements to the best of their abilities and with loyalty, prudence, and care. Whether a member or candidate is structuring a new securitization transaction, completing a credit rating analysis, or leading a public company, he or she must work with prudence and care in delivering the agreed-on services. Identifying the actual investment clients. The first step for members and candidates in fulfilling their duties of loyalty to clients is to determine the identity of the client, to whom the duty of loyalty is owed. In the context of an investment manager managing the personal assets of an investment individual, the client is easily identified. When the manager is responsible for the portfolio of pension plans or trusts, however, the client is not the person or entity who hires the manager, but rather the beneficiaries of the plan or trusts. The duty of loyalty is owed to the ultimate beneficiaries. In some situations, an actual client or group of beneficiaries may not exist. Members and candidates managing a fund to an index or an expected mandate own to the duty of loyalty, prudence, and care to invest in a manner consistent with the stated mandate. The decision of a fund manager, although benefiting all fund investors, do not have to be based on an individual investor's requirements and risk profile. Client loyalty and care for those investing in the fund are the responsibilities of members and candidates who have the adversary relationships with those individuals. Situations involving potential conflicts of interest with respect to responsibilities to clients may be extremely complex because they may involve a number of competing interests. The duty of loyalty, prudence, and care applies to the larger number of persons in varied capacities, but the exact duties may differ in many respects in accord with the relationship with each client or each type of account in which the assets are managed. Members and candidates must not only put their obligations of clients first in all dealings, but also endeavors to avoid all real or potential conflicts of interest. Members and candidates whose positions with responsibilities do not include direct investment management, also have clients. They must be considered just as they are various types of adversary relationships. Members and candidates must look at their roles and responsibilities when making a determination of who their clients are. Sometimes the client is easily identifiable, such as in the case of relationships between a company executive and a firm's public shareholders. At other times, the clients may be the investing public as a whole, in which case the goal of independence and objectivity of a research surpass the goal of loyalty to a single organization. Developing a client's portfolio. The duty of loyalty, prudence, and care owns to the individual client is especially important because the professional investment manager typically possesses greater knowledge in the investment arena than the client does. This disciplinary places the individual clients in a vulnerable position. The client must trust the manager. The manager in those situations should ensure that the client's objectives and expectations for the performance of the account are realistic and suitable to the client's circumstances, and that the risks involved are appropriate. In most circumstances, recommended investment strategies should relate to the long-term objectives and circumstances of the client. Particular care must be taken to detect whether the goals of the investment manager or the firm is conducting business, selling products, and executing securities transactions, potentially conflicts with the best interests and objectives of the clients. When members and candidates cannot avoid potential conflicts between their firms and clients' interests, they must provide clear and factual disclosures of the circumstances to the clients. Members and candidates must follow any guidelines set by their clients for the management of their assets. Some clients, such as charitable organizations and pension plans, have strict investment policies that limits investment options to certain types or classes of investments, or prohibits investments in certain securities. Other organizations have aggressive policies that do not prohibit investment by type, but instead set criteria on the basis of portfolio total risk and return. Investment decisions must be judged by Investment decisions must be judged in the context of the total portfolio rather than by individual investments within the portfolio. The member or candidate's duty is satisfied with respect to the particular investment if the individual has thoroughly considered the investment's place in the overall portfolio, the risk of losing and opportunity for gain, tax implications and diversification, liquidity, cash flow, and overall returns, requirements of the asset or the portion of the asset for which the manager is responsible. Soft commission policies. An investment manager often has discretion over the section of broker executing transactions. Conflicts may arise when an investment manager uses client's brokerage to purchase research service, a practice commonly called soft dollars or soft commission. A member or candidate who pays a higher brokerage commission than he or she would normally pay to allow for the purchase of goods or services without corresponding benefits to the client violates the duty of loyalty to the client. From time to time, a client will direct a manager to use the client's brokerage to purchase goods or services for the client, a practice that is commonly called directed brokerage, because brokerage commissions is an asset of the client and is used to loyalty. However, a member or candidate is obliged to seek best price and best execution and be assured by the client that the good or service purchased from the brokerage will benefit the account beneficiaries by execution. Refers to a trading process that seeks to maximize the value of the client's portfolio within the client's stated investment objectives and constraints. In addition, the member or candidate should disclose to the client that the client may not be getting the best execution from the directed brokerage. Proxy voting policies. The duty of loyalty, prudence, and care may apply in a number of situations facing the investment profession besides the related directly to investment assets. Part of a member or candidate's duty of loyalty includes voting proxies in an investment or responsible manner. Proxies have economic value to a client, and members and candidates must ensure that they properly safeguard the maximize this value. The investment manager who fails to vote, cast a vote without consideration to the impact of the question, or vote blindly with management on non-routine governance issues, e.g. a change in company capitalization, may violate the standards. Voting in proxies is an integral part of the management of investments. A cost-benefit analysis may show that voting all proxies may not be the client. So voting proxies may not necessarily, in all instances, members and candidates should disclose to clients their proxy voting policies, recommended procedures for compliance, regular account information. Members and candidates who control a client asset should submit to each client and least quarterly an itemized statement showing the fund of the security in the during the period. 2 should disclose to the clients where the assets are to be maintained, as well as where or when they are moved. And 3 should separate the client's assets from any other party's assets, including the members or candidate's own assets. A client approval. If a member or candidate is uncertain about the appropriate course of action with respect to the client, a member or candidate should consider what he or she would expect to demand if the member or candidate were the client. If in doubt, a member or candidate should dissolve the questionable matter in writing to the client and obtain client approval. Firm policies. Members and candidates should address and encourage the firm to address the following topics when drafting the statements or manuals containing their policies and procedures regarding the responsibilities to clients. Follow all applications. Members and candidates must follow all applications. Consider all the information when taking actions. When taking actions, members and candidates must consider appropriate and suitable. Diversify. Members and candidates should diversify investments to reduce the risk of loss unless diversification is not consistent with plan guidelines or is contrary to the account's objectives. Carrying out regular and reviews. Members and candidates should establish regular review schedules to ensure that the investment held and accurate adheres to the terms of governing documents. Deal freely with all clients with respect to investment actions. Members and candidates must not favor some clients or others, and should establish policies for allocating trades and disseminating investment recommendations. Disclosure conflicts of interest. Members and candidates must disclose all actual and potential conflicts of interest that the clients can evaluate the conflicts. Disclose compensation agreements. Members and candidates should make their clients aware of all forms of manager compensation. Voting proxies. In most cases, members and candidates should determine who is authorized to vote shares and vote proxies in the best interest of the clients and ultimate beneficiaries. Maintain confidentiality. Members and candidates must preserve the confidentiality of client information. Seek best execution unless directed by the clients as ultimate beneficiaries. Members and candidates must seek best execution for their clients. Best execution is defined in the preceding text. Members and place client interests first. Members and candidates must serve the best interests of the client's application of standard example 1, identifying the client plan participants. First country bank serves as trustees for Miller's company's pension plans. Miller is a target of hostile takeover attempt by Newton Incorporated in attempting to ward off Newton. Miller's manager persuaded Julian Wilkney, investment managers at First Country Bank, to purchase Miller's common stock and open market for the employee pension plan. Miller's official indicates that such action would be favorably received and would probably result in another account being placed with the bank. Although Willie believes that stock is overvalued and would not ordinarily buy it, he purchased the stock in support of Millie's managers to maintain Miller's good favor towards the bank and to realize additional new businesses. The heavy stock purchase favors towards the bank and to realize additional new businesses. The heavy stock purchase case Miller's market price to rise to such a level that Newton retracts its takeover bid. Common Standards III-A requires that members or candidates in evaluation takeover bid acting prudently and solely in the interest of the plan participants and beneficiaries. To meet this requirement, a member and or candidate must carefully evaluate the long-term prospects of the company agents, the short-term prospects represented by the takeover offer, and by the ability to invest elsewhere. In this instance, Welly, acting on behalf of his employer, which was the trustee of the pension plan, clearly violates Standards III-A. He used the pension plan to perpetrate existing management, perhaps to determine of price participants and the company's stakeholders, and to benefit himself. Willie's responsibilities to plan participants and beneficiaries should have taken precedence over any ties of his bank to corporate managers and use of his self-interest. Willie has a duty to examine the takeover offer on its own merits and make an independent decision. The guiding principles of the appropriateness of the investment decisions to the pension plan would not whether the decision benefited Willie or the company that hires him. Example 2, client commission practices. J&I, a successful investment consulting firm, serves an investment manager for the pension plan of several large regionally based companies. Its trading activities generally generate a significant amount of commission-related businesses. J&I is the brokerage and research services of many firms, but most of its trading activities is handled through a large brokerage company, Thomson Incorporated. Because the execution of the two firms have a close relationship, Thomson's commission structure is high in comparison with changes in smaller brokerage services from other firms. J&I considers Thomson's research securities and execution capacities average in exchange for J&I's directing its brokerage to Thomson. Thomson absorbs a number of J&I overhead expenses, including those for rent. J&I executives are breaching their responsibilities by using clients' brokerage for service that do not benefit J&I clients, and by not obtaining best practices and best executions for their clients. Besides, J&I executives are not upholding their duty of loyalty. They are violating Standards I-VIII. Example 3, brokerage arrangement. Charlotte Everett, struggling independent investment advisor, serves as investment manager for a pension plan for several companies. One of her brokers, a Scott company, is close to commencing management agreements for the prospective new client, whereby Everett would manage the new client account and trade the accounts exclusively through Scott. One of Everett's existing clients, Creighton Corporations, has directed Everett to place securities transactions for Creighton's account exclusively through Scott, but to induce Scott to exert efforts to send more new account to her. Everett also directs transactions to Scott from other clients without their knowledge. Comment: Everett has no obligations at all times to seek the best practice and best execution on all trades. Everett might direct new clients trading exclusively through Scott Company as long as Everett receives best practice and execution on a trade, or receives a written statement from the new clients that she is not to seek best practices and execution, and that they are aware of the consequence for their actions. Everett may trade other accounts through Scott as a reward for directing clients to Everett only if the account receives best price and execution, and the practice is disclosed to the account. Because Everett does not disclose the directed trading, Everett has not violated Standards I-VIII. Brokerage arrangement. Emily Rome is a trusted official at Page Trust Company. Rome's supervisor is responsible for reviewing Rome's trust account transactions and her monthly report of personal stock transactions. Rome has been using Nathan Gray, a broker, almost exclusively for trust account brokerage transactions. When Gray makes a mark in stocks, he has been giving Rome a lower price for personal purchases and a higher price for sales that gives to Rome's trust accounts and other investors. Comment: Rome is violating her duty of loyalty to the bank's trust account, using Gray for brokerage transactions simply because Gray trades Rome's personal account on favorable terms. Rome is placing her own interests before those of her clients. Example 5, clients commission practices. Lauren Parker, an analyst with Provo Advisory from covering South American equities for her firm. She likes to travel to the markets which she is responsible and declined and decided to go on a trip to Chile, Argentina, and Brazil. The trip is suspended by South AM Incorporated, a research firm with a small brokerage dealer affiliate that uses the clear facilities of a large New York brokerage house. South MA specializes in arranging South American trips for analysis, during which they could meet with central bank officials, government ministries, local economists, and senior executives of corporation. South AM accept commission dollars on a ratio of 2-to-1 against hard dollar costs of the research fee for the trip. Parker is not sure that South AM's execution is competitive, but without informing her supervisor, she directs the trading desk at Provo to start giving commission businesses to South AM. South AM has conventionally timid and briefing trips to coincide with the beginning of the carnival session. So Parker also decides to spend 5 days of vacation in Rio de Janeiro. At the end of the trip, Parker uses commission dollars to pay for the 5 days of hotel expenses. A comment: Parker is in violation of Standards III-A by not exercising her duty of loyalty to her clients. She should have determined whether the commissions charged by South AM are reasonable in relation to the benefits of the research provided by the tips. She also should have determined whether best execution and price should be received from South AM. In addition, the 5 extra days are not part of the research effort because they do not assist in the individual decision making. Thus, the hotel expenses for the 5 days should not be paid for with client assets. Example 6: excessive trading. Vida Canus manages a portfolio of a number of high net worth individuals. A major part of her investment management fee is based on trading commissions. Canus engages in extensive trading for each of her clients and ensures that she attains the minimal commission level set by her firm, although the securities purchased and sold for the clients are appropriate and fall within acceptable asset classes for the clients. The amount of trading for each account exceeds what is necessary to accomplish the client's investment objectives. Comment: Canus has violated Standards III-A because she is using the asset of her clients to benefit her firm and herself. Example 7: managing firm accounts. Adam Deal recently joined a new investment asset manager to assist Deal in building a book of clients. Both his father and his brother opened a free paying account. Deal followed all the firm's procedures in Notion. His relationship with these clients in the developing of their investment policy statements. After several years, the number of Deal's clients have grown, but he still manages the original accounts of the family markets. An IPO is coming to the market that is a suitable investment for many of his clients, including his brothers. Deal does not receive the amount of stock he requested. So to avoid any appearance of conflicts of interest, he does not allocate any shares to his brother's account. Comment: Deal has violated Standards III-A because he is not acting for the benefit of his brother's account as well as his other account. The brother's account is a regular free paying account composite with accounts of his own clients, but not allocating the shares proportionally across all accounts. Deal will have been correct in not allocating shares to his brother's account if that account was being managed outside of the normal fee structures of his firm. Example 8: identifying the client. Donna Hensley has been hired by a law firm to testify as an expert witness. Although the testimony is intended to represent initial advice, she is connected to her hard work. Many have negatively consequated for the law. If the law firm is Hensley's client, how does she ensure that her testimony will not violate the required duty of loyalty, prudence, and care to one's client? Comment: in this situation, the law firm represents Hensley's employers, and the aspect of who is the client is not well defined. When acting as an expert witness, Hensley is bound by the statement of independence, by the standard of independence and objectivity in the same manner as the independent research analyst would be bound. Hensley must not let the law firm influence the testimony she provides in legal proceedings. Example 9, identifying the client. Joe Miller is a mutual fund portfolio manager. The fund is forced on the global financial service sectors. Wanda Spears is a private wealth manager in the small city as Miller, and is a friend of Miller. At the local CFA Institute Society meeting, Spear mentions to Miller that her new client is an investor in Miller's fund. She states that the two of them now share a responsibility to the clients. Comment: Spears' statement is not totally correct because she provides the advisory services to her new clients. She alone is bound by the duty of loyalty to the clients. Miller's responsibility is to manage the funds according to the investment policy statements of the fund. His actions should not be influenced by the needs of any particular fund investor. Example 10, client loyalty. After providing client account investment performance to the external facing departments, but prior to being finalized to release to clients, Tresha Nguyen, that name is so hard, an investment performance analyst, noticed the reporting system missed a trade. Correcting the omission resulted in a large loss of a client that has previously placed the firms on watch for potential termination, owing to underperformance in the prior period. Nguyen knows this newspaper is unpleasant, but informs the appropriate individual that a report needs to update before releasing to the clients. Comment: Nguyen's actions align with the requirement of Standards I-VIII, even though the correction may lead to the firm's termination by the client. Withholding information on errors would not be the best interest of the clients. Example 11, execution only responsibility. Baftija Sulejman recently became a candidate in the CFA program. He is a broker who executes client-directed trades for several high-net-worth individuals. Sujaman does not provide any investment advice and only executes the trading decisions made by the clients. He is concerned that the client code of standards imposed by fiduciary duty on him in his dealing with the clients, and sends an email to the CFA Institute Ethics Help Desk to seek guidelines of the issue. In this instance, Sajuman serves in an execution-only capacity, and his duty of loyalty, prudence, and care centers on the skill and diligence used when executing trades, namely by seeking best execution and making trades within the parameters set by the clients, instructors on quantities, price, timing, etc. Acting in the best interest of the clients dictates that trades are executed on the most favorable term that can be achieved for the clients. Given this job function, the requirements of the Code of Standard for Loyalty, Prudence, and Care clearly do not impose a fiduciary duty. Alright, so I'm going to take a break, and then we're going to continue reading Standards I-VIII Fair Dealing. Okay, so I hope to see you guys continue. I'm going to take a break, and I'll be right back. Continue reading. Standards I-VIII. Fair dealing. Members and candidates must deal fairly and objectively with all clients when providing investment analysis, making investment recommendations, taking investment actions, or engaging in other professional activities. Guidance highlights investment recommendations, investment action. Standards I-VIII requires members and candidates to treat all clients fairly when disseminating investment recommendations or making material changes to prior investment recommendations, or in taking investment actions with regard to general purchases, new issues, or secondary offerings. Only through the fair treatment of all parties can the investment management profession maintain the confidence of the investing public. When an investment advisor has multiple clients, the potential exists for the advisor to favor one client over the other. This favoritism may take various forms, from the quality of time of services provided to the allocation of investment opportunities. The term fairly implies that the member or candidate must take care not to discriminate against any clients when disseminating investment recommendations or taking investment action. Standards I-VIII does not state equality, because members and candidates could not possibly reach all clients at the same time, whether by print, mail, telephone, including text messages, computer, including internet updates and email distributions, fax, mail, fax, or wire. Each client has unique needs, investment criteria, and investment objectives. So not all investment opportunities are suitable for all clients. In addition, members and candidates may provide more personal, specialized, or in-depth services to clients who are willing to pay for premium services, though higher management fees or higher levels of brokerages. Members and candidates may differentiate their service to clients. Both different levels of service must not disadvantage or negatively affect clients. Additionally, the different service levels should be disclosed to clients and prospective clients and should be available to everyone, i.e. different service levels do not affect the selectivity. Standards I-VIII covers conduct in two broadly defined categories: investment recommendations and investment actions. Firstly, investment recommendations. The first category of conduct involves members and candidates who primarily function in the preparation of investment recommendations to the dissemination either to the public or within a firm for the use of others in making investment decisions. This group includes members and candidates employed by investment counseling, advisory, or consulting firms, as well as banks, brokerage firms, and insurance companies. This criterion is that the member or candidate's primary responsibility is the preparation of recommendation to be acted by others, including those in the members or candidates organization. An investment recommendation is an opinion expressed by a member or candidate in regard to purchasing, selling, or holding a given security or other investment. The opinion may be disseminated to consumers or clients through the initial detailed research report, through a brief update report, by addition or deletion from a list of recommended securities, or simply by oral communications. The recommendation that is distributed to anyone outside the organization is considered a communication for general dissemination under Standards I-VIII. Standards I-VIII addresses the manner in which investment recommendations or changes to prior recommendations are disseminated to clients. For each member or candidate is obliged to ensure that the information is disseminated in such a manner that all clients have a fair opportunity to act on every recommendation. Communication with all clients on a uniform basis presents practical problems for members and candidates because of differences in timing and methods of communication with various types of customers and clients. Members and candidates should encourage their firms to design equitable system to prevent selective or discriminatory disclosure, and should inform clients about what kind of communication they would receive. The duty to client imposed by Standards I-VIII may be critical when members and candidates change their recommendation. Then when they make initial recommendations, material changes in members or candidates' prior investment recommendations because of subsequent research should be communicated to all current clients. Particular care should be taken to the information reaches those clients who the member or candidate should have acted or have been affected by the earlier advice. Clients investment actions. The second category of conduct includes those members and candidates whose primary function is taking investment actions, portfolio management, on the basis of recommendations prepared internally or received from external sources. Investment actions, like investment recommendations, can affect market value. Consequently, Standards I-VIII requires that members or candidates treat all clients fairly in light of their investment objectives, circumstances. For example, when making investments in new offerings or in secondary financing, members and candidates should distribute the issues to all customers or whom the investment are appropriate in a manner consistent with the policies of the firm, allocating blocks or stocks. If the issue of oversubscribed, then the issue should be appropriated to all subscribers. This action should be taken on a round lot basis to avoid odd lot distribution. In addition, if the issue of oversubscribed, members and candidates should forego any sales of them to themselves or their immediate families in order to free up additional shares for clients. In the investment professionals, family members' accounts are managed similarly to the accounts of their clients or the firm. However, the family members' accounts should not be excluded from buying such shares. Members and candidates must make every effort to treat all individuals and institutional clients as fair and impartial manner. A member or candidate may have multiple relationships with an institution. For example, the member or candidate may be a corporate trustee, pension fund manager for funds, or individual employed by the customer. Loan or originator or creditor or member or candidate must exercise care to treat all clients fairly. Members and candidates should disclose to clients and prospective clients the documented allocation procedures they or their firm have in place, and how the procedures would affect the clients or prospective or prospects. The disclosure should be clear and complete so that the clients can make an informed investment decisions even when complete disclosure is made. However, members or candidates must put clients' interests ahead of their own. A member or candidate's duty of fairness, loyalty to clients can never be overwritten by clients' consent to patently unfair allocation procedures. Treating clients fairly also means that members and candidates should not take advantage of their positions in the industry to the detriment of clients. For instance, in the context of IPOs, members and candidates must make bona fide public distributions of hot issue securities, defined as securities of a public offering, that are trading at a premium in the secondary market whenever trading commences. Because of the great demand for the securities, members and candidates are prohibited from withholding such securities for their own benefit and must not use such securities as a reward for incentives or gain benefit. Recommended procedures for compliance. Developing firm policies. Although Section 3B refers to members or candidates' responsibility to deal fairly and objectively with clients, members and candidates should also engage in their firms to establish compliance procedures requiring all employees to disseminate investment recommendations or take investment actions or treat customers and clients fairly. At the very least, a member or candidate should recommend appropriate procedures to manage if none are in place. And the member or candidate should make management aware of potential violations for fair dealing practices within the firm when they come to the attention of the member or candidate. The extent of the formality and complexity of such compliance procedures depends on the nature and size of the organization and type of securities involved. An investment advisor who is a sole proprietor and handles only the statutory accounts might not disseminate recommendations to the public, but the advisor should have formal written procedures to ensure that all clients receive fair investment actions. Good business practice dictates that initial recommendations to be made available to all customers who indicate an interest. Although a member or candidate needs not communicate a recommendation to all clients, the selection process by which customers receive information should be based on suitability and known interests, not on any preferred or favored status. A common practice to assure fair dealing is to communicate recommendations simultaneously within the firm and the customer. Members and candidates should consider the following points when establishing fair dealing compliance procedures. 1. Limit the number of people involved. Members and candidates should make reasonable efforts to limit the number of people who are privy to the fact that a recommendation is going to be disseminated to shorten the time frame between the decision and dissimulation. Members and candidates should make reasonable efforts to limit the amount of time that elapses between the decision to make an investment recommendation and the time the actual recommendation is dissimulated. If a detailed institutional recommendation that might take 2 or 3 weeks to publish is in preparation, a short summary report including the conclusion might be published in advance in an organization where both a research committee and an investment policy committee must approve a recommendation. The meeting should be held on the same day if possible. The process of reviewing reports and printing the mailing them, faxing them, or distributing them by email necessarily involves the passage of time. Sometimes long periods of time. In large firms with extensive review processes, the time factor is usually not within the control of the analyst who prepares the reports. Therefore, many firms and their analysts communicate to customers and firms personnel the new or change recommendations by an update or flash report. The communication technique may be faxed or emailed or written or short written report. Publish guidelines for pre-dissimulation behavior. Members and candidates should encourage firms to develop guidelines that prohibits personnel who have prior knowledge of an investment recommendation from discussing or taking any actions on the pending recommendations. Simultaneous dissimulation. Members and candidates should establish procedures for the timing of dissimulation of investment recommendation so that all clients are treated fairly. This is are informed and approximately the same time. For example, if a firm is going to announce a new recommendation, supervisory personnel should time the announcement to avoid placing any clients or groups of clients at an unfair advantage relative to other clients. A communication to all branch officers should be set at a time of a general announcement. When appropriate, the firm should accompany the announcement of a new recommendation with a statement that trading restrictions for the firm's employees are now in effect. The trading restrictions should stay in effect until the recommendation is widely distributed to all relevant clients. Once the distribution has occurred, the member or candidate may follow up separately with individual clients, but members and candidates should not give favored clients advance information when such advance notification may disadvantage other clients. Maintain a list of clients and their holdings. Members and candidates should maintain a list of all clients and the securities or other investment each client hold in order to facilitate notifications of consumers or clients of a change in an investment recommendation if a particular security or other investment is to be sold. Such a list can be used to ensure all holders are treated fairly to the liquidation of the particular investment. Develop and document trade allocation procedures. When formulating procedures for allocating trades, members and candidates should develop a set of guiding principles that ensures 1. Fairness of adversary clients, both in priority of execution of order and in allocation of price obtained in execution of block order or trades. 2. Timeliness and efficiency in the execution of orders. And 3. Accuracy of the members or candidates record as the trade or order and client account position. With these principles in mind, members and candidates should develop or encourage their firms to develop written allocation procedures. When particular attention to procedures or block trades are new issues, procedures to consider as a following: requiring orders of modification or cancellation of order to be documented and time-stamped. Processing and executing orders on a first-in, first-out basis with consideration of bonding order or for efficiency as appropriate for asset class or a security. 3. Developing a policy to address such issues as calculating execution prices and partial fields when trades are grouped in a block or for efficiency. Another one, giving all clients account participating in a block trade the same execution price and charging the same commission. When the full amount of the block order is not executed, allocating partially executed orders among the participating clients among pro rata on a basis of other size, while not going below the established minimum lot size for some securities, e.g. bonds. And lastly, when allocating trades for new issuers, obtaining advance indicators for interest, allocating securities by clients rather than portfolio managers, and providing a method for calculating allocations. Disclosure trade allocation procedures. Members and candidates should disclose to clients and prospective clients how they select accounts to participate in an order and how they determine the amount of securities each amount will buy and sell. Trade allocations procedures must be fair and equitable, and disclosure of inequitable allocation methods does not relieve the member or candidate of its obligation. Establish a systematic account review. Members and candidates a member and candidate supervisor should review each account on a regular basis to ensure that no clients or customers is being given preferential treatment, and that the investment actions taken for each account are suitable for each account's objectives. Because investments should be based on individual need and circumstances, an investment manager may have good reason for placing a given security or other investment in one account while selling in from another account, and should fully document the reasons behind both sides of the transactions. Members and candidates should encourage firms to establish review procedures, however, to detect whether trading in one account is being used to benefit a favored client. Disclose level of service. Members and candidates should disclose all clients whether the organization differs different levels of service to clients for the same fee, or different different levels of service should not be offered to clients selectively. Applications of standard. Example 1, selective disclosure. Bradley Ames, a well-known respected analyst, follows the computer industry. In the course of his research, he finds that a small, relatively unknown company whose shares are traded over the counter are just significantly contracts with some of the companies he follows. After a considerable amount of investigation, Ames decided to write a research report on the small company and recommend purchase of its shares while the report is being reviewed by the company for factual accuracy. Ames scheduled a luncheon with several of his blessed clients to discuss the company. At the luncheon, he mentioned the purchase recommendation scheduled to be sent early the following week to all the firm's clients. Comment: Ames has violated Standards I-VIII by disseminating the purchase recommendation to the clients with whom he has lunch a few weeks before recommendation is sent to all clients. Example 2, fair dealing between funds. Spencer Rivers, president of XYZ Corporation, moves his company growth-oriented pension fund to a particular bank primarily because of the excellent investment performance achieved by the bank's the common-legged fund for the prior 5-year period. Later, River compares the results of his pension fund with those of his bank's pension fund. He started to learn that even though the two companies have the same investment objectives and similar portfolios, his company's pension fund has significantly underperformed the bank's common-legged fund. Questioning this result at the next meeting with the pension fund manager, Rivers is told that as a matter of policy, when a new securities is placed on a recommendation list, Morgan Jackson, the pension fund manager, first purchases the security for the common leg account and then purchases it on a pro rata basis for all other pension fund accounts. Similarly, when a sale is recommended, the security is sold first from the common leg account and then sold to the pro rata basis for all the other accounts. Rivers also learned that if the bank cannot get enough shares, especially of hot issues, to be meaningful to all the accounts, its policies is to place new issuers only in the common leg account. Seeing that Rivers is neither satisfied nor pleased by the explanation, Jackson quickly added the non-discretionary pension account to personal trust accounts. has a lower priority on purchase and sell recommendation that discretionary pension funds accounts. Furthermore, Jackson states that companies' pension funds have the opportunity to invest up to 5% in the common leg fund. The bank's comments, the bank's policy does not treat all customers fairly, and Jackson has violated her duty to her clients by giving priority to growth-oriented common leg funds over all other funds, and to discretionary accounts over non-discretionary accounts. Jackson must execute orders on a systemic basis that is fair to all clients. In addition, trade allocation procedures should be disclosed to all clients when they become clients. Of course, in this case, disclosure of the bank's policies will not change the fact that the policy is unfair. Example 3, fair dealing and IPO distribution. Dominic Morris works for a small regional security firm. He works consist of corporate finance activities and investment for institutional clients. Arena Limited is planning to go public. The partners have secured rights to buy an Arena Football League franchise and are planning to use the funds from the issue to complete the purchase. Because Arena Football is the current range, Morris believes that he has a hot issue and has hands. He has quietly negotiated some options for himself from helping convince Arena to do the financing through his security firm. When he seeks expression of interest, the institution buyers oversubscribe the issue, Morris assuming that the institution has the financial clout to drive the stock up, then filing all orders, including his own, and decreasing the institutional block. Morris has violated Standards I-VIII by not treating all customers fairly. He should not have taken any shares himself and should have prorated the shares offered among all clients. In addition, he should have disclosed to his firms and his clients that he receives options as part of the deal. See Standards I-VIII, disclosure of conflict. Example 4, fair dealing and transactions allocations. Eleanor Preston, a chief investment officer of Porter Williams Investment, PWI, a medium-sized money management firm, has been trying to retain a client, Kobe Company, management by Kobe, which A few days later, when Preston is allocating trades, she notes that some of the MBSs have significantly increased in price and some have dropped. Preston decides to allocate the profitable trades to Kobe and spreading the lost trades among several of its PWI accounts. Comment: Preston has violated Standards I-VIII by failing to deal fairly with her clients and taking these investment actions. Preston should have allocated the trades prior to executing the orders, or she should have had a systemic approach to allocating the trades, such as pro rata, as soon as practical after they were executed. Among other things, Preston must disclose to the clients that the advisor may act as broker for receiving commission forms and have a potential conflict of interest regarding both parties in agency cross transactions. After disclosure, she should obtain from the client consent authorizing such transactions in advance. Example 5, selective disclosure. Sonder Industry Waste Management, SIWM, publicly indicates to analysts that it is comfortable with somewhat disappointing earnings per share projections of US $1.6 for the quarter. Bernard Roberts, an analyst for Call-Free Investments, is confident that SIWM management has understated the forecast earnings so that the real announcement will cause upside surprise. The boost of the price of SIWM stock, the whisper number, rumored, estimated based on the extensive research and discussed amount knowledgeable analysts in higher than US $1.6. Robert repeats the US $1.6 figures in his report. to all corporate clients by informally tells his large clients that his expected earnings per share to be higher, making SIWM a good buy. By not sharing his opinion regarding the potential for a significant upside earnings surprise with all clients, Roberts is not treating all clients fairly and has violated Standards I-VIII. Example 6, additional service for selective clients. Jinping Wang uses email to issue a new recommendation to all his clients. He then calls his 3 largest institutional clients to discuss the recommendation in detail. Wen has not violated Standards I-VIII because he widely disseminated the recommendation and provided the information to all his clients prior to discussing it with a selected few. Wang's largest clients receive additional personal service because they presumably pay higher fees or because they have larger amounts of asset under Wang's management. If Wang have discussed the report with a selective group of clients prior to distributing it to all his clients, he would have violated Standards I-VIII. Example 7, minimum lot allocations. Lynn Hampton is a well-respected private wealth manager in her community with a diversified client base. She determines that a new 10-year bond being offered by Healthy Pharmaceuticals is appropriate for 5 of her clients. 3 clients request to purchase $10,000 each, and the other request 2 requests of $50,000 each. The minimum size is established at $5,000 each, and the issue is oversubscribed at the time of placement. Her firm's policy is that odd lot allocation, especially those below the minimum, should be avoided because they may affect the liquidity of the security at time of sale. Hampton is informed that she will receive only $55,000 of the offering for all accounts. Hampton distributes the bond investment as follows. The accounts that she requests $10,000 are allocated $5,000 each, and the 2 accounts that requested $50,000 are allocated $20,000 each. Comment: Hampton has not violated Standards I-VIII, even though the distribution is not a complete pro rata basis because the required minimum lot size. With the total allocation being sufficiently below the account requested, Hampton ensured that each client receive at least the minimum lot size for issue. This approach allows the clients to efficiently sell the bond later if necessary. Example 8, excessive trading. Ling Chang manages the account for many pension plans, including the plan of his father's employer. Chen developed a similar but not identical investment policy for each client, so the investment portfolios are rarely the same. To minimize the cost to his father's pension plan, he intentionally trades more frequently in the accounts of other clients to ensure the required brokerage is incurred to continue receiving free research for use by all the pensions. Common Chain is violating Standards I-VIII because his trading actions are disadvantaging his clients. To enhance a relationship with a preferred client, all clients are benefiting from the research being provided and should incur fair portions of the cost. This does not mean that additional trading should occur if a client is not paid an equal portion for the commission. Trading should occur only as required by strategy. Example 9, limits social media disclosure. Marty Burdett was recently hired by Fundamental Investment Management (FIM) as a junior auto industry analyst. Burdetti is expected to expand the social media presence of a firm because she is active with various networks, including Facebook, LinkedIn, and Twitter. Although Burdetti's supervisor, Joe Graff, has never used social media, he encouraged Burdetti to explore opportunities to increase FIM's online presence and ability to share content, communicate, and broadcast information to clients in response to Graff's encouragement. Burdetti is working on proposal detailing the advantages of getting FIM on Twitter in addition to launching company Facebook page. As her auto industry research for FIM, Brodette is completing a report on the financial impacts of SunDrive's Auto Limited, a new solar technology for compact automobiles. This research report will be her first for FIM, and she believes SunDrive's technology could revolutionize the auto industry. In her excitement, Brodette sends a quick tweet to FIM Twitter following summarizing her buy recommendation for her SunDrive auto stock. A comment: Brodette has violated Standards I-VIII by sending an investment recommendation to a selected group of contract prior to distributing to all clients. Brodette must make sure she has received the appropriate training about FIM's policies and procedures, including the appropriate business use of potential social media networks before engaging in such activities. See Standards I-VIII guidance relating to duties to supervisors. Example: 10 fair dealing between clients. Paul Rove, performance analyst of Alpha Beta Investment Management, is describing to the firm's chief investment officer (CIO) 2 new reports he would like to develop to assist the firms in meeting its obligation to treat clients fairly. Because many of the firm's clients have similar investment objectives and portfolios, Rove suggests a report detailing securities owned access several clients and the percentage of the portfolio the security represents. The second report will compare the monthly performance of portfolios with similar strategies. The outliers within each report would be submitted to the CIO for review. Comment: as performance analyst, Rove likely has little direct contact with clients and thus has little opportunity to treat clients differently. The recommended report comply with Standards I-VIII while helping the firm conduct after the fact review of having effectively the firm's advisories and dealings with the client's portfolios, report and monitors their fair treatment of clients and their important oversight tools to ensure that clients are treated fairly. Continued reading. Standards I-VIII suitability. When members and candidates are in an advisory relationship with a client, they must A. make a reasonable inquiry to the client's or prospective client's investment experience, risks and return objectives, and financial constraints prior to making any investment recommendations or taking investment actions, and make reassessing and update this information regularly. B. Determine that an investment is suitable to a client's financial situation and consistent with the client's written objectives, mandates, and constraints before making an investment recommendation or taking investment action. C. Judge the suitability of an investment in the context of the client's total portfolio. 2. When members and candidates are responsible for managing a portfolio to a specific mandate, strategy, or style, they must make only investment recommendations or take only investment actions that are consistent with the stated objectives and constraints of the portfolio. Guidance highlights: 1. Develop an investment policy. 2. Understanding the client's risk profile. 3. Updating an investment policy. 4. The need for diversification. 5. Addressing unsolicited trading requests. 6. Managing to an index or mandate. Standards I-VIII requires that members and candidates who are in an investment advisory relationship with clients consider carefully the needs, circumstances, and objectives of the clients when determining the appropriateness and suitability of a given investment or course of investment actions. An appropriate suitability determination will not, however, prevent some investments or investment action from losing value. In judgment, the sustainability of a potential investment, the member or candidate should review many aspects of the client's knowledge, experience related to investing, and financial situation. These aspects include, but are not limited to, the risk profile of the investment as compared with the constraints of the clients, the impact of the investment on diversity of the portfolio, and whether the client has the means or the net worth to assume the allocated risk. The investment professional's determination of suitability should reflect only the investment recommendation or action that a prudent person will be willing to undertake. Not every investment opportunity will be suitable for every portfolio, regardless of the potential reward being offered. The responsibilities of members or candidates to gather information and make a suitability analysis prior to making a recommendation or taking investment actions falls on those members and candidates who provide investment advice in the course of an advisory relationship with a client. Other members and candidates may be simply executing specific instructions for retail clients when buying or selling securities such as shares and mutual funds. These members and candidates should and some others, such as sell-side analysts, may not have the opportunity to judge the suitability of a particular investment for the ultimate client. Developing an investment policy. When an advisory relationship exists, members and candidates must gather client information at the inception of the relationship. Such information includes the client's financial circumstances, personal data, such as age and occupation, that are relevant to investment decisions, altitude towards risk and objectives in investing. The information should be incorporated into a written investment policy statement, IPS, that addresses the client's risk tolerance, return requirements, and all investment constraints, including time horizons, liquidity needs, tax concerns, legal and regulatory factors, and unique circumstances. Without identifying such client factors, members and candidates cannot judge whether a particular investment or strategy is suitable for a particular client. The IPS also should identify and describe the role and responsibilities of the parties to the advisory relationship and investment process, as well as a schedule for review and evaluation for IPS. After formulating long-term capital market expectations, members and candidates can assist in developing an appropriate strategic asset allocation and investment program for the client, whether these are presented in separate documents or incorporated in the IPS or in appendices of the IPS. Understanding the client's risk profile. One of the most important factors to consider in matching appropriateness and suitability of an investment with the client's needs and circumstances is measuring the client's tolerance for risks. The investment professional must consider the responsibilities of rapidly changing investment environments and their likely impact on a client's holdings, both individual securities and collective portfolio. The risk of many investment strategies can and should be analyzed and quantified in advance. The use of synthetic investment vehicles and derivative investment products have introduced particular issues of risk. Members and candidates should pay careful attention to the leverage inherent in many of these vehicles or products when considering them for use in clients' investment programs. Such leverage and limits liquidity. Liquidity depends on the degree to which they are hedging, bear directly on the issue of sustainability for the client. Updating an investment policy using the IPS should be repeated at least annually and also prior to material changes to any specific investment recommendation or decisions on behalf of the client. The effect to determine the need and circumstances of such client is not a one-time occurrence. Investment recommendations or decisions are usually part of an ongoing process that takes into account the diversity and changing nature of portfolio and client characteristics. The passage of time is bound to produce changes that are important with respect to investment objectives from an individual client. For an individual client, important changes might include the number, dependents, personal tax status, health, liquidity needs, risk tolerance, amount of wealth beyond the represented in the portfolio, the extent to which compensations and other income provides for current income needs with respect to an institutional client. Such changes might relate to the magnitude and unfounded liabilities in a person's in a pension fund, the withdrawal privileges in an employee's savings plan, or the distribution requirements of a charitable foundation without efforts to update information concerning client factors. One or more factors could change without the investment manager's knowledge. Sustainability review can be done most effectively when the client fully discloses his or her complete financial portfolio, including those portions not managed by the member or candidate. If clients withhold information about their financial portfolios, the suitability analysis conducted by members and candidates cannot be expected to be complete. It must be based on the information provided. The need for diversification. The investment profession has long recognized that combining several different investments is likely to provide a more acceptable level of risk exposure than having all assets in a single investment. The unique characteristics or risks of an individual investment may become partially or entirely neutralized when it is combined with other individual investments within a portfolio. Some reasonable amount of diversification is thus the norm for many portfolios, especially those managed by individuals or institutions that have some degree of legal fiduciary responsibility. Investment with high relative risk on its own may be a suitable investment in the context of the entire portfolio, or when the client's stated objectives contemplate speculative or risky investments. The manager may be responsible for only a portion of the client's total portfolio, or the client may not have provided a full financial picture. Members and candidates can be responsible for assessing the suitability of an investment only on the basis of the information and criteria actually provided by the client. Addressing unsolicited trading requests. Members and candidates may receive requests from a client or trades that do not properly align with the risks and returns objectives outlined by the client's investment. Recommended procedures for compliance investment policy statement. To fulfill the basic provisions of Standards I-VIII, a member or candidate should put the needs of the circumstances of each client and the client's investment objectives into a written investment policy statement. In formulating an investment policy for the client, the member or candidate should take the following into consideration: client identification, 1, type of nature of the client, 2, the existence of separate beneficiaries, and 3rd, approximate portions of total client asset that the member or candidate is managing. Secondly, point 2, investor objectives, 1, return objectives, income growth, and principal maintenance of purchasing power, and 2, risk tolerance, sustainability of values. Third point 3, investor constraints, 1, liquid needs, 2, expected cash flows, patterns of additional and or withdrawals, 3, inevitable funds, assets or liabilities or other commitments, 4, time horizon, 5, tax considerations, 6, regulatory and legal circumstances, 7, investor preferences, prohibitions, circumstances, and unique needs, and 8, proxy voting responsibilities and guidances. And last point, performance measure benchmarks. Regular updates. The investor's objectives and constraints should be maintained and reviewed periodically to reflect any changes in the client's circumstances. Members and candidates should regularly compare client constraints with capital markets expectations to arrive at an appropriate asset allocation. Changes in either factors may result in fundamental changes in asset allocations. Annual review is reasonable unless business or other reasons, such as major changes in market conditions, dictate more frequent review. Members and candidates should document attempts to carry out such review if circumstances prevent it. Suitability test policies. With the increase in regulatory required suitability test, members and candidates should engage their firms and to develop related policies and procedures. The procedures will differ according to the size of the firm and the scope of the services offered to its clients. The test procedures should require the investment professional to look beyond the potential return of the investment and include the following: an analysis of the impact of the portfolio's diversification, and a comparison of the investment risk with clients' assessed risk tolerance, and 3, the fit of the investment with the required investment strategy. Application of standard example 1, investment suitability risk profile. Caleb Smith, an investment advisor, has 2 clients, Larry Robertson, 60 years old, and Gabriel Lanai, 40 years old. Both clients earns roughly the same salary, but Robertson has much higher risk tolerance because he has a large asset base. Robertson is willing to invest part of his assets very aggressively. Lanai wants to only achieve a steady rate of return with low volatility to pay off his children's education. Smith recommends investing 20% of both portfolios in a zero-yield, small-cap, high-technology equity issue. In Robertson's case, the investment may be appropriate because of his financial circumstances and aggressive investment positions. But this investment is not suitable for Lanai. Smith is violating Standards I-VIII by applying Robertson's investment strategies to Lanai because the 2 clients' financial circumstances are objectives differ. Example 2, investment suitability, entire portfolio. Jessica McDowell, investment advisor, suggests Brian Cosby, a risk-averse client, that covers call options be used in his equity portfolio. The purpose would be to enhance Cosby's income and partially offset the untimely depreciation in the portfolio's value should the stock market or other circumstances affect his holding unfavorably. McDowell educates Crosby about all possible outcomes, including the risks incurred and added tax liabilities if a stock rises in price and is called away, and conversely, the risk of losing protections on the downside if price drops sharply. Common when determining suitability of an investment, the primary focus should be the characteristics of the client's entire portfolio, not the characteristics of single securities on the issue-by-issue basis. The basic characteristics of the entire portfolio will largely determine whether investment recommendations are taking client factors into account. Therefore, the most important aspect of particular investments are those that will affect the characteristics of the total portfolio. In this case, McDowell properly considers the investment in the context of the entire portfolio and thoroughly explains the investment to the client. Example 3, IPS updating. In a regular meeting with clients, Seth Jones, the portfolio manager at Blue Chip Investment Advisors, are careful to allow some time to review his current needs and circumstances. In doing so, they learned that some significant changes have recently taken place in his life. A wealthy uncle left Jones an inheritance that increased his net worth fourfold to US $1 million. The inheritance has significantly increased Jones' ability and possibly his willingness to assume risk and has diminished an average yield required to meet his current income needs. Jones' financial circumstances have definitely changed, so Blue Chip Manager must update Jones' investment policy statements to reflect how his investment objectives have changed. Accordingly, the Blue Chip Portfolio Manager should consider somewhat higher equity ratios for his portfolio than was considered by the previous circumstances, and the manager's specific common stock recommendation might be heavily tilted towards low-yield, growth-oriented issues. Example 4, following an investment mandate, Louis Perkosvaki manages a high-income mutual fund. He purchases zero-dividend stocks in a financial service company because he believes the stock is undervalued and is a potential growth industry, which makes it an attractive investment. Comment: a zero-dividend stock does not seem to fit the mandate of the fund that Perkosvaki fit within the mandate or within the realm of allowable investments. The fund has made clear in its disclosure Perkosvaki has violated Standards I-VIII. Example 5, IPS requirements and limitations. Max Goldberg Chief Investment Officer of a property/casualty insurance subsidiary of a large financial conglomerate, wants to improve the diversification of the subsidiary's investment portfolio and increase its returns. The subsidiary investment policy statement provides for high liquid investments such as large cap equities and government supranational and corporate bonds with a minimum credit rating of AA and maturity of no more than 5 years. In a recent presentation, a venture capital group offered very attractive prospective returns on some of its private equity funds that provides seed capital to ventures. An exit strategy, well already contemplated by investors, would have to observe a minimum 3-year look-up period and a subsequent latter exit option for maximum of 1/3 of their shares per year. Goldberg did not want to miss the opportunity after extensive analysis with the intent to optimize the return on equity asset within the subsidiary's current portfolio. He invests 4% in the seed fund, leaving the portfolio's total equity exposure still well below the upper limit. Comment: Goldberg is violating Standards III-A, loyalty, prudence, and care, with this and as well as Standards III-C. His new investment looks up part of the subsidiary asset for at least 3 years, and up to as many as 5 years, and potentially beyond. The IPS requires investments in highly liquid investments and describes accepted asset classes. Private equity investment with a lockup period certainly do not qualify. Even without a lockup period, an asset class with only an occasional and thus implicitly illiquid market may not be suitable for the portfolio, although an IPS typically describes objectives and constraints in great detail. The manager must also make every effort to understand the client's business and circumstances. Doing so should enable the manager to recognize, understand, and discuss with the clients other factors that may be or may become material in the investment management process. Example 6, sub-managers and IPS review. Paul Ostrowski, investment management businesses has grown significantly over the past couple years, and some clients want to diversify internationally. Ostrowski decides to find a sub-manager to handle the expected international investment. Because this was his first supervisor, Ostrowski uses the CFA Institute model, requests for a proposal to design a questionnaire for his research. By his deadline, he receives 7 completely questionnaires from a variety of domestic and international firms trying to gain his business. Ostrowski reviews all the applications in detail and decides to select the firm that charges the lowest fee, because doing so will have the least impact on his firm's bottom line. Common when selecting an external manager or supervisor, Ostrowski needs to ensure that the new manager's services are appropriate for his client. The due diligence includes comparing the risk profile of his clients with the investment strategy of the manager, and basing the decision on the fee structure alone. Ostrowski may be violating Standards III-C when clients ask to diversify into international products. It is an appropriate time to review and update clients' IPS. Ostrowski's review may determine the risk of international investment modifies the risk profile of the client or does not represent an appropriate investment. See also Standards I-VIII, diligence and responsible basis for further discussion of the review process needed in selecting appropriate sub-managers. Example 7, investment subsidiary risk profile. Samantha Sneed, a portfolio manager for Thomas Incorporated Counsel, Investment Counsel Incorporated, specializes in managing public retirement funds and defined benefit pension plans accounts, all of which have long-term investment objectives. A year ago, Sneed's employer, in an attempt to motivate and retain key investment professionals, introduced a bonus compensation system that rewards portfolio managers on the basis of quarterly performance relative to their peers and to certain benchmarks indices in an attempt to improve the short-term performances of her accounts. Snead changes her investment strategies to purchase high-end beta stocks for her portfolio. Her investment strategies, purchasing several high beta stocks for client portfolios. These purchases are seemingly contrary to the client's investment policy statements. Following the purchase, an officer of Griffin Corporation's, one of Snead's pension fund clients, asked why Griffin Corporation portfolio seems to be dominated by high beta stocks of companies that often appear among the most actively traded issues. No changes in objectives or strategies has been recommended by Snead during the year. Snead violated Standards I-VIII by investing the client's assets in high beta stocks. These high-risk investments are contrary to the long-term risk profile established in the client's IPS. Snead has changed the investment strategy of the clients in an attempt to re-up short-term reward offered by her firm's new compensation arrangement, not in response to changes in clients' investment policy statements. See also Standards I-VIII disclosure of conflict. Example 8, investment suitability. Andre Strube owns and operates Conduit investment advisory firm. Prior to opening Conduit, Strube was an account manager with Elite Investment, a hedge fund management managed by a good friend, Adam Reed, to attract clients to a new Conduit fund. Strube offers lower than normal management fees. He can do so because the fund consists of 2 top-performing fund managers by Reed, giving his personal friendship with Reed and the prior performance records of these 2 funds. Strube believes this new fund is a winning combination for all parties. Clients quickly invest with Conduit to gain access to the elite fund. No one is turned away because Conduit is seeking to expand its asset under management. Strube has violated Standards I-VIII because the risk profile of new funds may not be suitable for every client. As an investment advisor, Strube needs to establish an investment policy statement for each client and recommended only investments as match each client's risk and return profile. In the IPS, Strube is required to act as more than a simple sales agent for Elite. Through Strube cannot disobey the direct request of the client to purchase a specific security. He should fully discuss the risks of a planned purchase and provide reasons why it might not be suitable for the client. This requirement may lead members and candidates to decline new customers if these customers request investment decisions significantly out of line. Standards I-D, performance presentation. When communicating investment performance information, members and candidates must make reasonable effort to ensure that it is fair, accurate, and complete. Guidance. Standards I-D requires members and candidates to provide credible performance information to clients and prospective clients and to avoid misstating performance or misleading clients and prospective clients about the investment performance of members and or candidates or their firms. This standard encourages full disclosure of investment performance data to clients and prospective clients. Standards I-D covers any practice that will lead to misrepresentation of a member or candidate's performance records, whether the practice involves performance presentation or performance measurements. The standards prohibits misrepresentation of a past performance or reasonably expected performance. A member or candidate must give a fair and complete presentation of performance information whenever communicating data with respect to the performance history and individual account, composites or groups of accounts or composites of the accounts or firm's performance results. Furthermore, members and candidates should not state or imply that clients will obtain or benefit from a return that is generated in the past. The requirements of this standards are not limited to members and candidates managing specific accounts. Wherever a member or candidate provides performance information for which the managers is claiming responsibilities, such as for pooled funds, the history must be accurate. Research analysts promoting the success or accuracy of their recommendation must ensure that their client claims are fair, accurate, and complete. If the presentation is brief, the members or candidate must make available to clients the prospects on request, the detailed information supporting that communication. Best practice dictates that brief presentations includes a reference to the limited nature of the information provided, recommended procedures for compliance. Any GIP standards members and candidates who are showing the performance history of the asset and they manage compliance with the GIP standards is the best method to meet their obligations under Standards I-VIII. Members and candidates should engage their firms to comply with GIP standards. Compliance without applying GIP standards. Members and candidates can also meet their obligations under Standards III-D by 1, considering the knowledge of and sophistication of the audience to whom performance presentation is addressed. 2, presenting the performance of a weighted composite or similar portfolios rather than using a single representative account. 3, including terminated accounts as part of performance history with a clear indication of when the account was terminated. 4, including disclosures that fully explains performance results being reported. For example, stats when appropriate, that results are simulated when models results are used, clearly indicating when the performance record is that of a prior entity, or disclosing whether the performance is gross or of fees, not of fees or after tax. And lastly, maintaining the data and record used to calculate the performance being presented. Application of standard. Example 1, performance calculations and length of time. Kyle Taylor of Taylor Trust Company, noting the performance of Taylor's Common Trust Fund for the past 2 years, states in a brochure sent to his potential clients, you can expect steady 25% annual compounded growth of the value of your investment over the year. Taylor's Common Trust Fund did not increase at the rate of 25% for the past year, which mirrors the increase of the stock market. The fund has never averaged the growth of more than 1 year. However, the average rate of return of its trust accumulated 5 years is 5% per year. Comment: Taylor's brochure is in violation of Standards III-D. Taylor should have disclosed that 5% growth occurred only in 1 year. Additionally, Taylor did not include client accounts other than those in the firm's common trust fund. A general claim of a firm's performance should be taken into account the performance of all categories of accounts. Finally, by stating that the clients can expect a steady 25% annual compound growth rate, Taylor is violating Standards I-C misrepresentation, which prohibits assurance of guarantees regarding an investment. Example 2, performance calculations and asset weighing. Anna Jude, a senior partner of Alexander Capital Markets, circulates a performance report for the capital appreciation accounts for the year 1988 through 2004. 2004, the firm claims compliance with GIP standards. Returns are not calculated in accordance with the requirements of the GIP standards. However, because the composite are not asset weighted. Comment: Jude is in violation of Standards III-D when claiming compliance with the GIP standards. Firms must meet all the requirements, must mandatory disclosures, and meet any other requirements that apply to the firm's specific situation. Judd's violation is not from any misuse of the data, but from a false claim of GIP compliance. Example 3. Performance presentation and prior fund / employee. Erin McCoy is vice president and managing partner of an equity investment group of Mastermind Financial Advisors, a new business. Masterminds recruited McCoy because he had a proven 6-year track record with GNP Financial. In developing Mastermind's advertising and marketing campaign, McCoy prepares an advertisement that includes the equity investment performance he achieved at GNP Financial. The advertisement and Mastermind does not identify the equity performance as being earned well at GNP. The advertisement is distributed to existing clients and prospective clients of Mastermind. Comment: McCoy has violated Standards I-VIII by distributing an advertisement that contains material misrepresentation of the historical performance of Mastermind. Standards I-VIII requires that members and candidates make every reasonable effort to ensure that performance information is fair, accurate, and complete representation of an individual or firm's performance. As a general matter, this standard does not prohibit showing past performances to fund managers managed at a prior firm or as part of a performance track record, as long as showing that record is accompanied by appropriate disclosures about where the performance took place and the person's specific role in achieving that performance. If McCoy chooses to use his past performance for GNP and Mastermind's advertisement, he should make full disclosure of the source of his historical performance. Example 4: performance presentation and simulated results. Jed Davis has developed a mutual fund selection product based on historical information from 1990 to 1995 period. Davis tested his methodology by applying the retroactively and data of 1996 to 2003 period, thus producing simulated performance results for those years. In January 2004, Davis's employers decided to offer the product to Davis, began promoting it through trade journal advertisement, and direct the simulation to clients. The advertisement included the performance results of 1996 to 2003 period, but did not indicate that the results were simulated. Comment: Davis violated Standards I-VIII by failing to clearly identify simulated performance results. Standards I-VIII prohibits members and candidates from making any statements that misrepresents the performance achieved by them or their firm, and requires members and candidates to make every reasonable effort to ensure that performance information presented to clients is fair, accurate, and complete. Use of simulated results should be accompanied by full disclosure as the source of the performance data, including the fact that the results from 1995 through 2003 were the results of applying the model retroactively at the time period. Example 5: performance calculations and selective accounts only. In a presentation prepared for a prospective client, William Kilmar shows the rate of return realized over a 5-year period by the composites of his firm's discretionary account that have a balanced objective. This composite, however, consisted of only a few of the accounts that met the balance criterion set by the firm. Excluded accounts under a certain asset level without disclosing the fact of their exclusion, and included accounts that did not have the balance mandate because those accounts will boost the investment results. In addition, to achieve better results, Kevlar manipulated the narrow range of the accounts include in the composite by changing the accounts that made up the composite over time. Comment: Kilmer violated Standards I-VIII by misrepresenting the fact in the promotional material sent to prospective clients, distorting his firm's performance records, and failing to indicate disclosure that would have clarified the presentation. Example 6: performance attribution changes. Art Pearl is reviewing the quarterly performance attribution reports for distribution to clients. Pearl works for an investment management firm with a bottom-up fundamentalist-driven investment process that seeks to add value through stock selection. The attribution methodology currently compares each stock with its selector. The attribution report indicates that the value added this quarter comes from asset allocation and that stock selection contributed negatively to the calculated returns. Through running several different scenarios, Pearl discovers that calculating attribution by comparing each stock with its industry and then rolling the effect of the sector level improves the appearance of the manager's stock selection activity. Because the firm defines the attribution terms and result better reflects the stated strategy, Pearl recommends the client report should have the revised methodology. Modifying and attributing methodology without proper notification to clients will fail to meet the requirements of Standards I-VIII. Pearl's recommendation is being done solely for the interest of the firm to improve its perceived ability to meet the stated improvement strategies. Such changes are unfair to clients and obscure the facts regarding the firm's abilities. Had Pearl believed the new methodology offered improvements to the original model, then he would have needed to report the results of both calculations to the clients. The report should have included the reasons why a new methodology is preferred, which would allow the clients to make a meaningful comparison to prior results and provide a basis for comparing future attributions. Example 7, performance calculations methodology disclosure. While developing a new reporting package for existing clients, Alicia Shi, a performance analyst, discovers that her company's new system automatically calculates both time weight and money weight returns. She asked the head of client services and retention what values would be preferred, given the firm has various investment strategies that includes bonds, equity, securities without leverage, and alternatives. She is told not to label the returns value so that the firm may show whichever value is greater for the period. Comment following these instructions will lead She to violating Standards I-VIII and reporting inconsistent return values. She would not be providing complete information to the firm's clients. Full information is provided when clients have sufficient information to judge the performance gathered by the firm. Example 8, performance conclusions methodology disclosure. Richmond Equity Investment manages a long short equity fund in which clients can trade once a week on Fridays. For transparency reasons, a daily net asset value of the firm is calculated in Richmond. The monthly fact sheets of the fund report month-to-date and year-to-date performances. Richmond publishes the performance based on a higher of the last trading day of the month, typically not the last business day or the last business day of the month as determined by Richmond. The fact sheet mentions only that the data are as the end of the month without giving the exact date. Maggie Clark, the investment performance analyst in charge of the calculations, is concerned about the frequent changes and asks her supervisor whether they are appropriate. Clark's actions in question are changing performance metrics, comply with Standards I-VIII. She has shown concern that these changes are not presenting an accurate and complete picture of the performance generated.
Continued reading. Standards I-VIII, preservation of confidentiality. Members and candidates must keep information about current, formal, and prospective clients confidential unless the information conceals illegal activities on the part of the client. Disclosure is required by law, or the client or prospective client permits disclosure of the information. Guidance highlights status of the client, compliance with the law, electronic information and security, professional conduct investigation by the CFA Institute. Standards III-E requires that members and candidates preserve the confidentiality of information communicated to them by their clients, prospective clients, their formal clients. The standard is applicable when 1. The member or candidate receives information because his or her special ability to conduct a portion of his client's business or personal affairs, and 2. The member or candidate receives information that arises from the relevance to the portion of the client's businesses that is subject for special or confidential relationships. If disclosure of the information is required by law, or if the information conceals illegal activities by the client, however, the member or candidate may have the obligation to report the activity to the appropriate authorities. Status of the client. The standard protects the confidentiality of client information even if the person is or entity is no longer a client of the member or candidate. Therefore, members and candidates must continue to maintain the confidentiality of client records even after the client relationship has ended. If a client or formal client expressly authorizes the member or candidate to disclose the information, however, the member or candidate may follow the terms of authorization to provide the information. Compliance with the law. As a general matter, members and candidates must comply with applicable laws. If applicable laws requires disclosure of client information in certain circumstances, members and candidates must comply with the law. Similarly, if applicable laws requires members and candidates to remain confidentiality, even if the information conceals illegal activities on the part of the client, members and candidates should not disclose such information. Additionally, applicable laws such as interdepartmental communication restrictions within financial institutions can impose limitations on information flow about a client within an entry that may lead to a violation of confidentiality. When in doubt, members and candidates should consult with their employer's compliance personnel or legal counsel before disclosing confidential information about clients. Electronic information and security. Because of the ever-increasing volume of electronically stored information, members and candidates need to be particularly aware of possible accidental disclosures. Many employers have strict policies about how electronically communicate sensitive client information and store client information on personal laptops, mobile devices, or portable desk/flash drives. In recent years, regulatory authorities have imposed stricter data security laws applying to the use of mobile remote digital communications, including the use of social media that must be considered. Standards III-E does not require members or candidates to become experts in information security technology, but that they should have a thorough understanding of the policies of their employers. The size of the operation of the firm will lead to different policies and for ensuring the security of confidential information maintained within the firm. Members and candidates should encourage their firms to conduct regular periodic training on confidentiality procedures for all firm personnel, including portfolio associates, receptionists, and other non-investment staff who have routine direct contact with clients and their records. Professional conduct investigation by CFA Institute. This requirement of Standards III-E are not intended to prevent members and candidates from cooperating with investigation by the CFA Institute Professional Conduct Program. When permission under applicable laws, members and candidates should consider the PCP and extensions of themselves when requested to provide information about a client in support of a PCP investigation into their own conduct. Members and candidates are encouraged to cooperate with investigations into the conduct of others. Any information turned over to the PCP is kept in the strict confidence. Members and candidates will not be considered in a violation of this standard by forwarding confidential information to the PCP. Recommended procedure for compliance. The simplest, most conservative, and most effective way to comply with Standard III-E is to avoid disclosing any information received from a client except to authorized fellow employees who are also working for the client. In some instances, however, a member or candidate may want to disclose information received from clients that is outside the scope of the confidential relationship and does not involve illegal activities. Before making such a disclosure, a member or candidate should ask the following: in what context was the information disclosed? If disclosed in a discussion or work being performed for the clients, is the information relevant to the work? Is the information background material that, if disclosed, will enable the member or candidate to improve services to the client? Members and candidates need to understand and follow their firm's electronic information communication and storage procedures. If the firm does not have procedures in place, members and candidates should encourage the development of procedures that appropriately reflects the firm's size and business operations. Communication with clients. Technological changes are constantly enhancing the methods that are used to communicate with clients and prospective clients. Members and candidates should make reasonable effort to ensure that firm-supported communication methods and compliance procedures follow practices designed to preventing additional distribution of confidential information. Given the rate at which technology changes, a regular review of privacy protection measures is encouraged. Members and candidates should be diligent in discussing with clients the appropriate methods of providing confidential information. It is important to convey to clients that not all firm-sponsored resources may be appropriate for such communications. Application of Standard Example 1, Professional Confidential Information. Sarah Connor, a financial analyst employed by Johnson Investment Counselor Incorporated, provides investment advice to the trustees of City Medical Center. The trustee have given her a number of internal reports concerning City Medical's needs for physical plant renovations and expansion. They have asked Connor to recommend investments that would generate capital appreciation in endowment funds to meet projected capital expenditures. Connor is approached by local businessman Thomas Keynesy, who is considering a substantial contribution to either to City Medical Center or another local hospital. Keynesy wants to find out the building plans of both institutions before making a decision, but he does not want to speak to the trustees. The trustees gave Connor the initial report so she could advise them on how to manage the endowment fund. Because the information of the report is clearly both confidential and within the scope of confidential relationship, Standard III-E requires that Connor refuse to divulge the information to Casey. Example 2, disclosure of confidential information. Lynn Melody, an investment officer at the Leicester Trust Company. She has an advisory customer who has talked to her about giving approximately $50,000 to charity to reduce her income taxes. Melody is also treasurer to the Home of Ingredient Widows, HIW, which is planning its annual giving campaign. HIW hopes to expand its list of prospects, particularly those capable of substantial gifts. Moody recommends that HIW's vice president for corporate gift calls to give her customer to ask for a donation in the $50,000 range. Even though the attempt to help the home is for indigenous widows was well intended, Moody violated Standards III-E by revealing confidential information about her client. Example 3. Discussing possible illegal activity. Government officials approached Casey Samuel, the portfolio manager for Gracia Company Pensions Plan, to examine pension fund records. They tell her that Gracia's corporate tax returns are being audited and the personal fund is being reviewed. 2 days earlier, Samuel has learned in a regular investment review with Garcia officers that potentially excessive and improper charges were being made to the pension plan by Garcia. Samuel consults her employer's general counsel and is advised that Garcia has probably violated tax and fiduciary regulations and laws. Samuel should inform her supervisor of the activities, and her employer should take steps with Garcia to remedy the violations. If that approach is not successful, Samuel and her employer should seek advice of legal counsel to determine the appropriate steps to be taken. Samuel may have a duty to disclose the evidence she has to continuing legal violation of and to resign as asset manager for Garcia. Example 4, disclosing possible illegal activities. David Bradfield manages monies for a family-owned real estate development corporation. He also manages the individual portfolio of several of the family members and officers. of the corporation, including the chief financial officer, based on the financial records of the corporation and some questionable practices of the CFO that Broadfield has observed. Broadfield believes that the CFO is embezzling money from the corporation and putting it into his own personal investment account. Bradfield should check with the firm's compliance department or appropriate legal counsel to determine whether applicable securities regulations requires a reporting of the CFO's financial records. Example 5, accidental disclosure of confidential information. Lynn Moody is an investment officer at Leicester Trust Company. She has stewardship of a significant number of individually managed taxable accounts. In addition to receiving quarterly written reports, about a dozen high net worth individuals have indicated to Moody a willingness to receive communications about overall economic and financial market outlooks directly from her by way of social media platform. Under the direction of her firm's technology and compliance department, she established a new group page on an existing social media platform specifically for her clients. In the instructions provided to clients, Moody asks them to join the group so they may be granted access to posted content. The instruction also advised clients that all comment posted will be available to the public, and thus platform will not be an appropriate method for communicating personal or confidential information. 6 months later, in early January, Moody posted LTC's year-end market outlook. The report outlines a new asset allocation strategy that the firm is adding to the recommendation in the new year. Moody introduced the publication with a note informing her clients that she would be discussing the changes with them individually in the upcoming meetings. One of Moody's clients responded directly on the group page that her family recently experienced a major change in their financial profile. The client described highly personal and confidential detail of the event. Unfortunately, all clients that were part of the group were also able to read the detailed posting until Moody has comments removed. Moody has taken responsible steps for protecting the confidentiality of client information while using social media platforms. She has provided instructions clarifying that all information posted on the site will be publicly viewable to all group members and warns against using the method for communicating confidential information. The accidental disclosure of confidential information by a client is not under Moody's control. Her actions to remove the information promptly once she become aware further aligns with Standards I-VIII. In understanding and the potentially sensitivity clients express surrounding the confidentiality of personal information, this event highlights a need for further training. Moody might be advocate for the additional warnings or controls for clients when they consider using social media platforms for two-way communication. Standards 4, duty to the employers. Standards 4A, loyalty in matters related to their employment. Members and candidates must act for the benefit of their employer and not deprive their employer of the advantages of their skills and abilities, divulge confidential information, or otherwise cause harm to their employer. Guidance, employer responsibilities, independent practices, leaving an employer, use of social media, whistleblowing nature of employment. Standards 4A requires members and candidates to protect the interest of their firms by refraining from any conduct that will injure the firm, deprive it of profit, or deprive it of the member or candidate's skills and abilities. Members and candidates must always place the interest of the clients above the interest of their employer, but should also consider the effect of their conduct on the suitability and integrity of the employer firm. In matters related to the employment, members and candidates must not engage in conduct that harms the interest of their employer. Implicit in its standards and in the obligation of members and candidates to comply with the policies and procedures established by the employers that governs the employee relationship to the extent that such policies and procedures do not conflict with applicable laws, rules, and regulations, or the code of standards. This standard is not meant to be a blanket requirement to place employers' interest ahead of personal interest in all matters. The standard does not require members and candidates to subordinate important personal or family obligations to their work. Members and candidates should enter into a dialogue with their employer about balancing personal and employment obligations when personal matters may interfere with their work or a regular or significant basis. Employer responsibilities. The employer-employee relationship imposes duties and responsibilities on both parties. Employers must recognize that the duties and responsibilities that they owe to the employees if they expect to have the productive employees. Members and candidates are encouraged to provide their employers with a copy of the code and standards. These materials will inform the employer of the responsibilities of a CFA Institute member or a candidate in the CFA program. The code and standards also serve as a basis for questioning employer policies and practices that conflicts with these responsibilities. Employers are not obligated to adhere to the code and standards in expecting to retain competent employees who are members and candidates. However, they should not develop conflicting policies and procedures. The employer is responsible for a positive working environment, which includes an ethical workplace. Senior management has the additional responsibility to devise compensation structure and incentive arrangements that do not encourage unethical behavior. Independence practice. Included in Standards I-VIII is the requirement that members and candidates abstain from independent competitive activities that could conflict with the interests of their employer. Although Standards I-VIII does not preclude member or candidates from entering into an independent business while still employed, members and candidates who plan to engage in independent practices for compensation must notify their employer and describe the types of services that will render the prospective independent client, the expected duration of the service, and the compensation for the service. Members and candidates should not render services until they receive consent from their employers to all of the terms of the arrangement. Practice means all services that the employer currently makes available to the recruitment. Undertaking independent practices means engaging in competitive businesses as opposed to making preparations to begin such practices. Leaving an employer. When members and candidates are planning to leave their current employer, they must continue to act in the employer's best interest. They must not engage in any activities that will conflict with this duty until this resignation becomes effective. It is difficult to define specific guidelines for these members and candidates who are planning to compete with their employers as a new venture. The circumstances of each situation may be reviewed to distinguish permissible preparations from violations of duty. Activities that may constitute a violation, especially in combination, includes the following: misappropriation of trade secrets, misuse of confidential information, solicitation of employers' client prior to a cessation of employment, self-dealing, appropriating for one's own property, business opportunity, or information belonging to one's employer, and lastly, misappropriation of clients or client lists. A departing employee is generally free to make arrangements and preparations to go into a competitive business before terminating their relationship with his or her employer, as long as such preparations do not breach the employee's duty of loyalty. A member or candidate who is contemplating seeking another employment must not contact existing clients or potential clients prior to his or her employer for purposes of soliciting their businesses for the new employer. Once notice is provided to the employer of the intent of resign, the member or candidate must follow the employer's policies and procedures relating to notifying clients and his or her planned departure. In addition, the member or candidate must not take records to file to a new employer without the written permission of the previous employer. Once an employee has left the firm, the skill and experience that an employee obtained while employed is not confidential or privileged information. Similarly, simple knowledge of the names of an existing former clients is generally non-confidential information unless deemed such by arrangement or by law. Standards I-VIII does not prohibit experience or knowledge gained at one employment to be used at another employer. Firm records or work performed on behalf of the firm that is stored in paper or copy or electronically for a member or candidate's convenience while employed, however, should be erased or returned to the employer unless the firm gives permission to keep these records after employment ends. The standard does not prohibit former employers from contacting clients of their previous firms as long as the contacts information do not come from the records of the former employer or violates any applicable non-compete agreements. Members and candidates are free to use public information after departing to contact former clients without violating Standards I-VIII, as long as there is no specific arrangement not to do so. Employers often require employees to sign non-complete agreements that precludes a departing employee from engaging in certain conducts. Members and candidates should take care to review the terms of such agreements when leaving their employer to determine what, if any, conducts these agreements may prohibit. In some markets, there are agreements between employers within the industry that outlines information from departing employees that permits to taking up resignations, such as protocol for brokerage recruiting in the United States. These agreements ease individual transition between firms that have agreed to follow the outlined procedures. Members and candidates who move between firms that sign such agreements may rely on the protection provided as long as they faithfully adhere to all the procedures outlined. For example, under the agreement between the U.S. brokers, individuals are allowed to take some general client contact information when departing to be protected. A copy of the information the individual is taken must be provided to the local management team for review. Additionally, the specific client information may only be used by the departing employee and not other employees by the new firm. Use of social media. The growth of various online networking platforms such as LinkedIn, Twitter, and Facebook, commonly referred to as social media platforms, is providing new opportunities and challenges for businesses. Members and candidates should understand and abide by all applicable firm policies and regulations as to the applicable laws used of social media platforms and interactions with clients and prospective clients. This is especially important when a member or a candidate is planning to leave an employer. Social media use makes determining how and when departure notification is delivered to clients more complex. Members and candidates may have developed profiles on the platform that includes connections with individuals who are clients of the firm, as well as individuals unrelated to the employer. Communication through social media platforms or potentially reach current clients should adhere to the employer's policies and procedures regarding notification of departing employees. Social media connections with clients are also raising questions concerning the differences between public information and firm property. Specific accounts and user profiles of members and candidates may be created to solely professional reasons, including firm-approved accounts from client engagement. Such firm-approved businesses related to accounts would be considered part of the firm's assets, thus require members and candidates to transfer or delete the accounts as directed by the firm's policies and procedures. Best practices for members and candidates is to maintain separate accounts for their personal and professional social media activities. Members and candidates should discuss with their employers how profiles should be treated when a single account includes personal connections and also is used to conduct aspects of their professional activities. Whistleblowing. A member or candidate's personal interest, as well as the interest of his or her employer and secondary are secondary to protecting the integrity of the capital market and the interests of the client. Therefore, circumstances may arise, e.g., when an employer is engaged in illegal or unethical activity in which members and candidates must act contrary to the employer's interests in order to comply with their duties and make the market the market and client in such instances. Activities that would normally violate a member or candidate's duty to his or her employer, such as contracting, contradicting employer instructions, violating certain policies and procedures, or preserving a record by copying employer records, may be justified. Such actions would be permitted only if the inherent intent is clearly aimed at protecting clients or the integrity of the market, not for personal gain. Nature of employment. A wide variety of business relationship exists within the investment industry. For instance, a member or candidate may be an employee for an independent contractor. Members and candidates must determine whether they are employees or independent contractors in order to determine the applicability of Standards I-VIII. The issue will be decided largely by the degree of control exercised by the employing entity over the member or candidate. Factors determining control includes whether the member or candidate's hours, work location, and other parameters of the jobs are set, whether facilities are provided to the member or candidate, whether the member or candidate expenses are reimbursed, whether the member or candidate seeks work from other employers, and a number of clients or employees of members that members or candidates work for. A member or candidate's duties within an independent contractor relationship are governed by the oral or written agreement between the member and candidate. Members and candidates should take care to define clearly the scope of their responsibilities and the expectation of each client within the context of each relationship. Once a member or candidate establishes a relationship with a client, the member or candidate has the duty to abide by the terms of the agreement. Recommended procedures for compliance. Employers may establish code of conduct and operating procedures for their employees to follow. Members and candidates should fully understand the policies to ensure that there are no conflicts of the code and standards. The following topics identify policies that members and candidates should engage their firms to adopt, should encourage their firms to adopt if the policies are not currently in place. Competition policies. A member or candidate must understand any restrictions placed by the employer on offering similar services outside the firm while employed by the firm. The policy may outline the procedures for requesting approval to undertake the outside services or may be a strict prohibition of such services. If a member or candidate's employer elects to have its members sign a non-compete agreement as part of the employment agreement, the member or candidate should ensure that the details are clearly and fully explained prior to signing the agreement. A termination policy. Members and candidates should clearly understand the termination policies of their employer. Termination policies should establish clear procedures regarding the resignation process, including addressing how the termination will be disclosed to clients and staff and whether updates posted through social media platforms will be allowed. The firm's policy may also outline the procedures for transferring ongoing research and account management responsibilities. Finally, the procedures should address agreements that allow departing employees to remove specific client relationship information upon registration. Incident reporting procedures. Members and candidates should be aware of the firm's policies relating to whistleblowing and encourage the firms to adopt industry-based practices in this area. Many firms are required by regulatory mandate to establish confidential and anonymous reporting procedures that allows employees to report potentially unethical and illegal activities to the firm. Employee classification. Members and candidates should understand their status within their employer firm, and encouraged to adapt a standards classification structure, e.g., part-time, full-time, outside contractor for their employee, and indicate how each of the firm's policies applies to each employee class. Application of standard example 1, soliciting former client Samuel McGee manages pension accounts for Trustee Asset Incorporated, but has become frustrated with the working environment and has been offered a position with fiduciary management. Before resigning from Trust Assets, McGee asked 4 big accounts to leave the firm and open accounts with fiduciary. McGee also persuades several prospective clients to sign agreements with fiduciary management. McGee has previously made presentations to these prospects on behalf of Trust Assets. McGee violated the employee-employer principle, requiring him to act solely for the employer's benefit. McGee's duty is to Trust Assets as long as he is employed there. The solicitation of Trust Assets current clients and prospective clients is unethical and a violation of Standards I-VIII. Example 2. Formal employer's documents and files. James Hightower has been employed by Jason Investment Management Corporation for 15 years. He began as an analyst, but assumed increasingly responsibilities and is now a senior portfolio manager and a member of the firm's investment policy committee. Hightower has decided to leave Jason Investments and start his own investment management business. He has been careful not to tell any of Johnson's clients that he is leaving. He does not want to be accused of breaching his duty to Johnson by soliciting Johnson's client before his departure. Hightower is planning to copy and take with him the following documents and information he developed or worked well at Johnson. 1. The client list with addresses, telephones, numbers, and other pertinent client information. 2. Client account statements. 3. Sample marketing presentation to prospective clients containing Jason's performance records. 4. Jason's recommended list of securities. 5. Computer models to determine asset allocation for accounts and various objectives. 6. Computer models for stock selections. And 7. Personal computer spreadsheets of Hightower's major corporate recommendations, which he developed when he was an analyst. A comment. Except with the consent of the employer, departing members and candidates may not take employer property, which includes books, records, reports, and other materials, because taking such materials may interfere with their employer's business opportunities. Taking any employer records, even those the members or candidates prepared, violates Standards I-VIII. Employer records includes items stored in hard copy or any other medium, e.g. a home computer, portable storage devices, cell phones. Example 3. Addressing rumors. Reuben Winston manages all equity portfolios at Target Asset Management, TAM, a large established investment counselor. 10 years previously, Philip and Company, which manages a family of global bond mutual funds, acquired TAM in a diversification move. After the merger, the combined operation prospered in the fixed income business, but the equity management business at TAM languished. Lately, a few of the equity pension accounts that have been with TAM before the merger have terminated their relationship with TAM. One day, Winston found on his voicemail the following message from a concerned client. Hey, I just heard that Philipop is close to announcing the sale of your firm's equity management business to Rugged Life. What is going on? Not being aware of any such deal, Winston has his associates are stunned. Their internal inquiries are met with denial from Philpot's management, but the rumors persist. Feeling left in the dark, Winston contemplated leading an employee buyout of TAM's equity management businesses. An employee-led buyout of TAM's equity asset management business would consistent with Standards I-VIII because it would rest on the permission of the employer and ultimately the client. In the case of, however, in which employers suspect the senior management or principals are not truthful or forthcoming, Winston should consult legal counsel to determine appropriate action. Example 4. Ownership of completed prior works. Laura Clay, who is unemployed, wants part-time consulting work, was seeking a full-time analyst position. During an interview at Broadley Associates, a large international asset manager, Clay is told that the firm has no immediate research openings, but would be willing to pay her for a flat fee to complete a study for the wireless communication industry within a given period of time. Clay would be allowed unlimited access to Bradley's research files and would be welcome to come to the offices and use whatever support facilities are available during normal work hours. Bradley's research directors does not seek any exclusively for Clay's output, and the two agree to the arrangement on the at a handshake. As Clay nears completion of the study, she is offered the analyst job in the research department of Winston and Company, a brokerage firm, and she is pondering submitting the draft of her wireless study for publication by Winston. Comment. Although she is under no written contract obligation to Bradley, Clay has an obligation to let Bradley act on the input of her study before Winston and Company or Clay uses the information to their advantage. This is unless Bradley gives permission to Clay and waives its right to her wireless report. Clay would be in violation of Standards I-VIII if she were to immediately recommend to Winston the same transactions recommended in the report to Bradley. Furthermore, Clay must not take from Bradley any research file materials or any property that she may have used. Example 5. Ownership of completed prior works. Emma Madeline, a recent college graduate and a candidate for the CFA program, spent her summer as an unpaid intern at Murdoch and Lowell. The senior managers of Murdoch are attempting to bring the firm into compliance with the GIP standards, and Madeline is signed to assist in this effort. 2 months into her internship, Madeline applies for a job at Macmillan and Company, which has plans to become GIP compliant. Madeline accepts the job with Macmillan before leaving Murdoch. She complies the firm's software that she has helped develop because she believes the software will assist her in her new position. Comment. Even though Madeline does not receive monetary compensation for her service at Murdoch, she has used the resources in creating the software and is considered an employee because she receives compensation and benefits in the firm of work experience and knowledge. By copying the software, Madeline violates Standards I-VIII because she misappropriated Murdoch's property without permission. Example 6. Soliciting former clients. Dennis Elliott has hired Sam Chisholm, who previously worked for a competing firm. Chisholm left his former firm after 18 years of employment. When Chisholm begins work for Elliott, he wants to contract his former clients because he knows them well and is certain that many will follow him to this new employer. Is Chasen in violation of Standards I-VIII if he contacts his former clients? Because client records are the property of the firm, contacting former clients for any reason through the use of client lists or any information taken from a former employer without permission would be a violation of Standards I-VIII. In addition, the nature and extent of the contact with former clients may be governed by the terms of non-complete agreements signed by the employee and the former employer that covers contracts with former clients after employment. Simple knowledge of the names and existence of former clients is not confidential information, just as seeking or experience skills or experiences that an employer obtains while employed are not confidential or privileged information. The code and standards do not impose a prohibition on the use of expected experience or knowledge gained at one employer from being used at another employer. The code and standard also do not prohibit former employees from contacting clients of their previous firms. In the absence of non-compete agreements, members and candidates are free to use public information about their former firms after departing to contact former clients without violating Standards I-VIII. In the absence of non-complete agreements, as long as Chisholm maintains his duty of loyalty to his employer before joining Elliott's firms, does not take steps in soliciting clients until he has left his former firm, he does not use material from his former employer without the permission of his before he's left, that he is not in violation of the code and standards. Example 7, starting a new firm. Geraldine Allen currently works at a registered investment company as an equity analyst. Without notice to her employer, she registers with government authorities to start an investment company that will compete with her employer. But she does not actively seek clients. Does registration of this competing company with the appropriate regulatory authorities constitute a violation of Standards I-VIII? Allen's preparation for a new business by registering with the regulatory activities does not conflict with the work for her employer if the preparations have been done on Allen's own time outside of the office, and if Allen will not be soliciting clients for businesses or otherwise operating the new company until she has left the current employer. Example 8, competing with current employers. Several employees are planning to depart their current employer within a few weeks and have been careful not to engage in any activities that will conflict with their duty to their current employer. They have just learned that one of the employer's clients has undertaken a request for proposal, RFP, to review the possibly hire a new investment consultant. The RFP has been sent to the employer and all its competitors. The group believes that the new entity to be formed will be qualified to respond to RFP and be eligible for the business. The RFP submission period is likely to conclude before the employee's registration are effective. It is permissible. Is it permissible for the group of departing employees to respond to RFP if they're anticipated for their anticipated new firm? A group of employees responding to an RFP that their employer is also responding to would lead to direct competition between the employees and the employers. Such conduct violates Standards I-VIII unless the group of employees receive permission from their employers as well as the entity sending out the RFP. Example 9. Externally compensated alignments. Alfonso Moto is a research analyst with Tyson Investments. He works part-time as a mayor in his hometown, positions for which receives compensation. Must Mota seek permission from Tyson to sever a mayor? If Mota's mayor duties are so extensive and time-consuming that they might detract from his abilities to fulfill his responsibility at Tyson, he should discuss his outside activities with his employer and come to a mutual agreement regarding how to manage his personal commitment with his responsibilities to his employer. Example 10. Soliciting former clients. After leaving his employer, Shauna McQuillan establishes her own money management business. While with her former employer, she did not sign a non-compete agreement that would have prevented her her from soliciting former clients. Upon her departure, she does not take any of her client lists or contact information, and she clears her personal computer of any employer records, including client contact information. She obtains the phone numbers of her former clients through public records and contacts them to solicit their business. McQuillan is not in violation of Standards I-VIII because she has not used information or records from her former employer and is not prevented by the agreement for her former employer from soliciting her former clients. Example 11. Whistleblowing actions. Meredith Rasmussen works on a buy-side trading desk and concentrates on in-house trades for a hedge fund subsidiary managed by a team of investment managers managing firms. The hedge fund has been very successful and is marketed globally by the firm. From her experience as the trade for much of the activities of the firm, Rasmussen has been quite knowledgeable about the hedge fund's strategies, tactics, and performances. When a distinct break in the market occurs, however, many of the securities involved in the hedge fund's strategy declines markedly in value. Rasmussen observes that the reported performance of the hedge fund does not reflect this decline. In her experience, the lack of any effect is a very unlikely occurrence. Comment: Rasmussen has clearly come under an error of policy, procedure, and compliance practices in the firm's operations. Having been unsuccessful in finding a resolution with her supervisor and compliance officer, Rasmussen should consult the firm's whistleblowing policy to determine See also Standards I-D, misconduct, and Standards 4C, responsibilities of supervisors. Example 12. Soliciting former clients. Andrea Crome has been a private investment banker for YB Safe Bank for the past 8 years. She has been very successful and built a considerable client portfolio during that time, but is extremely frustrated by the recent loss of reputation by her current employer and subsequent client insecurities. A local renowned headhunter contacted Crome a few days ago and offered her an interesting job with a competing private bank. This bank offers a substantial signing bonus for advisors with their own client portfolios. Crome figures that she can solicit at least 70% of her clients to follow her and gladly enters into the new employment contract. Crome may contact former clients upon termination of her employment with YBS Safe Bank, but she is prohibited from using client records built and kept with her in her capacity also an employee of YBS Safe Bank. Client lists are proprietary information of her former employer and must not be used for her or her new employer's benefit. The use of written, electronic, or other information from the records other than publicly available information to contact her former clients of YBS Safe Bank will be a violation of Standards 4A. Example 3. Notification of standard and code and standards. Krista Smith is a recently new assistant trader for a fixed income desk for a major investment bank. She is on a term responsible for structuring collective debt obligation CDOS made up of securities in the inventory of the trading desk. At a meeting of the team, senior executive explains the opportunity of eventually separates meeting of the team. Senior executive explains the opportunity to eventually separate the ODC into various risk-rated tranches to be sold to the client of the firm. After the senior executives leave the meeting, the head trader announces various responsibilities for each members of the team, and then says it is a good time to unload some of the junk that we have been stuck with a while, and disguise it with ratings and a thick, unreadable prospectus. So don't be shy in putting the CDO together. Just kidding. Smith is worried by this remark and asks some of her colleagues what the head trader meant. They all responded that he was just kidding, but that is some truth in the remark, because the CDO is seen by management as an opportunity to improve the quality of the security in the firm's inventory. Concerned about the ethical environment of the workplace, Smith decides to talk to her supervisor about her concerns and provides the head trader with a copy of the code and standards. Smith discusses the principle of placing the client above the interests of the firm and possibility that the development of new CDOs will not adhere to this responsibility. The head trader assures Smith that the appropriate analysis will be conducted when determining the appropriate securities for collateral. Furthermore, the ratings are assigned by an independent firm, and the prospectus will include full and factual disclosure. Smith is reassured by the meeting, but she also reviews the company's procedures and requirements for reporting potential violations of company policies and security laws. Comments Smith's review of the company procedures and policy report is reporting violations allows her to be prepared for report through the appropriate whistleblowing process. If she decides that the CDO development process involves unethical actions by others, Smith's actions comply with the code and standards principles of placing clients' interests first and being loyal to her employer, and providing her supervisor with a copy of the code and standards. Smith is highlighting the high levels of ethical conduct she is required to adhere to in her professional activities. Example 14, leaving an employer. Laura Webb just left her position as portfolio analyst at Research Systems Incorporated, RSI. Her employment contract concludes a non-solicitation agreement that requires her to wait 2 years before soliciting RSI clients with any investment-related services. Upon leaving, Webb was informed that RSI would contact clients immediately about her departure and introduce her replacement. While working at RSI, Webb connected with clients, other industry associates, and firms through her LinkedIn network. Her business and personal relationships were intermingled because she considered many of her clients to be personal friends. Realizing that her LinkedIn network would be a valuable resource for new employment opportunities, she updated her profile several days following her departure from RSI. LinkedIn automatically sent a notification to Webb's entire network that her employment status has been changed in her profile. Prior to departure, Webb should have discussed any client information contained on her social media networks by updating her LinkedIn profile after RSI notified clients, and after her employer ended, she has appropriately placed her employer's interests ahead of her own personal interests. In addition, she has not violated the non-solicitation agreement with RSI unless it's prohibited any contact with clients during the 2-year period. Example 15, confidential firm information. Sanjay Gupta is a research analyst at Naram Investment Management, NIM. NIM uses a term-based research process to develop recommendations on investment opportunities covered by a team member. Gupta, like others, provides commentary on NIM's clients through the company's blog, which is posted weekly on the NIM password-protected website. According to NIM's policies, every contribution to the website must be approved by company's compliance department before posting. Any opinions expressing on the website are disclosed as representing the perspective of NIM. Gupta also writes a personal blog to share his experience with friends and family. As with most blogs, Gupta's personal blog is widely available to interested readers through various internet search engines. Occasionally, when he disagrees with the term-based research opinions of NIM, Gupta uses his personal blog to express his own opinions and counterpoints to the contemporary posted across the internet, but his personal blog posts indirect. Additionally, by posting research commentary on his personal blog, Gupta is using firm resources for his personal advantage. To comply with standards 4A, members and candidates must receive consent from the employer prior to using company resources. Okay, so next we have standards 4B, additional compensation arrangement, and I will continue the reading in our next section. See you there. Continued reading of the CFA program curriculum. Standards 4B, additional compensation agreements. Members and candidates may not accept gifts, benefits, compensation, or consideration that competes with or might reasonably expect to compete to create a conflict of interest with their employer's interest unless they obtain written consent from all parties involved. Guidance Standards 4B requires members and candidates to obtain permission from their employers before accepting compensation or other benefits from third parties for the services rendered the employer or for any services that may create a conflict with their employer's interest. Compensation and benefits includes direct compensation by the clients and any indirect compensation or other benefits received from third parties. Written consent includes any form of communication that can be documented, for example, communication through email that can be retrieved and documented. Members and candidates must obtain permission for additional compensation benefits because such arrangements may affect loyalties and objectivities and create arrangements when evaluating the actions and motivates members and candidates. Moreover, the employers is entitled to full knowledge of all compensational benefits arrangements and so as to be assess the true cost of the service members or candidates are providing. There may be instances in which a member or candidate is hired by an employer on a part-time basis. Part-time status implies members do not commit to full number of hours required by normal work weeks. Members and candidates should discuss possible limitations to their abilities to provide services that may be competitive with their employers during the negotiation and hiring process. The requirements of Standards 4B would be applicable to limitations identified at that time. Recommended procedure for compliance. Members and candidates should make an immediate written report to their supervisor and compliance officer specifying any compensation they propose to receive for services in addition to the compensation or benefits received from their employers. The details, including performance incentives offered by clients. The written report should state the terms of any agreements written which a member or candidate will receive additional compensation. Terms includes the nature of the compensation, the approximate amount of compensation, and duration of the agreement. Application of standard example 1, notification of client bonus compensation. Geoff Whiteman, a portfolio analyst at Adams Trust Company, manages the account for Carl Cochran, a client. Whiteman is paid a salary by his employer, and Cochran pays the trust company a standard fee based on the market value of assets in her portfolio. Cochran proposes to Whitman that any year that my portfolio achieves at least 50% return before taxes, you and your wife can fly to Monaco at my expense and use my condominium during the third week of January. Whitman does not inform his employer of that arrangement and vacation in Monaco the following January as Cochran's guest. Comment: Whitman violated Standard 4B by failing to inform his employer in writing of this supplemental contingent compensation arrangement. The nature of this arrangement could have resulted in particularity to Cochran's account, which could have detracted from Whitman's performance with With respect to other accounts he handles for Adams Trust, Whiteman must obtain the consent of his employer to accept such supplemental benefits. Example 2, notification of outside compensation. Terry Jones sits on the board of directors at Exers Limited Incorporated. In return for his services on the board, Jones receives unlimited membership privileges for his family to all Exers Unlimited facilities. Jones purchases Exers Unlimited stock for the client accounts for which it is appropriate. Jones does not disclose this arrangement to his employer because he does not receive monetary compensation for his services on the board. A comment: Jones has violated Standards 4B by failing to disclose to his employer benefits received in exchange for his services on the board of directors. The non-monetary compensation may create a conflict of interest in the same manner as being paid to serve as a director. Example 3, prior approval for outside compensation. Jonathan Hollis is an analyst of oil and gas company in speculative investment management. He is currently recommending the purchase of ABC Oil Company shares in his published Longwell research report to substantiate his recommendations. Several weeks after publishing the report, Hollis receives a call from the investor relations office of ABC Oil saying that Thomas Andrews, CEO of the company, saw the report and really liked the analyst's grasp of the business and his company. The investor relations officer invites Hollis to visit ABC Oils to discuss industry further. ABC Oils offers to send a company plane to pick up Hollis up to arrange for his accommodation while visiting. Hollis, after gaining the appropriate approvals from his accommodation when appropriate approvals, accept the meeting with the CEO but declines to offer travel agreements. Several weeks later, Andrew and Hollis meets to discuss the oil business and Hollis's report. Following the meeting, Hollis joined Andrew and the investment relations officer for dinner at an upscale restaurant near ABC's oil headquarters. Upon returning to specialty investment management, Hollis provides a full review of the meeting and director research, including a disclosure of the dinner attended. Comment: Hollis's actions do not violate Standards 4B through gaining approval before accepting the meeting and declining the offered travel arrangements. Hollis sought to avoid any potential conflicts of interest between his company and ABC Oils. Because the location of the dinner was not available prior to arrival and Hollis notified his company of the dinner upon his return. Accepting the dinner should not impair his objectivity. By disclosing the dinner, Hollis is enabled specialty investment management to assess whether it has any impact on further reports and recommendation by Hollis related to ABC Oils. Standards 4C, responsibility of supervisors. Members and candidates must make reasonable efforts to ensure that anyone subject to their supervision or authority complies with applicable laws, rules, regulations, and code and standards. Guidance system of supervision. Supervision includes detection. Standards 4C states that members and candidates must prompt action by all employees under their supervision and authority to comply with applicable laws, rules, regulations, and firm policies and code standards. The investment professional who has employees subject to his or her control or influence, whether or not the employees are CFA Institute members, CFA charter holders, or CFA candidates in the CFA program, exercise supervisory responsibilities. Members and candidates acting as supervisors must have an in-depth knowledge of the code and standards so that they could apply this knowledge to discharging their supervisory responsibilities. The conduct that constitutes reasonable supervision in a particular case depends on the number of employees supervised and the work performed by those employees. Members and candidates with oversight responsibilities for a large number of employees may not be able to personally evaluate their conduct of these employees on a continual basis. These members and candidates may delegate supervisory duties to subordinates who directly oversee the other employees. A member or candidate responsibilities under Standard 4C includes instructing those subordinates to whom supervision is delegated about methods to promote compliance, including preventing and detecting violations of laws, rules, and regulations, firm policies, and the Code of Standards. At a minimum, Standard 4C requires that members and candidates with supervisory responsibilities make reasonable efforts to prevent and detect violation by ensuring the establishment of effective compliance systems. However, an effective compliance system goes beyond enacting a code of ethics, establishing policies and procedures to achieve compliance with the code and applicable laws, and reviewing employee actions to determine whether they are following the rules. To be effective, supervisors, members, and candidates should implement education and training programs on a reoccurring and regular basis for employees under their supervision. Such programs will assist the employees with meeting their professional obligations to practice in an ethical manner within the applicable law system, further establishing incentives, monitoring or otherwise, for employees not only to meet business goals but also to reward ethical behavior, offer supervisors another way to assist employees in complying with their legal and ethical obligations. Often, especially in large organizations, members and candidates may have supervisory responsibilities but not the authority to establish any or modify wide compliance policies and procedures or incentives structures. Such limitations should not prevent a member or candidate from working with his or her own superiors and within the firm structure to develop and implement effective compliance tools, including but not limited to: 1. A code of ethics; 2. Compliance policies and procedures; 3. Education and training programs; 4. An incentive structure that rewards ethical conduct; and lastly, adopt a firm-wide best practice standard, e.g. the GIP standards, the CFA Institute Asset Manager Code of Professional Conduct. A member or candidate with supervisory responsibilities should bring inadequate compliance systems to the attention of the firm's senior management and recommended corrective actions. If the member or candidate clearly cannot discharge supervisory responsibilities because of the abuse of the compliance systems or because of an inadequate compliance system, the member or candidate should decline in writing to accept supervisory responsibilities under the firm adopts reasonable procedures to allow adequate exercise of supervisory responsibilities. System of supervision. Members and candidates with supervisory relationships must understand what constitutes an adequate compliance system for their firm and make reasonable efforts to see that appropriate compliance procedures are established, documented, communicated to covered personnel, and followed. Adequate procedures are those designed to meet industry standards, regulatory requirements, the requirements of the code and standards and circumstances of the firm. Once compliance procedures are established, the supervisor must also make reasonable efforts to ensure that the procedures are monitored and enforced. To be effective, compliance procedures must be in place prior to the occurrence of violations of code of standards. Although compliance procedures cannot be designed to anticipate every potential violation, they should be designed to anticipate the activities most likely to result in misconduct. Compliance programs must be appropriate for the size and nature of the organization. The member or candidate should review model compliance procedures or other industry programs to ensure that the firm's procedures meet the minimum industry standards. Once a supervisor learns that an employee has violated or may have violated the law or the code or the standards, the supervisor must promptly initiate an assessment to determine the extent of the wrongdoing, relying on the employee's statements about the extent of the violation or assurance that the wrongdoing will not reoccur is not enough. Reporting the misconduct of the chain of command, warning the employee and to cease the activities are also not enough. Pending the outcome of the investigation, a supervisor should take steps to ensure the violation will not be repeated, such as placing limits on the employee's activity or increasing the monitoring of the employee's activities. Supervision includes detection. Members and candidates with supervisory responsibilities must also make reasonable efforts to detect violations of laws, rules, regulations, firm policies, and code and standards. The supervisors exercise reasonable supervision by establishing and implementing written compliance procedures and ensuring that these procedures are followed through periodic review. If a member or candidate has adopted reasonable procedures and taken steps to institute an effective compliance program, then the member or candidate may not be in violation of Standards I-VIII if he or she does not detect violation that occurs despite these efforts. The fact that violations do occur may indicate, however, that the compliance procedures are inadequate. In addition, in some cases, merely enacting some procedures may not be sufficient to fulfill the duty required by Standards I-VIII. A member or candidate may be in violation of Standards I-VIII if he or she knows or should know that the procedure designed to promote compliance includes detecting and preventing violations and not being followed. Recommended procedures for compliance, code of ethics, or compliance procedures. Members and candidates are encouraged to recommend that their employers adopt a code of ethics. Adaptation of code of ethics is critical to establishing a strong ethical foundation for investment advisory firms and their employees. Code of ethics formally emphasize and reinforce the client loyalty responsibilities of investment firms. Personnel protect investing clients by deterring misconduct and protect the firm's reputation for integrity. There is a distinction, however, between code of ethics and the specific policies and procedures needed to ensure compliance with the code and with securities laws and regulations. Although both are important, code of ethics should consist of fundamental principles-based ethical and fiduciary concepts that are applicable to all of the firm's employees. In this way, firms can best convey to employees and clients the ethical ideals that investment advisories strive to achieve. These concepts need to be implemented, however, by detailed firm-wide compliance policies and procedures. Compliance procedures assist the firm's personnel in fulfilling their responsibilities enumerated in the code of ethics and make probable that the ideals expressed in the code of ethics will be adhered to in the day-to-day operation of the firm. Standalone codes of ethics should be written in plain language and should address general fiduciary concepts. They should be unencumbered by numerous detailed procedures. Code presented in this way are the most effective in stressing the employees that they are in position of trust and must act with integrity at all time. Mingling compliance procedures in the firm's code of ethics goes against the goal of reinforcing the ethical obligation of employees. Separating the code of ethics from compliance procedures will also reduce, if not eliminate, the legal terminology of boilerplate language that can make the underlying ethical principles incomprehensible to the average person. Above all, to ensure the creation of a culture of ethics and integrity rather than than one that is merely focused on following the rules. The principles in the code of ethics must be stated in a way that is accessible and understandable to everyone in the firm. Members and candidates should encourage their employers to provide their code of ethics to clients. In this case, also a simple, straightforward code of ethics would be ethics with will be effective in conveying that the firm is committed to conducting business in an ethical manner and in the best interest of the client. Adequate compliance procedures. A supervisor complies with standards 4C by identifying situations in which legal violations or violations of code and standards are likely to occur by establishing and enforcing compliance procedures to prevent such violations. Adequate compliance procedures should be contained in clearly written and accessible manuals that is tailored to the firm's operation. Be drafted so that the procedures are easy to understand. Designated to compliance officers whose authority responsibility are clearly defined, and who has the necessary resources and authority to implement the firm's compliance procedures. Also, describe the hierarchy of supervision and assign duties among supervisors. Implement a system of checks and balances. Outline the scope of the procedures. Outline procedures to determine and monitoring the testing of compliance procedures. Outline permissible conduct and delineate procedures for reporting violations and sanctions. Once a compliance program is in place, a supervisor should disseminate the contents of the program to appropriate personnel, periodically update procedures to ensure that the measures are adequate under the law, continually educate personnel regarding the compliance procedures, issue periodic reminders of the procedures to appropriate personnel, incorporate a professional conduct evaluation as part of an employee's performance review, review the action of employees to ensure compliance and identify violators, and take the necessary steps to enforce the procedures once a violation has occurred. And once a violation is discovered, a supervisor should respond promptly, conduct a thorough investigation of the activities to determine the scope of the wrongdoing, increase supervision, or place appropriate limitations on the wrongdoers pending at the outcome of the investigation, and review procedures for potential changes necessary to prevent future violations from occurring. Implementation of compliance education and training. No amount of ethics education and awareness will deter someone determined to commit fraud for personal enrichment. But the vast majority of investment professionals strive to achieve personal success with dedicated services to the clients and employees. Regular ethics and compliance training in conjunction with adaptation of a code of ethics is critical to investment firms seeking to establish a strong culture of integrity and to provide an environment in which employers routinely engage in ethical conduct and compliance with the law. Training and education assets individuals in both recognizing areas that are prone to ethical and legal pitfalls, and identifying those circumstances and influences that can impair ethical judgment. By implementing educational programs, supervisors can train their subordinates to put into practice what the firm's code of ethics requires. Education helps employees make the best link between legal and ethical conduct and the long-term success of the business. A strong culture of compliance signals to clients and potential clients, the firm has truly embraced ethical conduct as a fundamental of the firm's mission to serve its client. Establish an appropriate incentive structure. Even if individuals want to make the right choices and follow an ethical course of conduct and are aware of the obstacles that may trip them up, there can still be influences acted improperly by a corporate culture of embrace a success to at all costs mentality, stresses results regardless of the methods used to achieve those results, and does not reward ethical behavior. Supervisors can reinforce an individual's natural desire to do the right thing by building a culture of integrity in the workplace. Supervisors and firms must look closely at their incentive structure to determine whether the structure encourages profit and returns at the expense of ethically appropriate conduct. Reward structures may turn a blind eye to how desired outcomes are achieved and encourage dysfunctional or counterproductive behavior only when compensation and incentives are firmly tied to the client's interests and how outcomes are achieved rather than how much is generated for the firm, will employees work to achieve a culture of integrity. Application of standards. Example 1. Supervising research activities. Jane Mattock, Senior Vice President and Head of Research Department of HNV Incorporated, a regional brokerage firm, has decided to change her recommendation for timber products from buy to sell. In line with HNV's procedures, she orally addresses certain other HNV executives of her proposed actions before the report is prepared for publication. As a result of Mattock's conversation with Dieter Frampton, one of HNV's executives accountable to Mattock, Frampton immediately sells timber stocks from his own account and from certain discretionary client accounts. In addition, other personnel information contain individual customers of the change recommendation before it is printed and disseminated to all HNV customers who have received previous timber reports. Comment: Mattox has violated standards of 4C by failing to reasonably and adequately supervise the actions of those accountable to her. She did not prevent or establish reasonable procedures designed to prevent dissemination of or trading on information by those who know of her change recommendation. She must ensure that her firm has procedures for reviewing or recording any trading in the stock of a corporation and has been the subject of an unpublished change in recommendation, and adequate procedures would have informed the subordinate of their duties and detect sales by Frampton and selected customers. Examples 2, supervising research activities. Delian Miller is a research director for Jamestown investment programs. The portfolio manager have become critical of Miller and his staff because of Jamestown's portfolios do not include any stock that has been subject to merger or tender offers. Georgia Jin, a member of Miller's staff, tells Miller that she has been studying a local company, Excelsior Incorporated, and recommends its purchase. Jin adds that the company has been widely rumored to be a subject of a merger studied by a well-known conglomerate, and discussion between them are underway. At Miller's request, Jin prepares a memo recommending the stock. Miller passes along Jin's memo to the portfolio managers prior to leaving for vacation, and he notes that he has not reviewed the memo. As a result of the memo, the portfolio managers buy Excelsior stocks immediately. The day Miller returns to the office, he learns that Jin's only source of the report were her brothers, who is an acquisitions analyst for Ace Industries, the well-known conglomerate, and the merger discussion were planned but not held. Comment: Miller validated standards 4C but not exercising reasonable supervision when disseminating the memo without checking to ensure that Jin has a reasonable and adequate basis for her recommendations, and that Jin was not relying on material non-public information. Example 3, supervising trading activity. David Edwards, a trainee under at Willers and Companies, a major national brokerage firm, assists a customer paying for the securities of Highland Incorporated by using anticipated profits from the immediate sales of the same securities, despite the fact that Highland is not on Willers' recommendation list. A large volume of its stock is traded through Weller in this manner. Roberta Ann Mason is a Willer vice president responsible for supervising compliance with the securities laws in the trading department. Part of her compensation from Willer is based on commission revenues from the trading department. Although she notices an increased trading activity, she does nothing to investigate or halt it. Comment: Mason's failure to adequately review and investigate purchase orders in Highland stock executed by Edward and her failure to supervise the trainees' activities violates standards 4C. Supervisors should be especially sensitive to actual or potential conflicts between their own self-interest and their supervisory responsibilities. Example 4, supervising trading activities and record keeping. Samantha Tabbing, a senior vice president and portfolio manager for Crozet Incorporated, a registered investment advisory and a registered broker/dealer firm. She reported to Charles Henry, the president of Crozet. Crozet serves as an investment advisor and principal underwriter for ABC and XYZ public mutual funds. The two funds prospectus allows Crozet to trade financial futures for the funds for the limited purpose of hedging against market risks. Henry, extremely impressed by Tabbing's performance in the past 2 years, directs Tabbing to act as portfolio manager for the funds. For the benefit of its employees, Crozet has also organized the Crozet Employee Profit Sharing Plan, CEPSP, as defined contribution retirement plans. Henry assigned Tabbings to manage 20% of the assets of CEPSP. Tabbing's investment objectives for her portion of CEPSP's assets and aggressive growth. Unbeknownst to Henry, Tabbing frequently passes S&P 500 index purchases and sells orders for the fund and the CEPSP without providing the Futures Commission's merchant, FCMS, who takes the orders which with any prior or simultaneous designations of the account of which the trades have been placed. Frequently, neither Tabbing nor anyone else at courts completes an internal trade ticket to record the time an order was placed or the specific amount for which the order was intended. FCMs often designate a specific account only after the trade. When Tabbing provides such designations, Crozet has no written operation procedures or compliance manuals concerning its future trading, and its compliance department does not review such trading. After observing the market's movement, Tabbing assigns to CEPSP the S&P 500 positions with more favorable execution prices and assigns positions with less favorable execution prices to the fund. Example 5, accepting responsibilities. Meredith Rasmussen works on a buy-side trading desk and concentrates on in-house trades for a hedge fund subsidiary managed by the team. Mary Brudette was recently hired by Fundamental Investment Management (FIM) as a junior auto industry analyst. Brudette is expected to expand the social media presence of the firm because she is active with various networks including Facebook, LinkedIn, and Twitter. Although Brudetti's supervisor, Joe Graff, has never used social media, he encourages Brudetti to explore opportunities to increase FIM's online presence and ability to share content, communicate, and broadcast information to clients. In response to Graff's encouragement, Brudetti is working on a proposal detailing the advantages of getting FIM on Twitter, in addition to launching a company Facebook page. As part of her auto industry research for FIM, Brudetti is completing a report on the financial impact of SunDrive Auto Limited's new solar technology for compact automobiles. This research report will be her first for FIM, and she believes SunDrive's technology could revolutionize the auto industry. In her excitement, Brudette sent a tweet to FIM Twitter followers summarizing her buy recommendations for SunDrive Auto stock. Comment: Graff has violated Standards I-VIII by failing to reasonably supervise Brudette with respect to the content of her Twitter. He did not establish reasonable procedures to prevent the unauthorized dissemination of company research through social media networks. Graff must make sure all employees receive regular training about FIM's policies and procedures, including the appropriate business use of personal social media networks. See Standards III-B for additional guidelines. Example 9, supervising research analyst Chen Wang leads the research department at YYR and retirement planning specialist. Chen supervises a team of 10 analysts in a fast-paced and understaffed organization. He is responsible for coordinating the firm's approved process to review all reports before they are approved to the portfolio management team for use of rebalancing client portfolios. One of Chen's direct reports, Huang Mei, covers the banking industry. Chen must submit at least the latest updates to the portfolio management team tomorrow morning. Huang has not yet has yet to submit her research reporting on ZYX Bank because she is uncomfortable providing a buy or sell opinion on ZYX on a basis of completed analysis. Pressed for time and concerned with that Chen will reject a hold recommendation, she researches various websites and blogs on the banking sector for whatever she could find on ZYX. One independent blogger provides a new interpretation of the recently reported data. Huang has analyzed and concluded with a strong sell recommendation for ZYX. She is impressed by the originality and resourcefulness of the blogger's report. Very late in the evening, Huang submits her report and sell recommendation to Chen without any references to the independent blogger's report. Given the late time of submission and the competence of Huang's prior work, Chen compiles this report and the recommendation for each of the other analysts and meets with the portfolio managers to discuss implementation. Comment: Chen has violated Standards I-VIII by neglecting to reasonably and adequately follow the firm's approved review process for Huang's research report. The delayed submission and the quarterly for prior work do not remove Chen's requirements to uphold the designated review process. A member or candidate with supervisory responsibilities must make reasonable efforts to see the appropriate procedures are established, documented, communicated, and covered personnel and followed. Okay, I'll continue reading Standards 5 in future readings. Continue reading of the CFA Level 1 Reading 3, Standards I-VIII Investment Analyst Recommendations and Actions, Standards I-VIII Diligence and Reasonable Basis. Members and candidates must exercise diligence, independence, and thoroughness in analyzing investments, making investment recommendations, and taking investment actions. Have a reasonable and adequate basis supported by appropriate research and investigation for any investment analysis, recommendation, or action. Guidance highlights defining diligence and reasonable basis under using secondary or third-party research, using quantitatively oriented research, developing quantitatively oriented techniques, selecting external advisors and supervisors, group research and decision making. The application of Standards I-VIII depends on the investment philosophy and the members, candidates, or firms as following: the role of the member or candidate in the investment decision-making process, and the support of the resources provided by a member or candidate's employer. These factors will dictate the nature of the diligence and thoroughness of the research and the level of investigation required by Standards I-VIII. The requirements for issuing conclusions based on research will vary in relation to the members or candidate's role in the investment decision-making process, but the member or candidate must make reasonable efforts to cover all pertinent issues when arriving at a recommendation. Members and candidates enhance transparency by providing or offering to provide supporting information to clients when recommending a purchase or sell, or when changing recommendations. Defining diligence and reasonable basis. Every investment decision is based on a set of facts known and understood at the time. Clients turn to members and candidates for advice and expect those advisors to have more information and knowledge than they do. The information and knowledge is the basis from which members and candidates apply their professional judgment in taking investment actions and making recommendations. At a basic level, clients want assurance that members and candidates are putting forth the necessary effort to support the recommendations they are making. Communicating the level and thoroughness of the information reviewed before the member or candidate makes a judgment allows clients to understand the reasonableness of the recommended investment actions as with determining the suitability of investment for the client. The necessary levels of research and analysis will differ with the product, security, or service being offered. In providing an investment service, members and candidates typically use a variety of resources, including company reports, third-party research, and results from quantitative models. A reasonable basis is formed through a balance of these resources appropriate for the security or decisions being analyzed. The following list provides some, but definitely not all, examples of attributes to consider while forming the basis for a recommendation. Global, regional, and country macroeconomics conditions, a company's operating and financial history, the industry and sector's current condition, and the stage of the business cycle, a mutual fund's fee structure and management history, the output of potential limitations of quantitative method models, the quality of the assets included in a securitization, and the appropriateness of select peer group comparisons. Even though investment recommendation may be well-informed, downside risks remains for any investment. Members and candidates can base their decisions only on the information available at the time decisions are made. The steps taken in developing a diligent and reasonable recommendation should minimize unexpected downside events. Using secondary or third-party research. If members and candidates rely on second or third-party research, they must make reasonable and diligent efforts to determine whether such research is sound. Secondary research is defined as research conducted by someone else in the members or candidate's firm. Third-party research is research conducted by entities outside the member or candidate's firm, such as brokerage firms, banks, or research firms. If a member or candidate has reason to suspect that either secondary or third-party research or information comes from a source that lacks a sound basis, the member or candidate must not rely on the information. Members and candidates should make reasonable inquiries into the source and accuracy of all data used in completing their investment analysis and recommendation. The sources of the information and data will influence all levels. The level of the review. A member or a candidate must undertake information and data taken from internet sources such as personal blogs, independent research, aggregation websites, or social media websites likely require a greater level of review than information from more established research organizations. Criteria that a member or a candidate can use in forming an opinion on whether research is sound includes the following assumptions used: rigor of analysis performed, date/time of the research, and evaluation of the objectivity and independence of the recommendations. A member or candidate may rely on others in his or her firm to determine whether secondary or third-party sources is sound and use the information in good faith, unless the member or candidate has reason to question its validity or the processes and procedures used by those responsible for the research. For example, a portfolio manager may not have a choice of data source because of the firm's senior managers conducted due diligence to determine which vendor will provide services. The members or candidates can use the information in good faith, assuming that due diligence processes was deemed adequate. A member or candidate should verify that the firm has a policy about the timely and consistent review of approved research providers to ensure that the quality of the research continues to meet the necessary standards. If such a policy is not in place at the firm, the member or candidate should encourage the development and adaptation of a formal review practice. Using quantitatively oriented research, Standards I-VIII applies to the rapidly expanding use of quarterly oriented research models and processes such as computer-generated models, screening and ranking of investment securities, the creation of valuation of derivative investments, and quantitative portfolios construction techniques. These models and procedures are being used for much more than the back testing of investment strategies, especially with continue advancing technology and techniques. The continued broad development of quantitative methods and models is an important part of capital market development. Members and candidates need to have an understanding of the parameters used, emendations, although used in models and quantitative research that are incorporated into their research recommendations. Although they are not required to be experts in every technical aspect of the model, they must understand the assumptions and limitations inherent in any model and how the results were used in the decision-making process. The reliance on the potential limitation of financial models becomes clear through the investment crisis that unfolded in 2007 and 2008. In some cases, the financial model used to value specific securities and related derivative procedures did not adequately demonstrate the level of associated risk. Members and candidates should make reasonable efforts to test the output of investment models and other pre-programmed analytical tools that they use. Such validations should occur before incorporating the process into their methods, models, or analysis. Although not every model can test for every factor or outcome, members and candidates should ensure that their analysis incorporates a broad range of assumptions sufficient to capture the underlying characteristics of investments. The omission from the analysis of potentially negative outcomes or the level of risk outside of the norm may misrepresent the true economic value of an investment. The possible scenarios for analysis should include factors that are likely to have a substantial influence on the investment value and may include extremely positive or negative scenarios. Developing
quantitatively oriented techniques. Individuals who create new quantitative methods and services must exhibit a higher level of diligence in reviewing new products than the individuals who ultimately use the analytical output. Members and candidates involved in development and oversight of quantitatively oriented models, methods, and algorithms must understand the technical aspects of the products they provide to clients. A thorough testing of the model and resulting analysis should be completed prior to product distribution. Members and candidates need to consider the source and time horizon of the data used as inputs in financial models. The information from many commercially available databases may not effectively incorporate both positive and negative market cycles in the development of a recommendation. The member or candidate may need to test the models by using volatility and performance expectations that represent scenarios outside the observable database, and reviewing the computer models or the resulting output. Members and candidates need to pay particular attention to the assumptions used in the analysis and the rigor of the analysis to ensure that the model incorporates a wide range of possible input expectations, including negative market events. Selecting external advisors and sub-advisors. Financial instruments and asset allocation techniques continue to develop and evolve. The progression has led to the use of specialized managers to invest in specific asset classes or diversification strategies that complement a firm in-house expertise. Standards IV-A applies to the level of review necessary in selecting an external advisor or sub-advisor to manage a specific mandated allocation. Members and candidates must review managers as diligently as they review individual funds and securities. Members and candidates who are directly involved with the use of external advisors need to ensure that the firm has standardized criteria for reviewing these selected external advisors and managers. Such criteria will include but would not be limited to the following: 1. Reviewing the advisor's established code of ethics. 2. Understanding the advisor's compliance to internal control procedures. 3. Assessing the inquiry of the published returns information. And lastly, 4. Reviewing the advisor's investment process and adherence to its stated strategy. Code, standards, and guides to best practice published by the CFA Institute provide members and candidates with examples of acceptable practices for external advisors and advice in selecting a new advisor. The following guides are available at the CFA Institute website: Asset Manager Core of Professional Conduct, Global Investment Professional Standards, and Model Request for Proposal. Group research and decision making. Commonly, members and candidates are part of a group or team that is collectively responsible for producing investment analysis or research. The conclusion or recommendation of the group report represents the consensus of the group that not all necessarily the views of the members or candidates, even though the name of the member or candidate is included on the report. In some instances, a member or candidate will not agree with the views of the group. If, however, the member or candidate believes that the consensus opinion has a reasonable and adequate basis and is independent and objective, the member or candidate need not decline to be identified with the report. If the member or candidate is confident in the process, the member or candidate does not need to dissociate from the respect, even if it does not reflect his or her opinion. Recommended procedures for compliance. Members and candidates should encourage their firms to consider the following policies and procedures to support the principles of Standards I-VIII. Establish a policy requiring the research reports, credit rating, and investment recommendation have a basis
should be appointed to review and approve such items prior to external circulation to determine whether the criteria established in the policy has been met. Develop detailed written guidance for analyst, research, investment, or credit supervisory analysts and review committees that establishes the due diligence procedures for judging whether a particular recommendation has a reasonable and adequate basis. Develop measurable criteria for assessing the quality of research, the reasonableness and adequacy of the basis for any recommendation or rating, and the accuracy of recommendations over time. In some cases, firms may consider implementing compensation arrangements that depend on these measurable criteria and that are applied consistently to all related analysts. Develop detailed written guidance that establishes minimum levels of scenario testing for all computer-based models used in developing, rating, and evaluating financial instruments. The policy should contain criteria relating to the breadth of the scenarios tested and the accuracy of the output over time and the analysis of cash flow sensitivity and inputs. Develop measurable criteria for assessing outside providers, including the quality of information being provided, the reasonableness and adequacy of the provider's collection practices, and the accuracy of the information over time. The established policy should outline how often the provider's products are reviewed, adopt a standardized set of criteria for evaluating the adequacy of external advisors. The policies should include how often and on what basis the allocation of funds to an advisor will be reviewed. Application of standards, example 1. Application of standard example 1, sufficient due diligence. Helen Hockey manages a corporate finance department in Chartered Securities Limited. The firm is anticipating the government will soon close a tax loophole that currently allows oil and gas exploration companies to pass on drilling expenses to holders of a certain class of shares because market demand for this tax-advantaged class of stock is currently high. Tchaikovsky convinces several companies to undertake new equity financing at once before the loophole closes. Time is of the essence, but Tchaikovsky lacks sufficient resources to conduct adequate research for all the prospective issuing companies. Hauke decides to estimate the IPO price on the basis of relative size of each company and to justify the pricing later with her staff has time. Tchaikovsky should have taken on only the work that it could adequately handle by categorizing the issuers in by general size. Hauke has bypassed researching all the other relevant aspects that should have been considered when pricing new issues and thus have not performed sufficient due diligence, such as omissions can result in investors purchasing shares at prices that have no actual basis. Hawk has violated Standards I-VIII. Example 2, sufficient scenario testing. Babu Baliwar works for Henrich Brokerage in the corporate finance group. He has just persuaded Fagan's Research Limited to allow his firm to do a secondary equity financing at Fagan's Resources Current stock prices because the stock has been trading at higher multiples than similar companies with equivalent productions. The Liwar presses the Fagan's Resource managers to project what would be the maximum production they could achieve in an optimal scenario. Based on these numbers, he is able to justify the price his firms will be asking for the secondary issue during a sales pitch to the brokers. Dwally then uses these numbers as a base case production level that the Fagans resources will achieve. When presenting information to the brokers, the wall should have given a range of production scenarios and a probability of Fagans resources achieving each level. By giving the maximum production level as the likely level of production, he has misrepresented the chances of achieving the production level and seriously misled the brokers. Dwally has violated Standards I-VIII. Brendan Witt, a former junior sell-side technology analyst, decides to return to school to earn an MBA to keep his research skills and industry knowledge sharp. Witt accepted a position with online and informed an independent internet-based research company. The position requires the publications on a recommendation and report on on a different company every month. Initially, Witt is a regular contributor to New Research and a participant in the associated discussion board that generally have positive comments on the technology sector. Over time, his ability to manage his educational requirements and his work requirements begins to conflict with one another. Knowing a recommendation is due the next day for online, Witt creates a report based on a few new articles and what the conventional wisdom of the markets has deemed the hot security of the day. Witt's knowledge of the exuberance of technology stocks, of a few news articles, and the conventional wisdom of the market do not constitute, without more information, a reasonable and adequate basis for a stock recommendation that is supported by appropriate research and investigation. Therefore, Witt has violated Standards I-VIII. See also Standards I-VIII. See also Standards I-VIII, responsibilities to supervisors, because it relates to the firm's inadequate procedures. Example 4, timely client updates. Kristen Chandler is an investment consultant in the London office of Dalton Securities, a major global investment consultant firm. One of her UK pension funds has decided to appoint a specialist U.S. equity manager. Dayton's global manager for research relies on local constituents to cover to cover managers within their regions, and after conducting thorough due diligence, puts their views and ratings in Dalton's manager database. Chandler accesses Dalton's global manager research database and conducts a screen of all U.S. equities managers on the basis of a match with the client's desired philosophy or style, performance, and tracking error targets. She selects the 5 managers that meets these criteria and puts them in a briefing report that is delivered to the clients 10 days later. Between the time of Chandler's database search and the delivery of the report to the client, Chandler is told that Dalton has updated the database with the information that one of the firms that the Chandler has recommended for consideration lost the chief investment officer, the head of its U.S. equity research, and the majority of its portfolio managers in the U.S. equity product, all of which have left to establish their own firm. Chandler does not revise her report with this updated information. Chandler has failed to satisfy the requirements for Standards I-VIII. Although Dalton updated the manager rating to reflect the personnel turnover at one of the firms. Chandler did not update on her report to reflect the new information. Group example 5, group research opinion. Evelyn Mastakis. Evelyn Mastakis is a junior analyst who has been asked by her firm to write a research report predicting the expected interest rate for residential mortgages over the next 6 months. Mastakis submits her report to the Fixed Income Investment Committee in her firm for review as required by firm procedures. Although some committee members support Mastakis' conclusions, the majority of the committee disagrees with her conclusions, and the report is significantly changed to indicate that interest rates are likely to increase more than originally predicted by Mastakis. Should Mastakis take her name to be taken off of the report when it is disseminated? The results of research are not always clear, and different people may have different opinions based on the same factual evidence. In this case, the committee may have valid reasons for issuing a report that differs from the analyst's original research. The firm can issue a report that is different from the original report of an analyst as long as there is a reasonable and adequate basis for its conclusions. Generally, analysts must write research reports that reflect their own opinions and can ask the firm not to put their names on a report that ultimately differs from that opinion. When the work is a group effort, however, not all members of the team may agree with all aspects of the report. Ultimately, members and candidates can ask to have their names removed from the report, but if they are satisfied that the process has produced results or conclusions that have a reasonable and adequate basis, members and candidates do not have to dissociate from the report even when they do not agree with its contents. If Mastakis is confident in the process, she does not need to dissociate from the report even if it does not reflect her opinion. Example 6, reliance on third-party research. Gary McDermott runs a 2-person investment management firm. McDermott's firm subscribes to a service from a large investment research firm that provides research reports. McDermott's firm makes investment recommendations on the basis of these reports. Comment members and candidates can rely on third-party research by making reasonable and diligent efforts to determine that such research is sound. If McDermott undertakes due diligence efforts on a regular basis to ensure that the research produced by the large firm is objective and reasonably based, McDermott can rely on the information when making investment recommendations to the clients. Example 7, due diligence and sub-manager selection. Paul Ostrotsky's business has grown significantly over the past couple of years, and some clients want to diversify internationally. Ostrotsky decides to find a sub-manager to handle the expected international investment because this will be his first sub-advisor. Ostrotsky uses the CFA Institute model, quote, request of proposal, end quote, to design questionnaire for his search. By his deadline, he receives 7 completed questionnaires from a variety of domestic and international firms trying to gain his business. Ostrotsky reviews all the applicants in detail and decides to select the firm charging the lowest fee because what he was doing was impact his firm's bottom line. Comment: the selection of an external advisor or a sub-advisor should be based on a full and complete review of the advisor's select services, performance history, and cost structure. In basing the decision on the fee structure alone, Ostrotsky may be violating Standards I-VIII. See also Standards III-C, suitability, because it relates to the ability of the selected advisors to meet the need of the client. Example 8, Michael Papis is the chief investment officer of his state retirement fund. The fund has always used outside advisors for the real estate allocation, and this information is clearly presented in all fund communications. Thomas Nagel, a recognized sell-side research analyst for Papis, and Papis's business school classmate, recently left the investment bank. He worked to start his own asset management firm, Accessible Real Estate. Nagel is trying to build his assets under management and contact Papis about gaining some of the retirement funds allocations in the previous years. The performance of the retirement fund's real estate investment was in line with the fund's benchmark, but was not extraordinary. Papis decides to help out his old friend and also to seek better returns by moving the real estate allocation to accessible. The only notice of the change an advisor appears in the next annual report of the listings of associated advisors. Comment: Papis violated Standards I-VIII. His responsibilities may include the selection of external advisors, but the decision to change advisors appeared to have been arbitrary. If Papis was dissatisfied with the current real estate advisor, he should have conducted a proper solicitation to select the most appropriate advisor. See also Standards 4C, responsibility of supervisor. Standards 5B, communication with clients, prospective clients, and Standards 6A, disclosure of conflicts. Example 9, sufficient due diligence. Andrew Schwab owns and operates Conduit investment advisory firm. Prior to opening a Conduit, Schwab was an account manager with Elite Investments, hedge fund management by his good friend Adam Reed. To attract clients to new Conduit fund, Schwab offers lower than normal management fees. He can do so because the fund consists of two top performing fund managers by Reed. Given the personal friendship with Reed and the prior performance records of the two funds, Schwab believes this new fund is a willing combination of all parties. Clients quickly invest with Conduit to gain access to the elite funds. No one is turned away because Conduit is seeking to expand its asset under management. Schwab violated Standards 4A by not conducting a thorough analysis of the firms managed by Reed before developing a new Conduit fund. Schwab's reliance on his personal relationship with Reed and his prior knowledge of Elite is insufficient justification for the investment. The funds may be appropriately considered, but a full review of their operating procedures, reporting practices, and transparency are some elements of the necessary due diligence. Example 10, sufficient due diligence. Bob Thompson has been doing research for the portfolio managers of a fixed income department. His assignment is to do sensitivity analysis on securitized subprime mortgages. He has discussed with the manager possible scenarios to use to calculate expected returns. A key assumption in such calculations is housing price appreciation. Expected returns a key HPS because it drives prepayment of mortgage and losses. Thompson is concerned with the sufficient appreciation experienced over the previous 5 years as a result of the increased availability of funds from subprime mortgages. Thompson insists that the analysis should include a scenario run with 10% for year 1, minus 5% for year 2, and then the project a worst case scenario of 0% on year 3. year 3 through 5, the manager replies that these assumptions are too dire because there has never been a time in the available database with HPA. Thompson conducts his research to better understand the risk inherent in these securities and evaluates these securities in the worst-case scenario, a less likely but possible environment based on the results of the enhanced scenarios. Thompson does not recommend the purchase of the securitization against the general market trends. The manager follows Thompson's recommendation and does not invest. The following year, the housing market collapsed. In avoiding the subprime investments, the manager's portfolio outperformed its peer group that year. Comment: Thompson's actions in running the scenarios, tests, and inputs beyond the historical trend available in the firm's database adheres to the principles of Standard IV-A. He concerns over recent trends provide a sound basis for future analysis. Thompson understands the limitations of his model. When combined with the limited available historical information, to accurately predict the performance of the fund and market conditions changes negatively. See also Standards I-VIII, Independence and Objectivity. Example 11, using quantitatively oriented models. Espasialiakos works in sales for Halencia Securities, a firm specializing in developing intricate derivative strategies to profit from particular views on market expectations. One of her clients is Eugene Karapalis, who has become convinced that commodity prices will become more volatile over the coming months. Karapalis also asks Liakos to quickly engineer a strategy that will benefit from the expectation. Liakos turns to Hellenica's modeling group to fulfill the request. Because of the tight deadline, the model group outstretched parts of the work to several trusted third parties. Liakos implements components of the strategy as the firm completes them. Within a month, Karapalis is proven correct. Volatility across the range of commodities increased sharply, but the relative precisions with Halencia's returns huge losses. And the losses increased daily. Liakos investigates and realizes that although each of these various components of the strategy has been validated, they had never been evaluated as an integrated whole. In extreme conditions, portions of the model worked as cross-purpose for other portions, causing the overall strategy to fail dramatically. Comment: Liakos violated Standards IV-A. Members and candidates must understand the statistical significance of the results of the model they recommend and must be able to explain them to clients. Liakos did not take adequate care to ensure a thorough review of the whole material. Its components were evaluated only through brain. Because Karapais clearly intended to implement the strategy as a whole rather than as separate parts, Liakos should have tested how the components of the strategy interacted, as well as how they are performed individually. Rehearsed. Ellis Smith is a performance analyst At Arctic Global Advisors, a firm that manages global equity mandates for international clients, she was asked by her supervisor to review 5 new performance attribute systems and recommend one that would be more appropriate. Appropriately explain the firm's investment strategy to clients. On the list was a system she recalled learning about when visiting an exhibitor booth in the recent conference. The system is highly quantitative, and something of the black box is how it calculates the attribution values. Smith recommended this option without researching the others because the sheer complexity of this process was sure to impress the client. Smith's actions do not demonstrate a sufficient level of diligence in reviewing the process to make recommendations for selecting the service. Besides not reviewing our consideration or considering the other 4 potential systems, she did not determine whether the black box attribution process aligns with the investment procedures of the firm, including its investments in different countries and currencies. Smith must review and understand the process of any software or system before recommending it to use as the firm's attribution system. Example 5, sub-advisor selection. Craig Jackson is working with Adam Partners Incorporated and has been assigned to select a hedge fund supervisor to improve a comment by considering only performance and GIP compliance. Jackson has not conducted sufficient review of potential firms and to satisfy the requirements of Standards I-VIII. A thorough investigation of the firm and the operation should not have cost me that much time. Example 16. A manager selection. Timothy Green works for Peach Asset Management, where he creates proprietary models that analyze data from requests for proposed questionnaires. To identify managers for possible inclusion in the firm's fund-to-fund investment platform. Various criteria must be met to be accepted to the platform. Because of the number of respondents of the questionnaire, Green uses only the data submitted to make a recommendation for adding a new manager. Comment by failing to conduct any additional outside review for the information to verify what was submitted through the request for proposal. Green has likely not satisfied the requirements of Standards I-VIII. The amount of information required from the outside firm varies among firms. Although the requested information may be comprehensive, Green should ensure sufficient effort is undertaken to verify the submitted information before recommending a firm for inclusion. This requires that he go beyond the information provided by the manager. The request for proposal questionnaire and may include the interviews with interested managers, reviews of regulatory filings, and discussions with the manager's custodian or offer. Example 17, technical model requirements. I'm not going to try to read this word. Jerome Dupont works for the credit research group at XYZ Asset Management. When he is in charge of developing and updating credit risk models in order to perform accurately, his models need to be regularly updated with the latest market data. DuPont does not interact with or manages money for any of the firm's clients. He is in contact with the firm's U.S. corporate bond fund manager, John Smith, who has only very superficial knowledge of the model and who from time to time asks very basic questions regarding the output recommendation. Smith does not consult DuPont with respect to finalizing his clients' investment strategies. DuPont recently assigned objectives is to develop a new emerging market corporate credit risk model. The firm is planning to expand into emerging credits, and the development of such a model is a critical step in the process because Smith seems to follow the model's recommendation without much concern for its quality. As he develops his clients' investment strategies, DuPont decides to focus his time on the development of the new emerging market model and neglects to update the U.S. model. After several months without regular updates, DuPont's diagnostic statistics starts to show alarming signs with respect to the quality of the U.S. credit model. Instead of conducting the long and complicated data update, DuPont introduces new codes into his model with some limited new data as a quick fix. He thinks these changes will address the issues without needing to complete the full data update, so he continues working on the new emerging market model. Several months following the quick quote-unquote fix, end quote, another set of diagnosis statistics review nonsensical results, and DuPont realizes that his earlier changes contains an error. He quickly corrects the error and alerts Smith. Smith realizes that some of the prior trades has performed were due to erroneous model results. Smith rebalances the portfolio to remove the securities purchases on the basis of the questionable results without reporting the issue to anyone else. Comment: Smith violated Standards IV-A because exercising diligence, independence, and thoroughness in analyzing investments, making investment recommendations, and taking investment actions means that members and candidates must understand the technical aspect of the products they provide to clients. Smith does not understand the model he is relying on to manage money. Members and candidates should also make reasonable inquiries into the sources of the accuracy of all data used in completing their investment analysis and recommendation. DuPont validated Standards V-A even if he does not trade securities or make investment decisions. DuPont's models give investment recommendations, and DuPont is accountable for the quality of these recommendations. Members and candidates should make reasonable efforts to test the output of pre-incorporated the tools into their decision-making process. See also Standards 5B, communication with clients and prospective clients. Standards 5B, communication with clients and prospective clients. I'll continue the reading in our next session. Continued reading of the CFA program curriculum. Standards 5B, communication with clients and prospective clients. Members and candidates must disclose to clients and prospective clients the basic format of general principles of the investment process they use to analyze investments, select securities, and construct portfolios. That must promptly disclose any changes that might materially affect these processes. Disclose to clients and prospective clients significant limitations to risks associated with the investment process. Use reasonable judgment in identifying which factors are important to their investment analysis, recommendation, or actions, and include those factors in communication with clients and prospective clients. Distinguish between fact and opinion in presentation of investment analysis and recommendation. Highlights informing clients and the investment process in different forms of communication, identifying risks and limitation, report presentation, distinguish between facts and opinions in report. Standards 5B addresses members and candidates' conduct when aspects or with respect to communication with clients, developing and maintaining clear, frequent, and thorough communication practices is critical to providing high quality financial services to clients. When clients understand the information communicated to them, they also can understand exactly how members and candidates are acting on their behalf, which gives clients the opportunity to make well-informed decisions about their investments. Such understanding can be accomplished only through clear communication. Standards I-VIII states that members and candidates should communicate in a recommendation that factors that were instrumental in making the investment communication a critical part of this recommendation is to distinguish clearly between opinion and facts. In preparing a research report, the member or a candidate must present the basic characteristics of the securities being analyzed, which will allow the readers to evaluate the report and incorporate information to the readers deemed relevant to his or her investment decision-making process. Similarly, in preparing a recommendation about, for example, an asset allocation strategy, alternative investment vehicles, or structured investment products, the member or candidate should include factors that are relevant to the asset classes that are being discussed, follow-up communication, or significant changes in the risk characteristics of a security or asset strategy is required. Providing regular updates to any changes in the risk characteristics is recommended. Informing clients of the investment process, members and candidates must adequately describe to clients and prospective clients the manner in which they conduct the investment decision-making process, such as disclosures should address factors that has positive or negative influences on the recommendations, including significant risks and limitation for the investment process used. The member or candidate must keep clients and their interest parties informed on an ongoing basis about changes to the investment process, especially newly identified significant risks and limitations. Only by thoroughly understanding the nature of the investment product or service can a client determine whether changes to the product or service should materially affect his or her investment objectives. Understanding the basic characteristics of investment is of great importance in judging the suitability of the investment on a standalone basis, but it is especially important in determining the impact each investment will have on the characteristics of a portfolio. Although the risk and return characteristics of a common stock might seem to be essentially the same of any investor, when the stock is viewed in isolation, the effect of these characteristics greatly depend on the other investments held. For instance, in the particular stock will represent 90% of an individual's assessment, that a stock's importance in a portfolio is vastly different to an investor who highly diversified portfolio, whom the stock will represent only 2% of the holdings. A firm's investment policy may include the use of outside advisors to manage various portions of the client's assets. Under management, members and candidates should inform the client about the specialization or diversification expertise provided by the external advisors. This information allows clients to understand the full mix of products and strategies being applied that may affect the investment objectives. Different forms of communication for purposes of Standards I-VIII. Communication is not confined with a written report of a type traditionally generated by an analyst research of a security or company or industry. Presentation of information can be made through or via any means of communication, including in-person recommendations or descriptions, telephone conversations, media broadcasts, or transmission by computer, e.g. on the internet. Computer and mobile device communications have rapidly evolved over the past few years. Members and candidates using any social media services to communicate business information must be diligent in their efforts to avoid unintended problems, because these services may not be available to all clients. When providing information to clients through new technologies, members and candidates should take reasonable steps to ensure that such delivery will treat all clients fairly and, if necessary, be considered publicly disseminated. The nature of client communication is highly diverse, and one word, buy or sell, to in-depth reports of more than 100 pages. Communication may contain a general recommendation about the market, asset allocation, or classes of investment, e.g. stocks, bonds, or real estate, or may relate to a specific security in recommendations, or contained in capsule form, such as recommended stock lists. Members and candidates should notify clients and additional information and analysis are available from the producer of the report. Identifying risks and limitations, members and candidates must outline to clients and prospective clients significant risk and limitation of the analysis constrained to their investment products and recommendations. The type of nature of significant risks will depend on the investment process the members and candidates are following and on the personal circumstances of the client. In general, the use of leverage constitutes a significant risk and should be disclosed. Members and candidates must adequately disclose the general market-related risks and the risks associated with use of forex financial instruments that are deemed significant. Other types of risks that members and candidates may consider disclosing includes but are not limited to counterparty risk, country risk, sector or industry risk, security-specific risk, and credit risk. Investment securities and vehicles may have limiting factors that influence a client's or prospective client's investment decisions. Members and candidates must report to clients and prospective clients the existence of limitations significant to the decision-making process. Examples of such factors and attributes includes but are not limited to investment liquidity and capacity. Liquidity is the ability to liquidate an investment on a timely basis at a reasonable cost. Capacity is the investment amount being which returns will be negatively affected by new investments. The appropriateness of risks disclosure should be assessed on the basis of what is known at the time of investment actions was taken, often called the ex-ante basis. The ex-ante basis. Members and candidates must disclose significant risks known to them at the time of the disclosure. Members and candidates cannot be expected to disclose risks they are unaware of at the time of recommendation or investment actions are made. In assessing compliance with Standards I-VIII, it is important to establish knowledge of a purported significant risk or limitation. A one-time investment loss that occurs after disclosure does not constitute a potent factor in assessing whether significant risks and limitations were properly disclosed. Having no knowledge of a risk or limitation that subsequently triggers a loss may reveal a deficiency in the diligence and reasonable basis of the research of the member or candidate may not reveal a breach of Standards I-VIII. Reporting presentation. Once the analytical process has been completed, the member or candidate who prepares the report must include those elements that are important to the analysis conclusions of the report so that the reader can follow the changes and report's reasoning. The report writer who has done adequate investigation may emphasize certain areas, touch briefly on others, and omit certain aspects deemed unimportant. For instance, a report may dwell on a quarterly earning release or new product introduction and omit the matter as long as analysis clearly stipulates the limits of the scope of the report. Investment advice based on quantitative research and analysis must be supported by readily available reference material and should be applied to a manner consistent with previously applied methodology. If changes in methodologies are made, then should be highlighted. They should be highlighted. Distinction between facts and opinions in report. Standards I-VIII requires that opinion to be separated by fact. Violations often occur when reports fail to separate the past from the future by not indicating that earning estimates changes in outlook for dividends or future market price informations are opinions subject to future circumstances. In the case of complex quantitative analysis, members and candidates must clearly separate from statistical conjunctions and should identify and the knowing limitations of analysis. Members and candidates may violate Standards I-VIII by failing to identify the limitations of statistical developed projections. Because such omission levels readers are aware of the limits of the published projections, members and candidates should explicitly discuss with clients and prospective clients the assumptions used in the investment models and the processes to generate the analysis. Caution should be used in promoting the perceived accuracy of any model or process to client, because the ultimate output is merely an estimate of future results and is not a certainty. Recommended procedures for compliance, because the section for relevant factors is an analytical skills determination of whether a member or candidate has used reasonable judgment in excluding and including information in research report depends heavily on case-by-case review rather than a specific checklist. Members and candidates should encourage their firms to have a rigorous methodology for reviewing research that is created for publication and dissemination to clients to assist in the after the fact review of a report. The member or candidate must maintain records indicating the nature of the research and should, if asked, be able to supply additional information to the client or any of the reports covering factors not included in the report. Application of standard example 1, sufficient disclosure of investment systems. Sarah Williamson, Director of Marketing for Country Technicians Incorporated, is convinced that she has found the perfect formula for increasing Country Technicians' income and diversifying its product base. Williamson plans to build a Country Technician's reputation as a leader, as a leading money manager by marketing the exclusive and expensive investment advisors letters to high net worth individuals. Once hitched its plans to its complexity of the Country Technician investment system, a combination of technical trading rules based on historical price and volume fluctuations and portfolio constructions, rules designed to minimize risk, to simply the newsletter. She decides to include only each week's top 5 buy and sell recommendations and leave out details of the valuation models and portfolio structuring schemes. Williamson's plans for the newsletter violate standards 5B. Williamson needs not describe the investment systems in detail in order to implement the advice effectively, but she must inform clients of Country Technicians' basic process and logic. Without understanding the basis for recommendations, clients cannot possibly understand the limitations or the inherent risks. Example 2, providing opinions as facts. Richard Docks is a mining analyst for East Bank Securities. He has just finished his report on Boise's main minerals, including in his report is his own assessments of a geological extent of mining reserves likely to be found in the company's land. Docks completely this calculation on the basis of the core samples from the company's latest drillings. According to Docks' calculation, the company has more than 50,000 ounces of gold on the property. Docks concluded the research report as follows: based on the facts that a company has 50,000 ounces of gold to be mined, I recommend a strong buy. A comment: if Docks issues the report as written, he will violate standards 5B. His calculations of the total gold reserves for the property based on the company's recent sample drilling is a quantitative opinion, not a fact. Opinions must be distinguished from fact in research reports. Example 3, proper description of security. Ovilia Thompson, an analyst at Government Brokers Incorporated, which is a brokerage firm specializing in government bond trading, has produced a report that describes an investment strategy designed to benefit from an expected decline in U.S. interest rates. The firm's derivatives products group has designed a structured product that will allow the firm's clients to benefit from the strategy. Thompson's report describing the strategy indicated that high returns are possible if various scenarios from declining interest rates are assumed, citing the proprietary natures of the structured products underlying the The strategy, the report does not describe in detail how the firm is able to offer such returns or the related risks in the scenarios, nor does the report address how likely returns of the strategy if, contrary to expectations, interest rates rise. Thomas has violated Standards I-VIII because her report fails to describe properly the basic characteristics and the actual and implied risks of the investment strategy, including how the structure will create the degree of which leverage will embedded in the structure. The report should include a balance of discussions on how the strategy would perform in the case of rising as well as falling interest rates, preferably illustrating how the strategies might be expected to perform in the event of reasonable variety of interest rates and credit spread scenarios. The liquidity issues are relevant with regard to the valuation of neither the derivatives or the underlying securities provisions to the firm has made to address those risks should also be disclosed. Example 4, notification of fund mandate changes. May and Associates is an aggressive growth manager that has represented itself since its inception as a specialist and investing in small cap U.S. stocks. One of May's selections criteria is a maximum capitalization of $250 million for any given company. After a string of successful years of superior performance relative to its peers, May has expanded the client base significantly to the point where its asset management now exceeds $3 billion. For liquidity purposes, May's chief investment officer, CIO, decides to lift the maximum permissible market cap to $500 million and change the firm's sales and marketing literature according to informed prospective clients and third-party consultants. Comment: May's CEO is correct about informing potentially interested parties as the change investment process. He may also notify May's existing clients. Among the latter group may also be a number of clients who are not retained who are not only retained May as a small cap manager, but also retained mid cap and large cap specialists in multiple manager approach. Such clients can regard May's change of criteria as a style change that distorts their overall asset allocation. Example 5, notification of a fund mandate change. Rather than lifting the ceiling for its universe from $250 million to $500 million, May and Associates extends its small cap universe to include a number of non-U.S. companies. Standards I-VIII requires that May's CIO advise May's clients of this change because the firm has been retained by some clients specifically for its prowess at investing in U.S. small cap stocks. Other changes that require client notification are introduced derivatives to emulate a certain market sector or relative various other constraints such as portfolio data. In such cases, members and candidates must disclose changes to all interested parties. Example 6, notification to changes to the investment process. RJZ Capital Management is an active value system equity manager that selects stocks by using a combination of 4 multifactor models. The firm has found favorable results when back testing the most recent 10 years of available market data of a new divided discount model, DDM, designed by the firm. The model is based on projected inflation ratings, earning growth rates, and interest rates. The president of RJZ RJZ, Jay-Z decides to replace its simple model and uses price to trailing 12 months earnings with the new DDM. Comment because the introduction of new and different valuation models represents a material change in the investment process. RJZ's president must communicate the changes to the firm's clients. RJZ is moving away from the model based on hard data toward a new model that is at least partly dependent on the firm's forecasting skills. Clients would likely view such a model as significant changes rather than more refinement of RJZ's processes. Example 7, notification of changes of investment process. RJZ's capital management loses the chief architect of its manufacturer valuation systems without informing its clients. The president RJZ decided to redirect the firm's talents and resources towards developing a product for passive equity management. A product will emulate the performance of a major market index by failing to disclose to clients substantial changes in investment process. The president of LJZ has violated Standards I-VIII. Example A, notification of changes in the investment process. At Fundamental Asset Management Incorporated, the responsibility of selecting stocks for addition to the firm's approval list has just shifted from individual security analysis to a committee consistent of the research directors and 3 senior portfolio managers. Ellen Morose, a portfolio manager for Fundamental Asset Management, thinks this change is not important enough to communicate to her clients. Morales must disclose this process change to all her clients. Some of her fundamental clients might be concerned about the morale and motivation among the firm's best research analysts after such a change. Moreover, clients might change the stock picking tracks records of those portfolio managers and might even want to monitor the situation closely. Example 9, sufficient disclosure of investment information. Amanda Chin is an investment director for Diversified Asset Management, which manages the endowment of charitable organization. Because a recent staff departure, diversification has been limited to its direct investment focus to large cap securities and supplements the needs for small cap and mid cap management by hiring outside fund management managers. And describing the planned strategy change in the charity, Chin's update later states, as investment director, I will directly oversee the investment terms, managing an endowment largest capitalization allocations. I will coordinate the selection and ongoing review of external managers responsible for allocations to other classes. The letter also describes the reasons for the change and the characteristics external managers must have to be considered. A comment, Standards I-VIII requires that disclosures of the investment process used to construct a portfolio of the fund, changing the investment processes for managing all clients' investments within the firm to the communication of 2 clients. Chin and her firm have embraced the principles of Standards I-VIII by providing their clients with relevant information. The charity can now make a reasonable decision about whether Diversified Asset Management remains an appropriate manager of its fund. Example 10, notification of changes to the investment process. Miguel Papis is the chief investment officer of his state's retirement fund. The fund has always used outside advisors for the real estate allocation, and this information is clearly presented and all fund communication. Thomas Nagel, a recognized sell-side research analyst and Papis' business school classmate, recently left the investment bank he worked for to start his own asset management firm. Acceptable Real Estate. Nagel is trying to build his asset assets under management and contact Papis about gaining some of the retirement funds allocations. In the previous 4 years, the performance of the retirement fund's real estate investments was in line with the fund's benchmark, but was not extraordinary. Papis decides to help out his old friend, and also to seek better returns by moving the real estate allocations to accessible. The only notice of this change is advisor appears to appear annual reports to the listing of associated advisors. Comment: Papis has violated Standards I-VIII. He attempted to hide the nature of this decision to change external managers by making only a limited disclosure. The plan recipients and the fund's trustees needs to be aware when changes are made to ensure that operation procedures are being followed. Since also Standards 4C responsibilities and supervisors, Standards 5A diligence and reasonable basis, and Standards 6A disclosure of conflict. Example 11, notification of errors. Jerome DuPont works for a credit research group at XYZ Asset Management, where he is in charge of developing and updating credit risk models in order to perform accurately. His models need to be regularly updated with the latest market data. DuPont does not interact with or manage money of any of the firm's clients. He is in contact with the firm's U.S. corporate bond fund manager, John Smith, who has only very superficial knowledge of the model, and who from time to time asks very basic questions regarding the output recommendations. Smith does not consult DuPont with respect to finalizing the client investment strategies. DuPont recently assigned objectives is to develop a new emerging market corporate credit risk model. The firm is planning to expand into emerging credit, and the development of such a model is a crucial step in the process, because Smith seems to follow the model of recommendation without much concern for its quality. As he develops clients' investment strategies, DuPont decides to focus his time on the development of new emerging market models and neglects to update the U.S. model. After several months without regular updates, DuPont's diagnostic statistics starts to show alarming signs with respect to the quality of U.S. credit models. Instead of conducting the long and complicated data update, DuPont introduces new codes to his method with some limited new data. As a quick fix, he thinks this change will address the issues without needing to complete a full data update. So he continues working on the new emerging market model. Several months following the quick fix, another set of diagnosis statistics reveal nonsensical results, and DuPont realizes that his earlier changes contains an error. He quickly corrects the error and alerts Smith. Smith realizes that the same of the prior trades has performed were due to erroneous model results. Smith rebalances the portfolio and removes a security purchase on the basis of questionable results without reporting the issue to anyone else. Smith violated Standards I-VIII by not disclosing the material error in the investment processes. A client should have been informed about the error, and the corrective actions of the firms will undertake it on their behalf. See also Standards I-VIII, diligence and reasonable basis. Example 12, notification of risk and limitations. Quantitative analyst Yuri Yakovlev has developed an investment strategy that selects small cap stocks on a basis of quantitative signals. Yakovlev's strategies typically identifies only small number of stocks, 10 to 20, and tends to be illiquid. But according to his back tests, the strategy generates significant risk-adjusted returns. The partners in the brackets By according to his back test, the strategy generates significant risk-adjusted returns. The partners at Yarkov's firm, QSC Capital, are impressed by these results. After a thorough examination of the strategy's risks, stress testing, historical back testing, and scenario analysis, QSC decides to seed the strategy with $10 million of internal capital in order for Yakov to create a track record for the strategy. After 2 years, the strategy has generated performance returns greater than the appropriate benchmark, and the Sharpe ratio of the fund is close to 1.0. On the basis of these results, QSC decides to actively market the fund to large institutional investors while creating the offering materials. Yaklov informs the marketing team that the capacity of the strategy is limited. The extent of the limitation is difficult to ascertain with precision. It depends on market liquidity and other factors in his models that can evolve over time. Yaklov indicates that given the current market conditions, investments in the fund beyond $100 million of capital can become more difficult and negatively affect expected fund returns. Alan Wallner, the manager of the marketing team, is a partner with 30 years of marketing experience and explains to Yaklov that those are complex technical issues and will muddy the marketing meetings. According to Wellner, the offering material should focus solely on the great track record of the fund. Yaklov does not object because the fund has only US $12 million in capital, very far from the US $100 million threshold. Yaklov and Wellard have not appropriately disclosed the significant limitation associated with the investment products. Yaklov believes this limitation, once reached, will materially affect the returns of the fund. Although the fund is currently far from the 100 million mark, currently and prospective investors must be made aware of the the capacity issue. Its significant limitations on capacity to grasp the clients do not have the technical background required to understand them. Yaklov and Wellner should either educate the clients or ascertain whether the fund is suitable for each client. Example 13, notification of risk and limitation. Brickwell Advisors offers investment advisory services mainly in South American clients. Julieta Ramon, a risk analysis at Brickwell, describes to clients how the firm uses value at risk VAR analysis to track the risk of its strategies. Roman assures clients that calculating a VAR at a 99% confidence level using a 20-day holding period and applying a methodology proven based on an ex-ante Monte Claro simulation is extremely effective. The firm has never had a loss greater than those predicted by the VAR analysis. Ramon has not significantly... I say Ramon because I speak Spanish and I can read the names because this is a Latin American or South American client. Okay. Has not significantly communicated the risk associated with the investment process to satisfy the requirement of Standards I-VIII. The losses predicted by VAR analysis depend greatly on the input used in the model. The size and probability of losses can differ significantly from what an individual model predicts. Ramon must disclose how the inputs were selected and the potential limitations and risks associated with the investment strategy. Investment example 14, notification of risk and limitation. Lily Smith attends an investment conference and noticed that John Baker, investment manager with Baker Associates, attracts a great deal of attention from the conference participants on the basis of her knowledge of Baker's reputation and the interest he receives at the conference. Smith recommends adding Baker's Associate to the approved manager platform. Her recommendation through the approval committee includes the statement: John Baker is well respected in the industry, and his insights are consistently sought after by investors. Our clients are sure to benefit from investing with Baker Associates. Comment: Smith is not appropriately separating fact from her opinions in her recommendation and to include the manager within the platform. Her actions will conflict with the requirements of Standards I-VIII. Smith is replying on her opinion about Baker's reputation and the fact that many attendees were talking with him at the conference. Smith should also review the requirements of Standards 4A regarding reasonable basis and determining 5A regarding reasonable basis and determining the level of review necessary to recommend Baker's Associates. Example 5C. Record retention: member and candidates must develop and maintain appropriate records to support their investment analysis, recommendations, actions, and other investment-related communication with clients and prospective clients. Highlight new media records. Records are properly of the firm. A property of the firm. And lastly, local requirements. Members and candidates must retain records that substantiate the scope of their research and reasons for their actions and conclusions. The retention requirements applies to decisions to buy or sell securities, as well as reviews undertaken that do not lead to a change in position. Which records are required to support recommendations or investment actions depend on the role of the member or candidate in the investment decision-making process. Records may be maintained either by hard copy or electronic form. Some examples of supporting documents that assist the members or candidates in meeting the requirements for retention are as follows: personal notes from meetings with the covered company, press releases, or presentations issued by covered companies, computer-based models, inputs and analysis, computer-based models, input parameters, risk analysis of security impacts on portfolios, selection criteria for external advisors, notes from clients from meetings to review investment policy statements and outside research reports, news media records, the increased use of news and involving technological formats, e.g. social media for gathering the sharing information creates new challenges in maintaining the appropriate records and files. The nature of our format of the information does not remove a member or candidate's responsibility to maintain a record of information used in his or her analysis or communicated to clients. Members and candidates should understand that although employers and local regulators are developing digital media retention policies, these policies may lag behind the advent of new communication channels. Such lag places greater responsibilities on individuals to ensuring that all relevant information is retained. Examples of non-print media formats that should be retained includes but are not limited to email, text messages, blog posts, and Twitter posts. Records are property of the firm. As general matter, records creates as members or candidates' professional activity on behalf of his or her employer are the property of the firm. When a member or a candidate leaves a firm to seek other employment, the member or candidate cannot take the property of the firm, including original forms or copies of supporting records of the members or candidates' works to the new employer without the express consent of the previous employer. The member or candidate cannot use historical recommendations or research reports created at the previous firm because the supporting documents are unavailable for future use. The member or candidate must recreate the supporting records at the new firm with information gathered through public sources or directly from the covered company and not memory or sources obtained at the previous employer. Local requirements. Local regulatory often imposes requirements on members and candidates and their firms related to record retention that must be followed. Firms may also implement policies detailing the applicable time frame for retaining research and client communication records. Fulfilling such regulatory and firm requirements satisfy the requirements of Standards I-VIII. In the absence of regulatory guidelines or firm policy, CFA Institute recommends maintaining records for at least 7 years. Now that's a long time, man. CFA Institute recommends maintaining records for at least 7 years. Man, okay. Now, that's a lot of paperwork that has to be maintained. Recommended procedures for compliances, the responsibilities to maintain records that support investment actions generally falls with the firm rather than individual. Members and candidates must, however, achieve research note and other documents either electronically or in hard copy that supports their current investment related communications. Doing so will assist their firms in complying with requirements or preservation of internal and external records. Application of a standard example 1 record retention and IPO objectives and the recommendations. One of Nicholas Lindstrom's client is updated by the negative investment returns of his equity portfolio. The investment policy statement of the client requires that the portfolio managers follow a benchmark-oriented approach. The benchmark for the client includes a 35% investment allocation in the technology sector. The client acknowledges that this allocation was appropriate, but over the past 3 years, technology stocks has suffered severe losses. The client complains the investment manager for allocating so much money in this sector. For Lindstrom, having an appropriate record is important to show that over the past 3 years, the portion of technology stock in the benchmark index was 35%. And called for the IPS. Lindstrom should also have the client's IPS stating that the benchmark was appropriate for the client's investment objectives. He should also have records indicating that the investment has been explained appropriately to the client and that the IPS was updated on a regular basis. Taking these actions, Lindstrom would be in compliance with Standards I-VIII. Example 2 record retention and research processes. Malcolm Young is a research analyst who writes numerous reports rating companies in luxury retail industry. His reports are based on a variety of sources, including interviews with company managers, manufacturers, and economists. One side company visits customer surveys and secondary research from analysts covering related industries. Comment: Young must carefully document and keep copies of all the information that goes into reports, including the secondary and third-party research for other analysts. Failure to maintain such files will violate Standards I-VIII. Example 3: records as firms, not employees' property. Martin Blake develops an analytical model while he is employed at Green Partners Investment Management, LLP, GPIM. While at the firm, he systematically documents the assumptions that made up the models, as well as his reasoning behind the assumptions. As a result of the success of his models, Blake is hired to be the head of the research department of one of GPIM's competitors. Blake takes copies of the records supporting his models to the new firm. The records created by Blake supporting the research model he developed at GPIM are the records of GPIM. Taking the documents with him to his new employer without GPIM's permission violates Standards I-VIII. To use the model in the future, Blake must recreate the records supporting his model with a new firm. Standard 6, conflict of interest. Standard 6A, disclosure of conflict. Members and candidates must make a full and fair disclosure of all matters that could reasonably be expected to impair their independence and objectivity, to interfere with respective duties to the client, prospective clients, and employers. Members and candidates must ensure that such disclosures are prominent and delivered in plain language and communicate the relevant information effectively. Guidance highlights disclosure of conflicts to employers, a disclosure to clients, cross-departmental conflicts with stock ownership, conflicts of as a director. Best practice is to avoid actual conflicts or the appearance of conflict of interest when possible. Conflicts of interest often arise in the investment profession. Conflicts can occur between investors, of clients, interests of employers, and members and candidates' own personal interests. Common sources of conflict are compensation structures, especially incentives and bonuses structures that provide immediate returns for members and candidates with little or no consideration with long-term value creation. Identifying and managing these conflicts is a critical part of working in the investment industry and can take many forms. When conflict cannot be reasonably avoided, clear and complete disclosure to their existence is necessary. Standards I-VIII protects employers and their investors by requiring members and candidates to fully disclose to clients, potential clients, and employers all actual and potential conflicts of interest. Once a member or candidate has made full disclosure, the member or candidate's employers, clients, and prospective clients will have the information needed to evaluate the objectivity of the investment advice or actions taken on their behalf. To be effective, disclosures must be prominent and must be made in plain language and in a manner designed to effectively communicate the information. Members and candidates have the responsibility to determine how often and in what manner and in what particular circumstances the disclosures of conflicts must be made. Best practices dedicated updates disclosure when the nature of a conflict of interest changes materially. For example, in the nature of a conflict of interest worsens through the introduction of bonuses based on each quarterly profits as the opposed annual profits, and making these updating disclosures, the conflicts of interest members and candidates should err on the side of caution to ensure the conflicts are effectively communicated. Disclosure of conflict to employers. Disclosure of conflict to employers may be appropriate in many instances when reporting conflicts of interest to employers. Members and candidates must give their employers enough information to assess the impact of conflict. By complying with employer guidelines, members and candidates allow their employers to avoid potentially embarrassing and costly ethical and regulatory violations. Reporting situations, including conflicts that would interfere with rendering unbiased investment advice, and conflicts that would cause a member or a candidate to act not in the employer's best interest. These same circumstances that generate conflicts to be reported to clients and prospective clients also would dictate reporting and employer ownership of the stock analyzed and recommended. The participation on outside boards and financial or other pressures that could influence a decision and are to be promptly reported, and the employers so that their impact can be assessed and a decision on how to resolve the conflicts can be made. Interesting. The mere appearance of a conflict of interest may create problems for members, candidates, and their employers. Therefore, many conflicts previously mentioned could be explicitly prohibited by an employer. For example, many of the conflicts previously mentioned could be explicitly prohibited by an employer. For example, many employers restrict personal trading, outside board membership, and related activities to prevent situations that might not normally be considered problematic from conflict of interest point of view, but that could give appearance of conflicts of interest. Members and candidates must comply with these restrictions. Members and candidates must take reasonable steps to avoid conflicts, and if they occur inadvertently, must report them promptly so that the employers and the members or candidates can resolve them as quickly and as effectively as possible. Standards I-VIII also deals with a member or candidate's conflict of interest that might be detrimental to the employer's business. any potential conflict situation that could prevent clear judgment about or for commitments to the execution of a member or candidate's duties to the employers should be reported to the members or candidates' employers and promptly resolved. Disclosure to clients, members, and candidates must maintain their objectivity when rendering investment advice or taking investment actions. Investment advice or actions may be perceived to be tainted in numerous situations. Can a member or candidate remain objective if on behalf of the firm the member or candidate obtains or assists in obtaining fees for services? Can a member or candidate give objective advice if he or she owns the stock in the company and is subject to an investment recommendation, or a member or candidate has a close personal relationship with the company's managers? Require members and candidates to disclose all matters that reasonably could be expected to impair the member or candidate's objectives. Allows prospective clients to judge motives and possible biases for themselves. Often in investment industry, a conflict or the perception of a conflict cannot be avoided. The most obvious conflicts of interest, which should always be disclosure, are relationships between an issuer and the member or candidate, or his or her firm, such as the directorship or consultancy by a member, investment banking, underwriting, or financial relationship, and broker/dealer, market making activities, a material beneficial ownership of stocks from the purpose of Standards I-VIII members and candidates beneficially own securities or other investments if they have a direct or indirect pecuniary interest in the security, have the power to vote or direct the voting of the share of the security investment, or in the power of dispose or direct the disposition of the security or investment. A member or candidate must take reasonable steps to determine whether a conflict of interest exists and disclose to clients any known conflicts of a member or candidate's firm's disclosure of broker/dealer market making activities alerts clients that a purchase or sale might be made from or to the firm's principal account, and that the firm has a special interest in the price of the stock. Additionally, disclosures should be made to clients regarding the arrangement, sub-adversary arrangements, or other situations involving non-standard fee structures. Equally important is the disclosure of arrangement in which the firm benefits directly from an investment recommendation. As obvious conflict of interest is the rebate of a portion of the service fees. Some classes of mutual fund charges to investors, members, and candidates should ensure that their firms disclosure such relationships so clients can fully understand the cost of the investments and the benefits received by their investment manager or employer. Cross-departmental conflicts. Other circumstances can arise to actual or potential conflicts of interest. For instance, a sell-side analyst working for a broker/dealer may be encouraged not only by members of his or her own firm, but by corporate issuers themselves, or write research reports about particular companies. The buy-side analyst is likely to be faced with similar conflicts as banks and exercise their underwriting and security dealing powers, and marketing divisions may ask an analyst and recommended stock of a certain company in order to obtain businesses from the company. A potential for the conflict of interest also exists with broker-sponsored limited partnerships formed to invest in ventures and capital. Increasing members and candidates are expected not only to follow issues from these partnerships once they are offered in the public, but also to promote the issues in the secondary market after public offerings. Members and candidates are their firms, and their firms should attempt to resolve situations presenting potential conflicts of interest or disclose them in accordance with the principles set forth by Standards I-VIII. Conflicts with stock ownership. The most prevalent conflict requires disclosure underwriting stock 6A. If a member or candidate's ownership of a stock and company that he or she recommends the conflicts the two clients or the clients hold clearly, the easiest method for preventing a conflict is to prohibit members and candidates from owning any such securities. But this approach is overly burdensome and discriminates against members and candidates. Therefore, sell-side members and candidates should disclose any mutually beneficial ownership interest in membership, and candidates should disclosure any material beneficial ownership interest in a security or other investments that the member or candidate is recommending. Buy-side members and candidates should disclose their procedures for reporting investments for personal transactions, conflicts arising from personal investments, and discuss more fully in the guidance of Standards I-VIII. Conflict as a director. A service as a director poses three basic conflicts of interest. First, a conflict may exist between the duties owed to clients and duties owed to shareholders of the company. Second, investment personnel who serve as directors may receive the securities or options to purchase securities of a company or serving the board, which could raise questions about trading auctions and might increase the value of these securities. Third, board services creates the opportunity to receive material non-public information involving the company. Even though the information is confidential, the perception can be informed that not available to public is because communicated to directors, firms, whether a broker, an investment advisor, or other type of organization with members or candidates providing investment services to serve the director as a member or isolated making investment decision making by a firewall or similar restrictions. Okay, I'll continue reading Standards 6B, priority of transaction next. And yeah, I do hope these readings are helpful. Okay, I'll see you guys next time. Continued reading of CFA Level 1 Program Curriculum, Standards 6B, Priority of Transactions. Investment transactions for clients and employers must have priority over investment transactions in which a member or candidate is the beneficial owner. Guidance highlights avoid potential conflicts. Personal trading secondary to trading for clients. Standards for non-public information, impact on all accounts with beneficial ownership. Standards 6B reinforces the responsibility of members and candidates to give the interests of their clients and employers priority over their personal financial interests. This standard is designed to prevent any potential conflicts of interest or the appearance of the conflicts of interest with respect to personal transactions. Client interests have priority. Client transactions must take a procedure over transactions made on behalf of the member or candidate's firm or personal transactions. Avoiding potential conflicts. Conflicts between conflicts of interest and an investment professional's personal interest may occur. Through conflicts and interest exists. Nothing is inherently unethical about individual managers, advisors, or mutual fund employees about money from personal investments as long as 1. The client is not disadvantaged by the trade, 2. The investment professional does not benefit personally from trades undertaken for clients, and 3. The investment professional complies with applicable regulations requirements. Some situations occur where a member or a candidate may need to enter a personal transaction that runs counter to current recommendations or what the portfolio manager is doing for client portfolios. For example, a member or a candidate may be required at some point to sell an asset to make a college tuition payment or a down payment on a home. To meet a margin call or so on, the sale may be contrary to the long-term advice the member or candidate is currently providing to the to clients. In this situation, the same three criteria as given in the preceding paragraph should be applied in the transaction so that it is not violating in Standard 6B. Personal trading secondary to trading of clients. Standard 6B states that transactions for clients and employers must have priority over transactions in securities or other investments for which a member or candidate is the beneficial owner. The objectives of the standard is to prevent personal transactions and adversely affecting the interests of clients or employers. A member or a candidate having the same investment positions or being co-invested with clients does not always create a conflict. Some clients in certain investment situations require members or candidates to have aligned interests. Personal investment positions or transactions for members or candidates or their firms should never, however, adversely affect the client's investments. Standard for non-public information, Standard 6B, covers the activities of members and candidates who have knowledge of pending transactions that may be made on behalf of their clients or employers who have access to non-public information during the normal preparation of research recommendation or who take investment actions. Members and candidates are prohibited from conveying non-public information to any person whose relationship to the member or candidate makes the member or candidate a beneficial owner of the person's securities. Members and candidates must not convey this information to any other person if the non-public information can be deemed material. Impact on all accounts with beneficial ownership. Members or candidates may undertake transactions in accounts for which there are a beneficial owner only if their clients and employers have adequate opportunities family accounts that are clients' accounts should be treated like any other firm account and should neither be given special treatment nor be disadvantaged because of the family relationship. If a member or candidate has the beneficial ownership in the account, however, the member or candidate may subject plea clearance or reporting requirements to the employer for applicable laws. Recommended procedures for compliance, policies and procedures designed to prevent potential conflicts of interest and even the appearance of conflict of interest with respect to personal transactions are critical to establishing investor confidence in the securities industry. Therefore, members and candidates should urge their firms to establish such policies and procedures because investment firms are vary greatly in assets under management, types of clients, numbers of employees, and so on. Each firm should have policies regarding personal investing that are best suited for the firm. Members and candidates should then prominently disclose those policies to clients and prospective clients. The specific provisions for each firm standards may vary. Most standards vary, but all firms should adopt a certain basic procedures to address the conflict areas created by personal investing. These procedures include the following: limited participation in equity IPOs. Some eagerly await IPO rise significantly in value shortly after the issues is brought to market. Because the new issues may be highly attractive and sought after, the opportunity to participate in IPOs may be limited. Therefore, purchases of IPOs by investment professional creates conflicts of interest in two principal ways. First, participation in an IPO may have an appearance of taking away an attractive investment opportunity for clients for personal gain, a clear breach of duty of loyalty to clients. Secondly, purchase an IPO may have the appearance that the investment opportunities is bestowed as an incentive to make future investment decisions for the benefit of the party providing the opportunity. Members and candidates can avoid these conflicts of appearances of conflicts of interest by not participating in the IPOs. Reliable and systemic reviews procedures should be established to ensure that conflicts relating to IPOs are identified and appropriately dealt with by supervisors. Members and candidates should clear their participation in IPOs, even if situations without any conflicts of interest between a member or candidate participates in IPO. The client's interest, members candidates should not benefit from the positions that their clients occupy in the marketplace through preferred trading and allocation of limited offerings or subscription. Restrictions on private placement. Okay, I stop with the absurd action. Strict limits should be placed on investment personnel acquiring securities and private placements. The appropriate supervisory and review procedures should be established to prevent non-compliance. Firms do not routinely use private placements for clients, e.g. venture capital deals, because the high risk associated with them. Conflicts related to private placements and more significant to members and candidates who manage large pools of assets or act as plan sponsors because these managers may be offered special opportunities, such as private placements as a reward or an enticement for continuing to do business with a particular broker. Participation in private placements raise conflicts of interest issues that are similar to issues surrounding IPOs. Investment personnel should not be involved in transactions, including but not limited to private placement that could be perceived as favors or gifts that seem designed to influence future judgment or to reward past business deals. Whether the venture eventually proves to be good or bad, managers have an immediate conflict concerning private placement opportunities if and when an investment goes public. Participants in private placements have an incentive to recommend the investments to clients regardless of the suitability of the investments for their clients. Doing so increases the value of the participants' personal portfolios. Establishing a blackout/restricted periods. Investment personnel involved in investment decision-making process should establish blackout periods prior to trades for clients, so the managers cannot take advantage of their knowledge of client activity by front-running client trades. Trading for one person's account before trading for client account. Individual firms must decide who within the firm should be required to comply with the trading restrictions. At a minimum, all individuals who are involved in the investment decision-making process should be subject to the same restricted period. Each firm must determine specific requirements related to blackouts and restriction periods and are most relevant to the firm, while ensuring that procedures are governed by the guidance principles set forth by the code and standards. Size of firms and type of security purchase are relevant factors. For example, in a large firm, a blackout requirement is in effect a total trading ban because the firm is continually trading in most securities. In a small firm, a blackout period will likely be to prevent the investment manager from front running. Reporting requirements. Supervisors should establish reporting procedures and investment personnel, including disclosure of personal holdings / beneficial ownerships, confirmations of trade to the firm and the employee, and plea clearance procedures. Once trading restrictions are in place, they must be enforced, and best methods of monitoring and enforcing procedures to eliminate conflicts of interest in personal trading is through reporting requirements, including the following: 1. Disclosure of holdings in which the employee has a beneficial interest. Disclosure by investment personnel to the firm should be made upon commencement of the employment relationship, at least annually thereafter, to address privacy considerations. Disclose of person holding should be handled in a confidential manner by the firm. Providing duplicate confirmation for transactions. Investment personnel should be required to direct their brokers to supply to firms duplicate copies or confirmations of of all your personal security transactions and copies of periodic statements for all security accounts. The duplicate confirmation requirements has two purposes. One, requirement sends a message that there is independent verification, which reduces the likelihood of unethical behavior, and two, it enables verification for the accounting of the flow of personal investments that cannot be determined from merely looking at holdings. Pre-clearance procedures: investment personnel should examine all planned personal trades to identify possible conflicts prior to execution of trades. Pre-clearance procedures are designed to identify possible conflicts before a problem arises. Lastly, disclosure of policies: members and candidates should fully disclose to investors firms' policies regarding personal investing. The information about employees' personal investment activities and policies will foster an atmosphere of conflict of interest posed by investment personnel's personal trading. The disclosure might provide helpful information to investors. It should not be simply by boilerplate language, such as investment personnel are subject to policies and procedures regarding their personal trading. Yeah. Now I'll use my certain action applications of standards. Example 1, personal trading. Research analyst Marilyn Long does not recommend purchase of a common stock for his employer's account because he wants to purchase the stock personally and does not want to wait until the recommendation is approved. If a stock is purchased by his employer, comment: Long has violated Standard 6B by taking advantage of his knowledge of the stock values before allowing his employer to benefit from this information. Example 2, trading from family member accounts. Carol Baker, a portfolio manager of an aggressive growth mutual fund, maintains an account in her husband's name at several brokerage firms, with which the fund of a number of Bakers other individual clients do a substantial amount of business. Whenever a hot issue becomes available, she instructs the brokers to buy it for her husband's account because such issues normally are scarce. Baker often acquires shares in hot issues, but her clients are not able to participate in them. To avoid violating Standards 6B, Baker should acquire shares from her mutual fund first and acquire them for her husband's account only after doing so, even though she might miss out on participating in new issues through her husband's account. She also must disclose the trading for her husband's account to her employer because this activity creates a conflict between her personal interest and her employer's interest. Example 3, family account as equals. Aaron Topher, a manager for Esposito Investment Managers. The retirement account established with a firm by her parents. Whosoever IPOs may becomes available, she first allocates shares to her other clients for whom the investment is appropriate. Only then does she place any remaining portions of her parents' account in her parents' account. If the issue is appropriate for them, she has adopted the procedures so that no one can accuse her of favoring her parents. Topher has violated Standards 6B by broaching her duty to her parents by treating them differently from her other accounts simply because of the family relationship. As a fee-paying client of Esposito Investments, Topher's parents are entitled to the same treatment as any other clients of the firm. If Topher has beneficial ownership of the account, however, then the Esposito Investment has pre-clearance and reporting requirements for personal transactions. She may have to pre-clear the trades and report the transactions to Esposito. Example 4, personal trading and disclosure. Gary Michaels is an entry-level employee who holds a low-paying job serving both the research department and the investment management department of an active investment management firm. He purchases sports cars and begins to wear expensive clothes after only a year of employment at the firm. The director of the investment management department, who has a responsibility for monitoring the personal stock transactions of all employees, investigates and discovers Michael has been made substantial investment gains by purchasing stock just before they were put on the firm's recommended buy list. Michael was regularly given the firm's quarterly personal transactions before, but declined to complete it. Michael's violated Standards 6B by placing personal transactions of the head of client's transaction. In addition, his supervisor violated Standards 4C, responsibility of supervisors, by permitting Michael's to continue his performance is assigned task without having assigned the quarterly personnel transaction form. Notes also that if Michael has communicated information about the firm's recommendation to a person who has traded the security, the action will be misappropriation of information and a violation of Standards 2A, material non-public information. Example 5, trading prior to report the simulation. A brokerage insurance analyst, Denise Wilson, makes a closed-circuit TV report to her firm's branches around the country. During the broadcast, she includes negative comments about a major company in the insurance industry. The following day, Wilson's report is printed and distributed to the sales force of public customers. The report recommends that both short-term trades and intermediate investors take profit by selling the insurance company's stock. 7 minutes after the broadcast, however, Ellen Riley, head of the firm's trading department, has closed out a long call position on the stock. Shortly thereafter, Riley established a sizable put position in the stock. When asked about her activities, Riley claimed that she took the actions to facilitate anticipated sales by institutional clients. Riley did not give customers appropriate opportunity to buy or sell in the options market before the firm itself did, but taking actions before the report was disseminated. Riley's firm may have depressed the price of the calls and increased the price of the puts. The firm could have avoided a conflict of interest if it had waited for trades for its own accounts until the client has an appropriate opportunity to receive the simulate Wilson's recommendations. As it is, Riley's actions violated Standards 6B. Standards 6C, referral fees. Members and candidates must disclose to their employers, clients, and prospective clients as appropriate any compensation, consideration, or benefits received from or paid to others for the recommendation of products or services. Guidance Standards 6C states that responsibility of members and candidates to inform their employers, clients, and prospective clients of any benefits received for referral of customers and clients. Such disclosures allow clients or employers to evaluate 1, any partially shown in any recommendation of services, and 2, the full cost of the services. Members and candidates must disclose when they pay a fee to provide compensation to others who have referred prospective clients to a member or a candidate. Appropriate disclosure means that members and candidates must advise the client or prospective client before entry into any formal agreement for services of any benefit given or received for the recommendation of any services provided by the member or candidate. In addition, the member or candidate must disclose the nature of the consideration or benefit, for example, flat fees or percentage basis, one-time or continuing benefits. Based on the performance benefits in the form of provision of research or other non-cash benefits, together with estimated dollar value consideration, includes all fees, whether paid in cash, in soft dollars, or in kind. Or in kind? Is that a typo on behalf of the CFA program? Because I'm pretty sure that's not a word or a phrase that makes logical sense. All right. Recommended procedures for compliance. Members and candidates should encourage their employers to develop procedures related to referral fees. The firm may restrict such fees, and the firm does not adopt a strict prohibition of such fees. The procedures should indicate the appropriate steps for requesting approval. Employers should have investment professional provided to the client notification of approved referral fee programs, and provide the employer regular, at least quarterly updates on the amount and nature of compensation received. Application of standard example 1, disclosure referral fee arrangements and outside parties. Bradley Securities Incorporated, a broker/dealer, has established a referral agreement with Lewis Brothers Limited, an investment counseling firm. In this arrangement, Bradley Securities refer all prospective tax-exempt accounts, including pensions, profit sharing, and endowment accounts, to Lewis Brothers. In return, Lewis Brothers makes available to Bradley Securities on a regular basis the security recommendations and reports of its research staff, which registered a representative of Bradley Security use of serving customers. In addition, Lewis Brothers conducts monthly economic and market reviews for Bradley Security personnel and all stock commission business generated by referral account to Bradley Securities. Willward White, a partner in Lewis Brothers, calculates that the incremental costs involved in the fluctuating of the research department of Bradley Securities are $20,000 US annually. Referrals from Bradley Securities last year result in a fee income of $200,000 US for Lewis Brothers. The directing all stock trades through Bradley Securities results in additional costs to Lewis Brothers clients of US $10,000. Diane Branch, the chief financial officer of Maxwell Incorporated, contacts White and says she is seeking an investment manager for Maxwell profit sharing plan. She adds, my friend Harold Hill at Bradley Securities recommended your firm without qualification, and that's good enough for me. What do we have a deal? White accepts the new accounts but does not disclose his firm's referral arrangement to Bradley Securities. White has violated Standards I-VIII by failing to inform the prospective customer of the referral fee payable in services and commissions for an indefinite period to Bradley Securities. Such disclosures could have caused Branch to reassess Hill's recommendation and make more critical evaluations of Lewis Brothers' services. Example 2, disclosure of interdepartmental referral arrangement. James Handley works for the trust department of Central Trust Bank. He receives compensation for each referral he makes in Central Trust, the brokerage department, and personal finance management, a department that results in a sale. He refers several of its clients to personal financial management department but does not disclose the arrangements within Central Trust to his clients. Comment, Handley has violated Standards I-VIII by not disclosing the referral arrangement Central Trust Bank to his clients. Standards I-VIII does not distinguish between referral programs paid by third parties for referral clients to the third party and internal payments paid within the firm to attract new business to a subsidiary. Members and candidates must disclose all such referral fees. Therefore, Handley is required to disclose at the time of referral any referral fees agreement in place among Central Trust Bank's department. The disclosure should include the nature of the value of the benefits and should be made in writing. Example 3, disclosure referral arrangement and informing firm. Catherine Roberts is a portfolio manager at Katama Investments, an advisory firm specializing in managing assets for high net worth individuals. Katama's trading desk uses a variety of brokerage houses to execute trades on behalf of its clients. Roberts asked the trading desk to direct a large portion of its commissions to Nushin Incorporated, a small broker/dealer ran by one of Roberts' business school classmates. Katama traders have found that Nushin is not very competitive on pricing, and although Nushin generates some research for its trading clients, Katama's other analysts have found most of Nushin's research to be not especially useful. Nevertheless, the traders do as Roberts asks, and in return for receiving a large portion of Katama's business, Yashan recommends the investment services of Roberts and Katama and the wealthiest clients. This arrangement is not disclosed to Katama or the clients referred by Nushin. Robert has violated Standards I-VIII by failing to inform her employer of the referral arrangement. Example, for disclosure of referral agreements and outside organizations. Alex Burrow is a professional manager at Helpful Investments, a local investment advisory firm. Burrow is on the advisory board of his child's school, which is looking for ways to raise money to purchase new playground equipment for the school. Burrow discusses a plan with a supervisor in which he will donate to the school a portion of his service fees from new clients referred by the parents of students at the school. Upon getting the approval from Helpful, Burrow presents the idea to the school's advisory board and directors. The school agrees to announce the program at the next parent event and directors, and ask Burrow to provide the appropriate written material to be distributed. A week following the distribution of the flyers, Burrow receives the first school-related referral. In establishing a client investment policy statement, Burrow clearly discusses the school's referral and outlines the plan for distributing and the donation back to the school. A comment: Burrow has not violated Standards I-VIII because he secured the permission of his employer, Helpful Investments, and the school prior to beginning the program, and because he discusses the arrangement with the client at the time the investment policy statements were designed. Example 3, disclosure to referral arrangement and outside parties. The sponsor of a state employee pension is seeking to hire a firm to manage the pension plan's emerging market allocation. To assist in the review process, the sponsor was hired. Thomas Arrow is a consultant to solicit proposals from various advertisers. Arrow is contracted by the sponsor to represent its best interest in selecting the most appropriate news manager. The process runs smoothly and Overseas Investment is selected as the new manager. The following year, news breaks that Arrow is under investigation by local regulatory for accepting kickbacks from investment managers after they are awarded new pension allocations. Overseas Investments is included in the list of firms alleged making these payments. Although the sponsor is happy with the performance of the Overseas since it has been managed by the pension plan's emerging market fund, the sponsor still decides to have an independent review of the proposals and a selections process to ensure that Overseas was an appropriate firm for its needs. The review confirms that even though Arrow was being paid by both parties, the recommendation of Overseas appeared to be objective and appropriate. Comment: Arrow has violated Standards I-VIII because he did not disclose the fees being paid by Overseas. Withholding this information raises the questions of potential lack of objectivity in the recommendation of Overseas by Arrow. This aspect is in addition to questions about the legality of having firms pay to be considered for an allocation. Regulators and government agencies may adopt requirements concerning allowable consultant activities. Local regulations sometimes includes having a consultant register with the regulatory agency. Ethics board regulatory policies may include a prohibition of acceptance of payments from investment managers receiving allocations and require regular reporting of contributions made to political organizations and candidates. Arrow would have to adhere to these requirements as well as the Code of Ethics and Standards. Standard I-VII, responsibilities as a CFA Institute member or CFA candidate. Standards I-VIII, conduct as participants in the CFA Institute programs. Members and candidates must not engage in any conduct that compromises the reputation or integrity of the CFA Institute or CFA designation, or integrity, validity, or security of the CFA Institute program. Highlights confidential program information, additional CFA program restrictions, and expressing an opinion. Standards I-VIII covers the conduct of CFA Institute members and candidates involved with the program curriculum, prohibits any conduct that undermines the public confidence in the CFA charter, represents a level of achievement based on merit and ethical conduct. There's an array of CFA Institute programs beyond the CFA program that provides additional education and credentialing opportunities, including the Certificate of Investment Professional Management CIPM program and the CFA Institute Investment Foundation program. These standards functions its hold members and candidate high ethical criteria while they are participating and involved with any CFA Institute program. Conduct covered includes but are not limited to giving or receiving assistance, cheating on any CFA Institute examination, violating the rules, regulation, and testing policies of CFA Institute programs, providing confidential program or exam information to candidates or the public, disregarding or attempting to circumvent security measures established by any CFA Institute examinations, inappropriately using association with the CFA Institute to further personal or professional goals, and misrepresenting information on the professional conduct statement or in the CFA continuing education programs. Confidential program information. CFA is vigilant about protecting the integrity of the CFA program's content and examination process. CFA Institute programs, rules, regulations, and policies prohibit candidates from disclosing confidential material during the examination process. Examples of information that cannot be disclosed to candidates sitting for an examination include but are not limited to specific detail of questions appearing on the exams, broad topic areas for formula tested or not tested on the exam. All aspects of exams, including questions, broad topical areas, and formulas tested or not tested, are considered confidential until such time as CFA Institute elects to release them publicly. The confidentiality requirement allows CFA Institute to maintain the integrity and rigor of exams for future candidates. Standards I-VIII does not prohibit candidates from discussing non-confidential information or curricular material with others or in study groups in preparation for the exam. Candidates increasing use of online forums and new technology as part as their examination preparation. CFA Institute activities, personal blog, forums, and related social network groups and information considered confidential. The organization works with both individual candidates and the sponsors of online or offline service to promptly remove any and all violations. As noted in the discussion, Standards I-A knowledge of the law, candidates, members and public are encouraged to report suspected violations of CFA Institute. The CFA program's rules, regulations, and policies define additional disallowed actions concerning the exam. Violating any of these testing policies, such as the calculated policies, personal belonging policy, or candidate pledge, constitutes a violation of Standards I-VIII. Candidates with all of these policies on the CFA program portion of the CFA Institute website. Exhibit 2 provides the CFA the candidate pledge, which highlights the respect candidates must have for the integrity, validity, and security of the CFA exam. Members may participate as volunteers or in various aspects of the CFA program. Standards I-VIII prohibits members from discussing, from disclosing and or soliciting confidential material gained prior to or during the exam and grading process with those outside of the CFA exam development process. Examples of information that cannot be shared by members involved in developing administration or grading the exams include but are not limited to questions appeared on the exam or under consideration, deliberation relates to exam processes, and information related to scoring of questions. Members may also be asked to offer assistance with other CFA Institute programs include but not limited to CIPM and investment foundation programs. Members, participants in any CFA Institute program should do so with the same level of integrity and confidentiality as is required of participants of the CFA program. Expressing an opinion. Standards I-VIII does not cover expression of opinion regarding CFA Institute, the CFA program, and other CFA Institute programs. Members and candidates are free to disagree and express their disagreement with CFA Institute and its policies and procedures or any advocacy positions taken by the organization. When expressing a personal opinion, the candidate is prohibited from disclosing content-specific information, including any actual exam questions of the information as to subject matter covered and not covered in the exam. Exhibit 2, sample CFA program test practice. A candidate pledge. As a candidate in the CFA program, I am obliged to follow Standards 7A of the CFA Standard of Professional Conduct, which states that members and candidates must not engage in any conduct that compromises the reputation, integrity of the CFA program, of the CFA designation, or the integrity and validity or security of the CFA exam. Prior to this exam, I have not given or received information regarding the contents of this exam. During the exam, I will not give or receive information regarding the content of this exam. After this exam, I will not disclose any portion of this exam, and I will not remove any exam material from the testing room. In original or copied form, I understand that all exam material, including my answers, are property of CFA Institute and will not be returned to me in any form. I will follow all rules of the CFA program as stated on the CFA Institute website and the back cover of the exam book. My violations of any rules of CFA program result in CFA Institute voiding my exam results and may lead to suspension or termination of my candidacy in the CFA program. Applications of standard example when sharing exam questions. Travis Narrow serves as a proctor for administration for CFA examination in his city. In the course of his service, he reviews a copy of the Level 2 exam on the evening prior to the exam's administration and provides information concerning the exam questions and two candidates who use it to prepare for the exam. Nero and the two candidates has violated Standards 7A by giving information about exam questions to two candidates. Nero provided an unfair advantage to the two candidates and undermines the integrity and validity of the Level 2 exam as an accurate measure of the knowledge, skills, and abilities necessary to earn the right to use the CFA designation. By accepting the information, the candidate also compromises the integrity and validity of Level 2 exams, undermines the ethical framework by keeps that is a key part in the designation. Example 2, bring written material into exam room. Lauren Sovian is enrolled to take CFA Level 2 CFA examination. He has been having difficulties remembering a particular formula, so prior to entering the exam, he writes the formula on the palm of his hand. During the afternoon sections of the exam, proctor notices Sylvia looking at his palm of his hands. She asks to see his hand and sees the formula. Because Sylvian wrote down the information from the candidate book of knowledge CBOK and took the written information into the exam room, his conduct compromises the validity of the exam performance and violated Standards 7A. Sylvian's conduct was also in direct contradiction with the rules and regulations of the CFA program and candidate pledge and the CFA Institute Code and Standards. Example 3, writing after prior exams. At the conclusion of the morning section of Level 1 CFA examination, the proctors announced to stop writing now. John Davis has not completed the exam, so he continues to randomly fill in overalls on his answer sheet. The proctor approaches Davis's desk and reminds him that he should stop writing immediately. Davis, however, continues to complete his answer sheet after the proctor asks him to stop writing 2 additional times. Davis finally put down his pen by continuing to complete the exam after time was called. Davis has violated Standard 7A by continuing to write. Davis took an unfair advantage over other candidates, and his conduct compromises the validity of the exam performance. Additionally, by not heeding the prosecutor's repeated instructions, Davis has violated the rules and regulations of the CFA program. Example 4, sharing exam content. After completely Level 2 of the CFA exam, Annabelle Rossi puts on her blog about her experience. She posts the following: Level 2 is complete. I think I did fairly well on the exam. It was really difficult, but fair. I think I did especially well on the derivatives question, and there were tons of them. I think I counted 18. The ethical questions were really hard. I'm glad I spent much time on the code and standards. I was surprised to see there were no questions about IPO allocations. I expected there to be a couple. Well, off to celebrating getting through this. See you tonight. Question mark. Rosie did not violate Standards 7A when she wrote about how difficult she found the exam or how well she thinks she may have done. By reviewing her portion of the CBOK covered on the exam and areas not covered. However, she did violate Standards 7A. The candidate pledged, depending on the time frame in which the comment was posted, Rosie not only may have assisted future candidates, but also may provide an unfair advantage to candidates yet to sit for the same exam, thereby undermining the integrity and validity of the Level 2 exam. Example 6, sharing exam content. CFA for sure is a company produces text preparation materials for CFA program candidates. Many candidates register for the use of program products the day after CFA examination. CFA for sure sends an email to all its customers asking them to share with the company the hardest questions from the exam. Of the CFA for sure can better prepare customers for the next exam administration. Marceli Pena emails a summary of the questions she found most difficult on the exam. Comment: Pena has violated Standard 7A by disclosing a portion of the exam question. The information provided is considered confidential until publicly released by the CFA Institute. CFA for sure is likely to use such feedback to refine its review material for future candidates. Pena's sharing of this specific questions undermines the integrity of the exam while potentially making the exam easier for future candidates. If the CFA for sure employees who participate in the solicitation of confidential CFA program information are CFA Institute members or candidates, they also have violated Standard 7A. Example 7, discussion of exam graded guidelines and results prior to participating in grading CFA examination. Wesley Whitecone is required to sign a CFA Institute grader agreement as part of the graders agreement. Whitcomb agrees not to reveal or discuss the examined material with anyone except CFA Institute staff and other graders. Several weeks after the conclusion of the CFA exam grading, Whitcomb tells several colleagues who are candidates of the CFA program which questions he graded. He also discusses the guideline answer and adds that few candidates scored well on those questions. Whitcomb violated Standards 7A by breaking the grader agreement and disclosing information related to specific questions on the exam, which compromises the integrity of the exam process. Example 8, compromising CFA Institute integrity as a volunteer. Jose Ramirez is an investor relations consultant for several small companies that are seeking greater exposure to investors. He is also the program chair for the CFA Institute Society in the city where he works. Ramirez schedules only companies that are his clients and makes presentations to the society and excludes other companies. Ramirez, by using his volunteer position at CFA Institute to benefit himself and his clients, compromises the reputation and integrity of CFA Institute and thus violates Standard 7A. Example 9, compromising CFA Institute integrity as a volunteer. Margaret Waransky is a member of CFA Institute GIP Executive Committee, where oversees the creation, implementation, and revision of the Global Investment Procedure Standards, or the GIP standards. As a member of the Executive Committee, she has advanced knowledge and confidential information regarding the GIP standards, including any new or revised standards and committee in considering. She tells her clients that her Executive Committee membership will allow her to better assist her clients in keeping up with the changes to the standards and facilitating their compliance with the changes. Comment: Wawrensky is using her association with the GIP Executive Committee to promote her firm's services to clients and potential clients in defining her volunteer positions at CFA Institute as a strategic business advantage over competing firms, and implying to clients that she would use confidential information to further their interests. Wierenski is compromising the reputation and integrity of the CFA Institute and thus violating Standards I-VIII. She may factually state her involvement with the executive committee but cannot infer any special advantages to her clients from such participation. Standards I-VIIB, reference to CFA Institute, the CFA designation, and CFA program. When referring to CFA Institute, CFA institution membership, the CFA designation or candidacy in the CFA program, members and candidates must not misrepresent or exaggerate the meaning or implications of membership in the CFA Institute holding the CFA designation or candidacy in the CFA program. Guidance highlights CFA Institute members using the CFA designation referring to candidacy in the CFA program. Standard I-VIIB is intended to prevent promotional effects that makes promises or guarantees that are tied to the CFA designations. Individuals must not exaggerate the meaning and implications of being a member in the CFA program or institute holding the CFA designation or candidacy in the CFA program. Standards I-VIIA is not intended to prohibit factual statements related to positive benefits of earning the CFA program. However, statements referring to the CFA Institute and CFA designation or the CFA program that overstates the competency of an individual or imply either directly or indirectly that superior performance can be expected from someone with a CFA designation are not allowed under this standard. A statement that highlights or emphasizes the commitment of CFA Institute members, CFA charter holders, and CFA candidates to ethical and professional conduct, or mentions the thoroughness and rigor of the CFA program are appropriate. Members and candidates may make claims about the relevant merits of CFA Institute, the CFA program, or the CFA code and standards, as long as those statements are implicitly or explicitly stated as opinions of the speaker. Statements that do not express opinions have to be supposed to be facts. Standard I-VIIB applies to any form of communications, including but not limited to communications made by electronic or written forms such as letterhead, business cards, brochure, or professional resumes, and oral statements made by the made to the public client or prospects. CFA Institute membership. The term CFA Institute membership refers to regular or affiliated members of CFA Institute who have met the membership requirements as defined as in the CFA Institute bylaws. Once accepted as a CFA Institute member, the member must satisfy the following requirements to maintain his or her status: remit annually to CFA Institute to complete professional conduct statements, which renews the commitment to abide by requirements of the code and standards and CFA Institute program, professional conduct program, and 2, pay applicable CFA Institute membership dues on an annual basis. If a CFA member fails to meet any of these requirements, the individual is no longer considered an active member until the membership is reactivated. Individuals must not present themselves to others as active members. They may state, however, that they were CFA Institute members in the past and refer to the years when the membership was active. Using the CFA designation, those who have earned the right to use Chartered Financial Analyst designation are encouraged to do so, but only in a manner that does not misrepresent or exaggerate the meaning or implication of the designation. The use of the designation may be accompanied by an accurate explanation of the requirements that have been met to earn the right to use the designation. CFA charter holders are those individuals who have earned the right to use the CFA designation granted by the CFA Institute. These people have satisfied certain requirements, including completion of the CFA program and required years of acceptable work experience. Once granted the right to use the designation, individuals must also satisfy the CFA Institute membership requirements, see above, and maintain their right to use the designation. If a CFA charter holder fails to meet any of these membership requirements, he or she forfeits the right to use the CFA designation. Until membership is reactivated, individuals might not present themselves to others as CFA charter holders. They might state, however, that they were charter holders in the past year. Given the growing popularity of social media, where individuals may anonymously express their opinions pseudonyms or online profile nicknames created to hide a member's identity should not be tagged with the CFA designation. Use of the CFA designation by the CFA charter holder is governed by the terms and conditions CFA Institute and program membership prior to commencement of use of CFA designation and reaffirming it annually. Referring to candidacy in the CFA program, candidates in the CFA program may refer to their participation in the CFA program, but such references may clearly state that an individual is a candidate in the CFA program and must not imply that candidates have achieved any type of partial designation. A person is a candidate of the CFA program if 1. The person's application for registering a CFA program has been accepted by CFA Institute as evidenced by issuance of notice of appearance and the person's is enrolled for a specific examination, or the registered person has sat for a specific examination by exam results have not yet been received. If an individual is registered by the CFA program but declined to sit for an exam or otherwise does not meet with the definition of a candidate or describe it to the CFA Institute bylaws, then the individual is no longer considered an active candidate. Once the person is enrolled to sit for the future examination, his or her CFA program candidacy resumes. CFA program candidates must never state or imply that they have partial designation as a result of passing one or more levels, or cite an expected completion date of any level of the CFA program. No reward of charters is subject to meeting the CFA program requirements and approved by CFA as the Board of Governors. If a candidate passes each level of examination in consecutive years and wants to state that he or she did so, that is not a violation of Standards I-VIII, because it is a statement of fact. If a candidate then goes on to claim or implies superior ability by obtaining the designation in only 3 years, however, he or she is in violation of Standards I-VIII. Exhibit 3 provides examples of proper and improper references to CFA designations. Exhibit 3, proper and improper information for CFA designations. So I'm not going to read that. Recommended, you could pause the video and look at it yourself. Okay. Moving on, recommendations, procedures for compliance, misuse of a member's CFA designation or CFA candidacy, or improper reference to the to its comments by the member by those in members or candidates firms who do not possess knowledge of the requirements of Standards I-VIII as an appropriate step for reduce the risks. Members and candidates should disseminate written information about Standards I-VIII and company guidance for their firm's legal compliance, public relations, and meeting departments. For material that refers to employees' affiliation with CFA Institute, members and candidates should encourage their firms to create templates that are approved by the central authority, such as the compliance department, as being consistent with Standards I-VIII. The practice promotes consistency and accuracy in the firm of reference to CFA Institute membership, the CFA designation, and CFA candidacy. Okay, application of standards, and we're done. Okay, let's do some application of standards. Example 1, passing exams in consecutive years. An advertisement for AZ Investment advertiser states that all the firm's participants and are CFA charter holders that all pass the 3 examinations on the first attempt. This advertisement promptly links the notion that AZ's mutual fund has achieved a superior performance. AZ may state that all participants pass the 3 examinations on the first try as long as the statement is true, but it may not be linked to performance or imply superior ability, implying that 1, CFA charter holders achieve better investment results, and 2, those who pass the exams on the first try may be more successful than those who do not, violates Standards I-VIII. Example 2, right to use CFA designations. 5 years after receiving his CFA charter, Louis Vassar resigns his position as an investment analyst and spends the next 2 years traveling abroad because he is not actively engaged in the investment profession. He does not file a complete professional conduct statement with CFA Institute and does not pay his CFA Institute membership dues. At the conclusion of its travel, Vassar becomes a self-employed analyst, accepting assignments as an independent contractor without reinstating his CFA Institute membership. By filing his professional conduct statements and paying his due, he prints business cards that display CFA after his name. Vassar has violated Standards I-VIII because his right to use the CFA designation was suspended when he failed to file the professional conduct statement and stop paying dues. Therefore, he is no longer he no longer is able to state or imply that he is an active CFA charter holder. When Vassar files his professional conduct statement, resumes paying CFA Institute dues to activate his membership and completes the CFA Institute reinstatement procedures, he will be eligible to use the CFA designation. Example 3, retired, quote-unquote, retired CFA Institute membership status. After 25 years, after a 25-year career, James Simpson retires from his firm. Because he is not actively engaged in the investment profession, he does not file a complete professional conduct statement with CFA Institute and does not pay his CFA Institute membership dues. Simpson designs a plain business card without a corporate logo to hand out to friends with his new contact detail and continues to put CFA after his name. Simpson has violated Standards I-VIII because he failed to file his professional conduct statements and ceased paying dues. His membership has been suspended and has given up the right to use the CFA designation. CFA Institute has procedures, however, to reclassify a member or a candidate as retired and reducing the annual dues. If he wants to obtain retired status, he needs to file appropriate paperwork with CFA Institute. When Simpson receives notification from CFA Institute that his membership has been reclassified as retired, and he resumes paying reduced dues, his membership will be reactivated and his right to use the CFA designation will be reinstated. Example 4, stating facts about CFA designation and programs. Rhonda Rees has been a CFA charter holder since the year 2000. In a conversation with a friend who is considering enrolling the CFA program, she states that she has learned a great deal from the CFA program and the many firms require their employees to be CFA charter holders. She would recommend the CFA program to anyone pursuing a career in investment management. Rose comments comply with Standards I-VIII. Her statements refer to facts. The CFA program enhance her knowledge, and many firms require CFA designations for their investment professionals. Example 5, order of professional academic designation. Tatiana Pritima, that's a funny name. Tatiana Pritima. Tatiana Pritima has entered both her CFA designation and a PhD in finance. She would like to cite both her accomplishment on her business card, but is unsure of the proper method for doing so. In order for designations cited as such items as resumes and business cards, in a matter of personal preference, Pritima is free to cite the CFA designation either before or after citing her PhD. Multiple designations must be separated by a comma. Example 6, which is the last darn example of reading 3, which is so long. Do you see how long this video is? Man, I spent like countless hours on this video. So please leave a like and subscribe, okay? Example 6, using the fictitious name Barry Gass is the lead quantitative analyst at City Center Hedge Fund. Glass is responsible for the department, maintenance, and enhancement of proprietary models and fund used to manage its investors' asset. Glass reads several high-level mathematical publications and blogs to stay informed on current development. One blog run by expert CFA presents some intriguing research that may benefit one of City Center's current models. Glass is under the pressure from firm executives to improve the model's predictive abilities, and he incorporates the factors discussed in the online research. The update output recommended several new investments to the funds portfolio managers. Expert CFA has violated standards 7B by using the CFA designation inappropriately. As with any research report, authorship of online comments must include the charter holder's full name along with reference to the CFA designation. See also Standards 5A with Glass has violated the guidance of diligence and reasonable basis. Okay, so what we have next is the practice problems. I'm not going to read the practice problems, nor am I going to read the solutions to the practice problems. This video is so long. It's so darn long. I actually split the recording of this video into 12 parts, believe it or not. This reading starts around page 60 and now it's page 230. But I'm glad we were able to get through reading 3. And I do hope this reading 3 is helpful, and I do hope my commentary on reading 3 is helpful. And our next video, we'll be doing reading 4, which is about the global investment performance standards, the GIPS, another integral part of the CFA level 1 of professional conduct ethics section. So this concludes my reading 3 of the CFA level 1 program curriculum, and I hope to see you guys in the next one. I do hope this video is helpful. This very long ass video is helpful, and I hope to see you guys in the next one. We'll be doing reading 4, and yeah, so thanks for your time, and I hope this video is helpful. Goodbye.